of what is behind the growth scare. It is not necessarily a lack of borrowing available. It's not a lack of capital. It's a lack of demand. It's a lack of consumer spending. And so cutting rates won't attack that. And that really just highlights how much the market's aware of that and not responding to this in the same kind of way as it might have.
Puts even more emphasis on fiscal stimulus
Correct.
and the need for it. Goldman just yesterday talking about maybe Chinese authorities waiting to unload some of that for 25 to see the outcome of the November election. I want to turn to the automakers. It's been difficult for many of them. Shares of Ford slumping in the pre-market. The automaker posting second quarter profit that fell short of estimates. Quality problems the issue here that led to a jump in warranty costs. That stock is down by 13%. The CFO saying it was a one-time issue, insisting, Lisa, the company's heading in the right direction. I guess we'll see.
There are a lot of questions remaining. This is a warranty issue. They had one particular vehicle that did have a warranty, and people brought it in for a technical failure, and the cost was in the billions. Question is, what was behind that? Again, I keep going back to why are there these technical failures, issues? Is it a matter of personnel dating back to the pandemic? Is it something endemic? Or is this a matter of where do you focus at a time where consumers aren't buying electric vehicles as quickly as people had previously thought? And so how do you go back to the bread and butter while also having a nod to the future?
I tell you, we'll try and answer some of those questions in about 40 minutes when we catch up with the Stellantis CEO exclusively on this program. As the auto manufacturers, let's turn back to big tech. Higher spending on AI programs and computing needs at Google parent Alphabet, prompting a sell-off in big tech stocks as investors look for more return on AI spending. One area companies are investing heavily is in data center capacity. Waldemar Zlazak is the global head of digital infrastructure at KKR and says two megatrends are driving the demand for data center capacity: migrating data to the cloud and the rise of AI. Waldemar joins us now for more. Waldemar, good to see you, sir.
Thanks for having me.
Thank you for being here. Let's just talk about what is digital infrastructure. Let's start there, super simple. What are we describing here?
Yeah, it's a great question. I mean, I think to us, digital infrastructure really has three big pillars. There's mobile infrastructure. Traditionally, think of it as towers, telecom towers. There is the fixed line infrastructure, so it could be fiber that delivers connectivity to homes or enterprises. And of course, I think the topic we're about to discuss is cloud sort of storage and computing infrastructure, right? i.e. data centers, most pronouncedly. So those to us are the three big pillars, at least how we define digital infrastructure within KKR.
So let's talk about the investment opportunities and how much is going to be invested over the next several years. I want to reflect on a quote that came from the Google CEO, the Alphabet CEO, in the last couple of days, when he said the biggest risk here in a cycle with a theme like this is underinvesting and not over-investing. I sense from your perspective you're going to agree with that stance. Am I right?
Yes. Yes.
Why is that? Why is this such a big moment? And why is that the right way to look at the balance of risks?
Well, I think let's look at the computing piece, right, of it. I think two mega themes that we have are obviously under computing and last mile connectivity, and I think maybe we'll touch a little bit later on Metronet, which is a deal we announced yesterday in partnership with T-Mobile. But focusing on data center piece, I think if you look at United States and say what was the infrastructure, what was the spend to help facilitate the build out of internet infrastructure or cloud infrastructure? So 16-year cycle from 1990 to 2006. 2 gigawatts. No longer do we think about data centers in terms of square feet. It's really about the amount of power that the data centers have. So that's an important factor there to consider, and we'll touch on that in a second. So internet infrastructure, 2 gigawatts. The next phase was Internet 2.0 and cloud, 8 gigawatts, about 15 years. Technology cycles have accelerated. So we're now talking about AI build-out, cloud 2.0, internet 3.0 as a 5-year cycle, and 25 to 30 gigawatts of power required to fuel this. So I think you had a more patient, sort of highly visible investment cycle that's now gotten compressed, and perhaps it's creating, I think, scaring some of the investors out there.
Well, some people would argue that this might be one big reason for the sell-off we've actually seen in big tech. There was one investor who said this in a recent story: the overarching concern is, where is the return on investment in all the AI infrastructure spending? It'll pay off in a few years, but it's not going to come anytime soon. That is what the fear is. Waldemar, how much are you seeing near-term returns on some of these infrastructure projects that a lot of people would agree may be crucial in, say, 10 years?
Yeah, I mean, I think it's a great question. I would draw an analogy to similar questions raised during the build-out of cloud in 2006 and 2007. So, when Amazon really emerged as the cloud provider in 2007, I think similar questions were raised about where is the ROI. A tremendous amount of investment is needed to help facilitate the build-out before you actually start seeing the applications of that. And if you fast forward 2007 to today, Amazon stock is up almost 3,000%, right? And it's been forgotten. So I think the concerns are valid. I do think that there's frothiness in parts of the ecosystem. Within digital infrastructure, at least how we're positioning ourselves, we don't see that. Most of the capacity on the data center side that's coming online is fully leased. Most of it is leased to the large hyperscale customers. So the type of risks that we're looking to take, we're not necessarily exposed to perhaps some of the volatility. But I think it's a fair question to ask. What is the ROI? I think AI will be larger than potentially cloud. If you think about it today, cloud business is about a $500 billion business annually, investing almost $200 billion to build that infrastructure. I think the view is that this feels different than late 90s, perhaps, bubble.
That said, you said that there are certain pockets that feel frothy and certain pockets that seem very worthy. What are those pockets? How do you distinguish the two?
Yeah, I mean, that's why I think we're trying to figure that out. So a big part of what we're doing at KKR is really trying to map the entire ecosystem from the silicon side, which is, I think, we're talking about chips, to the ultimate endpoint of applications layer, and trying to figure out how do we participate to the different strategies that we have within KKR. We're not a venture investor, so we're staying away from that. An interesting point I would make, in 1990s, a lot of analogies are being drawn to the 1990s tech bubble and bust. There were 38 or 39 stocks. In 1999, they were up 100% in a year. Today, there's only one. So public markets, perhaps there isn't as much of a frothiness. Private markets, there's $15 billion of capital that has gone from venture capital funds into generative AI platforms. That's 10x the prior trend line. So I think perhaps there are parts of frothiness in the private markets versus the public markets. But I think we think of it as a long-term trend, sort of an industry 3.0, if you think about it in terms of long-term 300-year sort of a cycle. And we're pretty confident that we're still in early innings of that.
When you look at the investment, is it actual market demand, or some of this has to do with the fiscal push coming out of Washington?
It's fundamental market demand. I think we're seeing government part of this investment has not played a large role. Now, we think that in the long term, I think a comprehensive solution, which includes private capital, includes obviously a combination of the tech companies, intervention from some government policies to help facilitate the build out of some of this power infrastructure, which ultimately is a key component of this, will be required. From a KKR perspective, we think of it as we're pretty uniquely positioned to ultimately play a major role in that.
So you just announced a deal, and
Yes.
It was actually not on highfalutin cyber prowess in artificial intelligence. It was in medium-sized, smaller cities getting connectivity, basic connectivity to the internet, to the cell phone. How far behind are we in basic infrastructure at a time when we're trying to build out a massive network?
Yeah, so two mega themes. We touched on the cloud computing. The other big theme we have is fiber to the home. We've made over 10 investments globally, over $10 billion of capital just in the fiber to the home strategies over the last decade. We're pretty bullish. We think this is pretty important. So in the US, about 50 million homes still don't have access to full fiber. We think that that's unacceptable, and that ought to change. And so Metronet, which is the deal that we announced in partnership with T-Mobile, it's really meant to help facilitate the growth of that and really bridge the digital divide, not only in the sort of the, as you call it, the smaller cities, which, by the way, a smaller city in the United States called sub 50,000 population center has about the 1/5 of the speeds that you see in the major urban areas. And even in major urban areas, it's pretty inadequate. So I do think that we believe that there is a large decade-long investment cycle to help build out fiber infrastructure in the United States, and we're really happy to be part of it and happy to partner with a premier telecom operator like T-Mobile to do that.
You need to come back soon. We've only scratched the surface, haven't we? This was great. It's good to catch up with you, sir. Appreciate it.
Would love to.
Thank you. Waldemar Zazek there of KKR. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Let's get over to Danny Berger. Hey, Danny.
Hey, John. The PBOC has unexpectedly lowered the cost of its one-year policy loans by the most since April 2020. Days ago, it also cut a key short-term rate to give greater support for a slowing economy. Now, taken together, those rate cuts amount to just a modest round of easing, which economists say is unlikely to move the needle in things like boosting domestic demand. Shares of Kering getting slammed this morning, down more than 7%, trading at the lowest since 2017. The owner of Gucci has warned that its profit will tumble in the second half of the year. Luxury demand is cooling and its turnaround efforts are sputtering. Kering has lost half of its value just nearly over the past 12 months. The company's market cap is now $37 billion. That is roughly 1/10 the size of its rival LVMH. And while luxury is struggling, so too are consumer staples this morning. Nestle down 4.5%. It cut its sales guidance for the year with consumers turning to cheaper food options. Revenue also disappointed, growing 2.1%. That's compared to 2.5% expected by analysts. Nearly all of that growth came from higher pricing, which also slowed sharply in the second quarter. The CEO on a call said that the company is still in repair mode and gross margins will still come under pressure thanks to higher costs of coffee and cocoa. And that's your Bloomberg Brief. John.
Things are looking tough over there, Danny, in both staples and discretionary in Europe. Up next on this program, we'll switch gears. Netanyahu staying the course.
For the forces of civilization to triumph, America and Israel must stand together. Israel will fight until we destroy Hamas's military capabilities, end its rule in Gaza, and bring all our hostages home.
That conversation up next. Live from New York, you're watching Bloomberg Surveillance.
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The equity sell-off going worldwide. See it in Europe, in Asia, and Japan once again off the back of that stronger Japanese yen. Equity futures stateside after the sell-off of yesterday, down just a bit. We're negative 0.25% on the S&P. Under surveillance this morning, Netanyahu staying the course.
For the forces of civilization to triumph, America and Israel must stand together. This is an exceptional moment. Fast-tracking U.S. military aid could dramatically expedite an end to the war in Gaza and help prevent a broader war in the Middle East. Israel will fight until we destroy Hamas's military capabilities, end its rule in Gaza, and bring all our hostages home.
So here's the latest. Israeli Prime Minister Benjamin Netanyahu set to meet with President Joe Biden and Vice President Kamala Harris later on today. Thousands protesting Netanyahu's visit to the US, including burning American flags. Julie Norman of University College London saying this: expect those eyes, close eyes rather, on Kamala Harris's Mid-East foreign policy comments this week. She's mostly held the administration's line, but is also seen as less personally connected to Israel than Biden. Julie joins us now for more. Julie, we'll spend some time about how these individual leaders, the president and the vice president, are going to navigate these two issues. Just want to sort of set the scene for where we are in the conflict at the moment, because it seems to change from day to day. Are we closer to a ceasefire or closer to a broader conflict? Just how finely balanced are things at the moment?
Yeah, John, I would say it's almost both at the same time. On the one hand, I think we are closer to a ceasefire than almost any time before. With that said, we've gotten close before and things have fallen apart at the last minute. So until it's a done deal, it's not done. I would say even with a ceasefire, though, this war is not just going to close down and go away. I think as we heard yesterday from Netanyahu and as we've heard from him for months, Israel will expect to retain a security presence in Gaza. There is still no real plan for a day after. And my guess is that we'll be looking at a sort of a insurgency, counterinsurgency dynamic for some time to come.
What needs to change to open up the negotiation for a ceasefire? Because Netanyahu's in the country, but there's a lot of reporting that he's the one that's been holding this back.
Well, that's right. I would say there's been finger pointing both ways, again, for months now about who's holding it up. Right now, there are some elements that Netanyahu keeps pushing, and some say is slowing the negotiations. Those are some specific details, such as who's going to control the southern border of Gaza with Egypt, who's going to control that crossing, how will people move from south to north. But I think the crux of this is really what the tension has always been, the sense that Hamas wants to ensure this will lead to a permanent ceasefire and a full withdrawal of Israeli army and troops. And Israel wants to ensure that they can maintain some kind of security and military presence in the Strip. And those two things just keep coming to a head in some of the final wording.
Julie, as it comes to my understanding at this moment, there are 5 Americans still being held hostage by Hamas. Although yesterday we saw protesters in Washington, D.C., waving Hamas flags and burning American flags. How much of a gift are those images to the likes of Sinwar?
Yeah, so obviously the protests have been going on for months now, and I do think that they give some sense of support to Hamas, but also to Palestinians more broadly. With that said, I think a lot of the messages in the protests reflect just a small slice of many of who are taking to the streets around this. But I would say, protests have been a big part of this in Israel as well, in terms of trying to bring the hostages home. And if anything, I'd say that is where Netanyahu is feeling the pressure more from the protests that have been ongoing within his own country.
It does put a spotlight on the differing views that are associated currently with respect to Israel from both the Republican Party as well as the Democratic Party. It is viewed in popular culture right now that Republicans are a lot more friendly to Israel than Democrats, and that's one of the reasons why you're seeing an increasing number of the Jewish vote actually shifting Republican, which is really the first time you've seen that in a long time. Julie, how is this reshaping the concept of the U.S. relationship with Israel, depending on whether it is a Republican or Democratic administration?
Yeah, Lisa, this was certainly part of Netanyahu's calculation with coming at this time. He sees the political landscape shifting, and I think he wanted to come and give this speech to really try and shore up that bipartisan support and almost challenge Democratic lawmakers to, turn their back on him. And I think the case that we heard him making yesterday was trying to appeal a bit more to bipartisanship than he has in a couple of his recent visits. And that was in trying to frame this conflict, one, in very moral terms, and two, in very strategic terms, saying this is civilization versus, barbarism. And on top of that, all this is nested within Iran, within other regional tensions, that the U.S., this is in your interest to keep aiding Israel. And I think that's the message that Netanyahu really is trying to get home this week to both parties.
One big question has been that currently we now have a lame duck president, that President Biden has about 4 more months left in his tenure, less than that, as he prepares for another administration, whether it's Kamala Harris or Donald Trump. Does that lack of another term, the lack of his being in the running, make it easier or harder for him to play a significant role in some of the ceasefire, some of the end to the conflict types of discussions?
Yeah, I think a bit of both. I mean, right now, we still have 6 months with Biden in office, and a lot of what's going to play out with the ceasefire, et cetera, in the short term is going to be under his watch. And that's one reason why this meeting today between Biden and Netanyahu still matters. At the same time, we all know, looking ahead, it's going to be a different leader after 6 months, and that's also why Netanyahu has to meet with Harris and with Trump and trying to get those relationships somewhat on track with him as well. But with Biden, I think it'll be interesting to see. Some are saying he might be a bit more open to tough talk with Netanyahu today simply because he doesn't have re-election hanging over him. His strategy up till now has been what they call a bear hug approach, a sort of a public embrace, but private speaking a bit more frankly. And I think we might expect a bit more frankness today.
And that's an interesting assessment. Julie Norman there of UCL. Julie, thank you very much. Appreciate it. Just reconnected my mic there, I think. Okay, we saw it. I think we're good. All right, good. I think your question's an important one. The lack of appreciable sort of like continuity around a key foreign policy issue, I think it's going to be really, really important here. If you think about two issues at the moment, Ukraine and Israel could have two very, very different partners come January next year. You mentioned Israel, Ukraine too.
Terry Haynes actually put out a note and said that on the margins, the speech was somewhat markets negative because he expects the increase in potential geopolitical tensions to result from that lack of continuity and an unclear sense of exactly how he plans to proceed.
And also what you have is Netanyahu going down to Mar-a-Lago to meet with Trump. There's been this narrative that Netanyahu wants to wait to get any sort of deal until Trump comes back into play. And we're going to hear a lot more policy leak out. This week I've reported that a Trump 2.0 might mean pushing NATO when it comes to Ukraine, pushing NATO to spend 3% of defense of their GDP, no longer the 2% he was hammering them for.
The second hour of Bloomberg Surveillance is up next. Coming up next on the program, we'll catch up with Anastasia Amoroso of iCapital, Carlos Tavares of Stellantis, and Gurpreet Garewal of Goldman Sachs Asset Management, alongside Libby Cantrell of PIMCO. From New York City, this is Bloomberg.
Bloomberg Power Players is back this September. As the top names in tennis take the court over in Queens, we are convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at BloombergLive.com/powerplayers.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m., only on Bloomberg Television. Context changes everything. The names that move markets are on Bloomberg.
We've seen story after story about companies delisting from the London Stock Exchange, listing in New York, listing in Europe. I want to turn that around. I want Britain to be the place of choice to make an IPO, to grow your business. That's why I welcome the reforms that the FCA put in place last week. It's also why I'm determined to change our pension system so we can keep more businesses here in Britain.
Bloomberg. Context changes everything.
We're at a point right now where I think we can all agree the economy is slowing.
There is some evidence that some of that slowing in the macro data is starting to feed through to corporate earnings, and that creates a less constructive backdrop for stocks.
Policy rates today are restrictive. Why not have less restrictive policy?
To the market, what's going to matter most on all of these things is clarity. So long as there's clarity, the business environment will be able to handle it.
I gotta say, we've never had this intensity of debates between bulls and bears.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Coming off the back of the biggest one-day sell-off of the year so far on both the S&P 500 and the NASDAQ too. From New York City this morning, good morning, good morning. Your equity picture looks a little something like this. Equity futures pulling back once again on the S&P by 1/10 of 1%, down just 2/10 on the NASDAQ. Think about the arc of the last month or so. Mohamed Al-Arian coming out and saying they need to cut rates in July. Jan Hatzius of Goldman saying, why wait? Bill Dudley, former New York Fed president, on Bloomberg Opinion in the last 24 hours, I've changed my mind. They need to cut interest rates.
And the change of mind was partly why markets particularly took this as an onerous and potentially problematic signal. It comes as there's a number of data points that have pointed to a weakening consumer, including credit card balances. That the share of credit card balances past due reached a series high in recent Philly Fed data, going back to 2012, at a time when it's clear that there has been a shift in consumer preferences. This is really the key. Weak or weakening?
Bill Dudley, 8:15 Eastern Time. Bill's going to have thoughts on that. Don't miss that conversation a little bit later on this morning. Think about where we've been and what's worked so far and what's unwinding now. We've described this, characterized things this morning as just a monster unwind of consensus positions across equities, bonds and foreign exchange. In equities, it's big tech selling off. Over in Europe, it's luxury. We see that again this morning. In Japan, what did you want to be in Japan? You wanted to be short the Japanese yen along the equity market. What's unwound? Exactly that. We're seeing this across the board in a really aggressive way. It is not just US tech. I think we need to be really clear about that. It is global. It is a series of consensus positions unwinding cross-asset.
Which is the reason why you're going to hear some people, including Max Kettner over at HSBC, say this is technical. This is not a matter of any kind of fundamental change. And people are trying to put a narrative around it. This has been the story for the whole year. We've all been trying to do that. Here's the question, though. At a certain time when, yes, that is true, these are consensus trades that are now suddenly underperforming after basically a hyperbolic move up, there are some real signals. We're getting some earnings, including from the airlines, that are hugely disappointing, including from some of the auto manufacturers, hugely disappointing. The commentary from executives also highlighting how consumers are pushing back. They're not spending as freely.
Max Kettner saying don't buy the growth scare, but I agree with you. Go to the earnings this morning. Nestle, talking about the cost of living crisis. Those consumers that were trading down at the moment, they're struggling to get them back. Look at the automakers. It is bleak when you look at autos, when you look at luxury. You thought potentially it was a higher end consumer that was going to keep chugging along. You are seeing cracks even at the higher end. It's not just the lower end that's trading down.
Well, let's talk about the airlines. Check out American this morning. Numbers just dropped. Stock does too. Down by more than 6%. New range, new outlook for EPS, 70 cents to 130. They had seen 225 to 325. Pre-market, at least we're down 7% in early trading.
Yeah, what they see right now is third quarter adjusted earnings per share about $0. It was expected to be about half a dollar. You're looking at a situation where they're not able to pass along pricing increases to the consumers. The same story for Nestle, although albeit a different industry. They're seeing their margins squeezed. Is this just a consequence of inflation coming down, which is what a lot of people were saying? So it was less clear that they could pass it along to consumers? Or is this something different? And that, I think, is what's creating some issues in markets.
Sit on that stock. Just look at this move. We're down 9%. And think about how much lower the bar should have been for this company. We heard it from Delta. We heard it from United. Surely the bar was low enough going into earnings. And I think this really just shows you something. And we often talk about this. You can look at the information. That's one thing. And you can look at how the market responds to it. That's another. This is a really bad time to report bad news. We've seen that at the automakers in the last 24 hours. You're seeing it with American this morning.
It's a great point that essentially if you present something that is disappointing, you are unduly punished, especially if it is consumer facing. There is this sense that in the airline industry, there is a normalization or a rolling over in the post-pandemic kind of travel boom. Question is, how deep does it go? These are pretty bad. The idea of seeing full-year adjusted earnings per share 70 cents to $1.30 versus $2.25 to $3.25, that's a huge adjustment downward.
The airline business is a tough one right now, that's for sure. That's the latest on American. The broader price action, equity futures stateside settled down just a little bit. We're lower by only 0.1% on the S&P. The losses follow through from the US into Asia, into Europe. Europe's getting dragged down big time across the board over on the continent. In the FX market, we're seeing just a little bit, again, a lot more maybe, of yen strength against the weaker dollar. Dollar yen breaking down to the low 150s now at about 152. In the bond market, quite a scene for you. Big rally. Once again, we're down 6 basis points on 10s. Lisa, on 2s, we're down 7 or 8 basis points.
There's this expectation that the Fed's going to have to respond, and this is clearly baked into markets for September. Whether next week they cut rates is going to be a huge question. Mohamed El-Erian, in his column today, talked about how they probably won't, just because they want to signal and they want to create enough distance from the political process. But if they don't cut rates in September, this will be a policy error akin to transitory, if not potentially even more harmful to the U.S. economy.
I was catching up with Mike McKee in the newsroom a little bit earlier this morning before the program started. He just said the market's already cutting rates for them based on some of these moves. They just have to validate it by giving a nod to September.
Maybe, but if they continue to come out with a certain rhetoric that they have patience and they continue this rhetoric that they don't expect to cut rates all that much next year, that could change the market's perception of the reaction function to a Fed that is looking at the same data that they are.
Coming up this hour, we'll catch up with Anastasia Amoroso of iCapital as the S&P 500 snaps its longest streak without a 2% decline since 2007. Stellantis CEO Carlos Tavares following a disappointing earnings report, and PIMCO's Libby Cantrell as the 2024 presidential race heats up. We begin with our top story, a big sell-off in big tech, sending the S&P 500 to its worst day since December 22. Anastasia Amoroso of iCapital writes in this: tech consolidation and sell-off likely has more to go. Outperformance in terms of positive surprises led the significant Mag 7 stocks outperformance over the past year and a half. But it now may be coming to an end. Anastasia joins us for more. Anastasia, good morning. It's good to see you.
Good to see you.
What are we seeing take place here? Just a massive technical unwind of consensus positions across the board? Is it a growth scare, a rotation, a broadening gap? What is this?
Well, I think the technical backdrop is part of the story. And obviously, you know, the technicals were very stretched coming into, I would say, June for technology shares in particular, whether you looked at positioning, whether you looked at the overbought conditions. Remember, we were the relative strength indicator over 70 for quite some time. So I think that explains part of the unwind. When you see a setup like that, you think, well, something's going to happen to take us down. But I do think also there's a more fundamental story here, which is the earnings surprises. As I mentioned, that's what really lifted the Mag 7 stocks higher. If you look at by how much they were beating expectations, that's one way to look at it. The rest of the S&P was not doing much, but the Mag 7 was doing a lot. The other thing to think about is how much were the earnings revisions going up for some of those technology stocks. And again, it's by a significant amount. That is not likely to be the case going forward. And case in point, Alphabet and Tesla did not see the positive surprises or saw a negative surprise. And to your point, the market is really severely punishing that. So you have lofty expectations, you have lofty valuations, and now you don't have the same surprise factors you did before. So that's why I think investors will continue this unwind trade.
This is a very confusing market to me because on one hand, I believe in the sort of unwind story and then it doesn't seem so pernicious. It's just basically taking chips off the table, cashing in just technically for risk adjustment. On the flip side, I want to stick on American Air for a second, and I'm not asking you to comment specifically on this airline, but the fact that the shares are down so much, even after, as John was mentioning, being punished all through the year, it is down 26% year to date, really suggests that we're coming off really low expectations and still getting punished when earnings disappoint. Doesn't that reflect this feeling of sort of the unknown of how much and how quickly growth is weakening?
Yeah, but I think the expectations were probably not low enough coming into this quarter. If you think about how much the expectations typically get revised down, it's let's say 3 or 4%. This time around, they got revised down by all of 0.5%. So I don't think we really set the bar substantially lower, and that's why going into the reporting season, one of the things we've been flagging is there's likely this disconnect that's building between the earnings expectations and what's happening in the economy. And if you look at the economic surprise index, it's been negative for quite some time. If you look at the U.S. consumer, Lisa, I think I'm now maybe finally joining you in that camp, that there's a weakening in the U.S. consumer, and there's the unemployment rate that did go up from 3.4% to 4.1%. That's not something to disregard. So I think that's the squaring that we have to do in the markets, is acknowledge the fact that earnings expectations were too high for the economic growth that we have today.
What does that mean for how bullish or bearish you are on, say, tech stocks, which you used to really love and you used to lean into? You said you can't just throw them out because everybody loves them.
Yeah.
At this point, are you looking to buy? Is this sort of a buyable dip, or is this something that you stay away from because you don't want to get in front of a freight train?
I think you don't buy just yet, or maybe you buy very slowly, but with the idea that this is likely to play out over the coming months. And the reason I say that, Lisa, is there's this Gartner's hype chart that I'm sure a lot of us and a lot of viewers have seen, and you go through this peak of inflated expectation cycle, and what's on the other end is actually the trough of disillusionment. And I'm not saying that we're necessarily going that way for all of the AI stocks, but I think for some of them we likely are. Or it's going to take longer to monetize the AI that we were all so excited about. So that's why I think that part is going to take a little bit longer to play out. The other part is just given how long investors have been some of these artificial intelligence stocks, I think there's still a lot of selling pressure that is likely to come forth. So that's why I would think about having a shopping list, but executing that shopping list probably over the next few months. The other thing, too, the markets typically consolidate into the first, or I should say after the first rate cut. So whether it's July, whether it's September, the markets 3 months after the cut tended to consolidate. Information technology, if you use the 1995 cycle, for example, as a soft landing scenario, Infotech rallied into the first rate cut, but again, it's sold off or consolidated after. So that's why I don't think it's a quick buy the dip here in technology, but think about it as more of a protracted, let's say 3 months consolidation frame.
Given you've now come onto Lisa's side about these concerns in the consumer, where will that play out in the market? If consumers aren't spending, what does that mean for potentially stocks you want to go in on or pull back?
First of all, what I would say, the consumers are spending, right? But they're not spending as much as they used to. If you look at credit card spending data, for example, if it was up 7 or 8% year over year, now it's maybe 3 to 5%, depending on what kind of a consumer you look at. So I think it's a slowdown story versus a recessionary consumer spending print. But I will say, Anne-Marie, that one of the favorite trades that I have in the market today are the rotation trade, which is the other side of the technology trade, which is going to things like regional banks, for example. So it's probably not as levered to the consumer as it is to the commercial real estate market, for example, but regional banks are really levered to lower interest rates. I think the one certainty that we have in this market environment is the Fed is likely to cut rates, if not this month, then probably in the next couple of months. And if that's the case, you want to go to those rate cutting beneficiaries. If you have lower rates, then some of those unrealized losses on the balance sheets of those banks should maybe become less so than they were before. If you have lower rates, you should also have better income margins, net interest margins for those banks. So that's where I would be looking to position in regionals, in small caps, and utilities, which all of those sort of avoid the consumer.
Smalls outperforming this morning. Equity futures on a Russell up by about 0.2%. Just an observation, more and more people sort of shift into Bramo's camp. on the consumer. You notice that? They always point at you. They're like, I'm in your camp
it's
now.
Sort of like,
it's like you run the camp.
I run the camp of sort of vague pessimism and sort of gloom and doom. I think about the 60-40 on Sebastian Page's allocation committee, and basically the bond people are on one side, the equity people are on the other side, and there's sort of a cloud hanging over bond people, and equities are like,
Without a doubt, you are a Bond person. Anastasia Amoroso of iCapital. Anastasia, thank you. Appreciate it. Let's give you an update on news elsewhere with your top stories in your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of American Air down some 8% in the pre-market after reporting a short while ago. They beat on second quarter earnings, but they did slash their guidance for the full year. It originally saw adjusted EPS coming in at $2.25 to $3.25 for the year, but it's lowered that to just 70 cents to $1.30. The airline saying that they, quote, did not perform to initial expectations due to their prior sales and distribution strategy and an imbalance of domestic supply and demand. Shares of Universal Music Group also plunging in the Amsterdam trade, down 25%, the biggest drop since their IPO. The world's biggest record label, which represents Taylor Swift and Drake, reported subscription and streaming revenue that fell short of analyst estimates. It was a slowdown in streaming platforms in adding new subscribers that ultimately hit revenue. Meanwhile, a dispute with TikTok and licensing changes for Meta also hurt them in the quarter. The NBA has announced new long-term contracts for TV with Walt Disney, Comcast, and Amazon, spurring long-standing partner Warner Brothers. The league rejected Warner's bid to match Amazon's offer of about $1.8 billion a year, setting up a potential legal battle. The new agreements are set to generate $76 billion in fees over the next 11 years. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, automakers under pressure.
We're working on reducing our costs intensely. It's an incredible focus by the team. Really, it's quality and cost reductions. That's our opportunity in the near term to really improve the business. We're going to look to, accelerate that progress.
That's the view from Ford, the view from Stellantis. Up next.
On the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Wednesday, the Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
I do love a Lisa promo. Just some of the best. Look out for the Federal Reserve.
Haywire.
Sort of a long list of things there, Lisa.
I need to really kind of sit back.
Don't sit back. We love it. Equity futures on the S&P pulling back just 0.1%. Under surveillance this morning, automakers under pressure.
We're working on reducing our costs intensely. It's an incredible focus by the team. Really, it's quality and cost reductions. That's our opportunity in the near term to really improve the business. The team's focused on it. There will be additional cost reductions. We're on track to take $2 billion in material cost out, manufacturing costs, freight costs, and we're going to look to, accelerate that progress.
Here's the latest this morning. Auto earnings reflecting some big challenges for the industry, with Ford and Stellantis delivering disappointing results. Stellantis opting to bring back old models and weighing price cuts after a massive drop in sales during the first half of the year. Joining us now to discuss, the Stellantis CEO, Carlos Tavares. Carlos, great to catch up with you, sir. Difficult morning for the stock. We're down about 8%. You know that. I want to talk about some of the brands. I'm not sure how many people recognize or realize how big this company is. So just give me a couple of seconds to go through this. At the premium end, you've got the luxury brand like Maserati. Then you've got Alfa Romeo Lancia. You've got Jeep, which of course is well known here in the United States, Chrysler, Dodge, Ram. Over in Europe, Citroën, Fiat, Opel, Peugeot, Abarth, which of course Abarth is part of the Fiat business. This goes on and on and on. And I'm trying to work out this morning, Carlos, whether you're committed to all of that lineup, those brands, or whether some of them could be cut and spun off.
Well, there is, first of all, you are right to say that the automakers are under pressure. The auto industry is in a turmoil, and as you are looking at the results, everybody is going in the same direction. And for the time being, as much as I am aware of, we are the only guy in town with a double-digit AOI margin. But you are right, we are under pressure. And to your question about the brands, there is no taboo. There is absolutely no taboo. The brands are intangible assets that we respect. We believe that they are here to be leveraged. We could celebrate this year the 125th anniversary of Fiat and Opel, which demonstrates that the brands are stronger than the legal entities, stronger than the political regimes, and they can cross wars, survive, and get better. So we do respect the brands. We respect the fan bases of the brands, but there is no taboo. If they are not able to monetize the value that they represent, then decisions will come. For the time being, all of our brands, with no exception, are profitable. It is not by chance that we are a 10% AOI margin car company, the only one to be double digits so far. It is just because our brands are great. Our products are very appealing, and I will just use the example of our Ram pickup trucks, where we were again number one in the GD Power quality survey, which means that our customers appreciate what our creative people are bringing to the market. Now, it is true that the market is in a turmoil. It is true that the transition that we are going through is immensely challenging, and this is a bump. There will be other bumps. This will last for a few years. This is not a short-term turmoil. And the most resilient, the most focused, the most customer-focused will survive, of course. And that also means, because that's what I'm hearing, that cost reduction is not becoming a taboo anymore. As you know, we have been working hard on cost reduction for many years. We have not been so popular, but now everybody recognizes that the customers want affordability. The customers want a safe, clean, and affordable mobility. So that's my comment to your great question. Thank you.
There's one question about cutting the cost of the vehicle. There's another question about cutting costs internally to offset some of the increased expenses. Shipments in North America fell 18% in the last quarter, and I'm just wondering whether some deeper cost cutting, to John's point, is required to sort of bring that up to speed at a time where the EV transition isn't happening as quickly as people had planned for.
Exactly. And what you are saying, you say is not happening as quickly as the people had planned for. I would like, with all the respect, to correct that. It is not happening as quickly as the political leadership had expected. What we are seeing in the Western world right now is that the consumers are not supporting as much as the political leadership was expecting the EV ramp up. And the consumers, they are very clear in what they expect from us. They expect safe, clean, and affordable mobility. And safe and clean they are, affordable is the challenge. So they want basically to buy EV cars at the price of internal combustion engine cars. They don't want to pay more for the EV technology, which I can totally understand. And I want to tell them that we are working super hard to achieve that. And we already have evidence that we are succeeding because we started to launch our first B segment EV cars from 20,000 euros, a little bit more than $20,000. And we will bring to the US market in a couple of years a Jeep model below $25,000. So yes, we hear what they say, and we are working super hard to deliver that. And indeed, the political leadership through the regulations thought that the consumers were able and willing to pay a higher price for EVs. And they are telling us, the consumers, that they don't agree with that. And we are in the middle. We are the fuse between the consumers and the regulators. We are trying to fix it. And of course, it's difficult. It's difficult,
Carlos,
it's painful.
In January, you said you were going to hold off on some of your investment in the United States because you wanted to see how the election played out. But are you basically saying now it doesn't matter who gets elected because the consumers are rejecting the government push towards the EV models?
Well, that's not exactly what I am saying. It's a little bit more complicated than that. What I'm saying is that we have received loud and clear the message of affordability that the consumer is asking us to deliver on EVs. The sooner we get there, the faster we are going to ramp up. And the investments in EV technology are already done. What needs to be done now is the investments in the capacity for the volumes. So the investments in the capacity will be staged in function of the adoption by the consumers, and the adoption by the consumers is going to be function of our ability to bring affordable vehicles to the market, which we are right now doing. And I think it's going to have a few bumps on the road. That's nothing specific or nothing surprising. It is going to be a bumpy road, and we will adapt the capacity investments to the adoption rate of the consumers, which is going to be the consequence of affordability. That's where we are.
Yeah.
And we are bringing a lot of proof points that we are achieving that, starting with the European market right now, but it will come very soon with the US.
Carlos, how difficult is it to compete right now with Chinese auto manufacturers who really have a leg up in providing affordable electric vehicles and are able to export some of those to Europe? Right now, there are gates in the US. Are those gates positive or negative for you at a time when you're a global car business?
Well, that's a great question. As we are a global car maker, and it was pointed out that we had a 14 plus one brand. The plus one is a Chinese brand, Leapmotor. So yes, we have 15 brands, and we are a global car maker. So as a racing team we need to recognize that being global means that we will not be protected everywhere. For instance, we are not protected in Latin America. We are not protected in Africa, Middle East. So as a racing team we need to confront ourselves with the harshest competition. Right now, the harshest competition is China, and they have a 30% cost competitive edge against us, ex-workspaces. And we are working hard to recover those 30% cost competitive handicap that we have. And it's good for a company like ours to be competing with the harshest competition. That keeps us awake, that keeps us alive, and we need to run fast and even faster to compete. Then when we come to protected markets, we have to realize that there are a lot of side effects and collateral damages to protected markets. And that protection that may be nice in the short term may have enormous disadvantages in the mid and long term. And that's why we do not advocate custom duties. We have to fight against the best. We have to make ourselves better in quality, in appeal, in cost. This is the way we can survive. And we used to say at Stellantis The only thing that protects us is performance, and we deeply believe in that.
If that's the case, does that make it harder to keep a production base in places like Italy?
It makes it harder in the Western world, indeed. But in the Western world, we have more knowledge, more experience. We should use our education, our scientific education, our capability to work collectively to find paradigm breakers to compete. It is possible. The 23,000 euro mid-trim EC3 Citroën is made in Europe. Of course, in the lowest cost countries of Europe, but it's made in Europe. It's made inside of Europe.
As you know, sir, the reason I ask is because there are some Chinese producers looking for a manufacturing base in Italy. You, of course, have some production bases there. I wonder if you'd be interested in selling them.
Well, it's a public information that all the European governments are dating the Chinese car makers to come to assemble their vehicles in their countries. So all the European countries, Italy, France, Germany, Spain, they are all dating the Chinese. Fine, so that's a fact. So if you were to ask me, which is possibly your question, would I be willing to sell one of my plants to the Chinese? I would ask you back a question. What is the intention of the European Union if we are encouraged to sell our plants to the Chinese? What will be the sense and the purpose of inviting the automakers of Europe, which represent 14 million jobs, to hand over their plants to the Chinese? Does that make sense for the European citizen? Of course, it doesn't make any sense, which of course we know. So, of course, all business is business. We'll see what the future will bring, but we are here for the fight. We are here to demonstrate that we have more appealing brands, more exciting cars at the right level of affordability, with the right performance and the right safety. So we are going to fight. This is a competition. We love competition. And everything we do for Europe, because the market is much more open than US market, in terms of competitiveness of our technology, will benefit our American brands, because Stellantis is a global car maker and the technology is available for the 15 brands of the company. Anything we do to compete with the Chinese in Europe or in the rest of the world will benefit, of course, our US brands to bring affordability and performance as soon as we can to this market.
Carlos, you've been super generous with your time. I just want to return to my original question, though. The way you posed your response to that, the conversation that I would have with a policymaker for the good of the European economy and for the good of European labour is a very different one to the CEO of an auto manufacturer. You, of course, are accountable to the shareholder, and the stock is down by 9%, as you know, today. This is a difficult day for Stellantis. So when I ask you a question like, would you sell a production base in Italy to the Chinese? I'm not asking you that as a public official who needs to worry about the size of the European labour market. I'm asking you that as a CEO of Stellantis. Is that a good financial decision for you to make?
It depends if I am making profit out of that facility or not.
Well, you're under capacity there, aren't you?
I will make sure that we keep the capacity above 80% utilization rate. That's the threshold. As long as you are above 80%, you can do a good job.
And you're confident you will be for the next 12 months and beyond?
This is one of the things we have been discussing with the Italian government. They keep on asking us to have a 1 million car production, and I keep on answering that I need 1 million customers. The point is not about the production, the point is about the customers. Now, it is quite clear that if you have 1 million customers out there, and you have to break down the 1 million customers among a certain number of car makers, if you increase the number of car makers competing for the same 1 million customers, it is easy to understand that there will be less cars to be produced. And that is going to open the road to a new context. And in the new context, we'll see what are the decisions we need to make. But at the end of the day, it all boils down to something we know very well in the US. Make the customer happy, period. It starts there. Good quality, good appeal, good affordability, and then you will capture the share of the market that you deserve. And if you don't compete with the harshest competition, then forget it. On the long run, you are going to disappear. There is no other way than to compete with the harshest competition at any point in time.
Carlos, I can tell you this, I'd be very happy if there was a Maserati on my drive, okay? We can leave it there. Carlos, thank you, sir. Appreciate your time. I could talk all day with you. Appreciate it. Carlos Tavares there, the Stellantis CEO. Just a wide-ranging conversation about how difficult it is for an auto manufacturer right now, a global one, when you've got to deal with the politics, the politicians who are looking for one thing, and you've got to deal with the economic reality of where the consumer is at the moment. The tension, the push and pull there, you can feel it. I think Carlos did a wonderful job of really laying that out for us in a very honest, transparent way of how difficult things are right now.
Especially given the fact that he said that Chinese auto manufacturers have a 30% advantage on them when it comes to a cost base of production at a time when a lot of government leaders are trying to figure out how to get around this. His response is the levies, the charges that people are talking about, the gates are not helpful and have corollary side effects that people will not like.
He's climbing two different hills at the same time. One, China, the other, internal politics, whether it's Western Europe, whether it's the United States, this political hope of this EV transition happening quicker than it currently is. And the consumers, he said it right there, are rejecting it. They're rejecting it at the moment.
If you are just joining us, welcome to the programme. Got some things to get through, so let's start with the price action. Equity futures on the S&P, negative here by about 0.1%. Bit of a pullback again on the NASDAQ. In the bond market, this big rally that started to emerge at the front end of the curve, it continues. And it continues through the curve. We're down 6 or 7 basis points on twos to 436.47. Down about 6 on a 10-year to about 422. The curve just a little bit steeper. The difference, the distance between a 2-year and a 10-year right now, about 14 basis points. In foreign exchange, all eyes on the Japanese yen. 4 consecutive days of yen strength. The longest such streak going back to March. Dollar yen at the moment, 152.39. Under surveillance this morning, some top stories for you. Israel's Prime Minister Benjamin Netanyahu making his pitch to Congress, defending Israel's war against Hamas and calling on the United States to fast-track military aid. He's set to meet with President Biden and Vice President Kamala Harris later on today. The share of U.S. credit card balances past due reaching a series high in a Philadelphia Fed gauge dating back to 2012. Lisa, you mentioned this earlier. 2.6% of balances were 60 days past due in the first quarter. That's up from a low of 1.1% back in 2021.
The problem with sort of extrapolating out too much from this data is just that it's still pretty low at 2.6%. That said, the trend is remarkable. And the fact that we haven't seen this type of trend is something a lot of people are taking note of. It's the reason why jobless claims today at about an hour time are going to be so crucial in tomorrow personal income and spending, also really setting a tone.
Let's go through that list of data that we get in about 60 minutes. So jobless claims one, US GDP another, durable goods data all due in about less than an hour from now. Gurpreet Garrawal of Goldman Sachs writing this in her Q3 fixed income outlook. While we recognise sound economic and corporate fundamentals, we remain vigilant due to stretch valuations and political uncertainties. Gurpreet joins us now for more. Gurpreet, thanks for your patience and thank you for being with us. I want to go straight to this slowdown that we're starting to see emerge, just a sign of it in some of the earnings and some of the pushback we've heard from a former Goldman Sachs colleague, Bill Dudley, of course, former New York Fed president as well, who's come out in the last 24 hours and says the Fed needs to get a move on, that we risk a recession here if they don't cut interest rates. What's your stance on that? How are you and the team thinking about the balance of risks around the Fed's timing of its next move?
Hi, Jonathan. First of all, great to be with you. Look, I would say, we agree the Fed is data dependent, and if that is the case, the data right now does seem supportive of a rate cut. You've had inflation cool down, the disinflation has resumed after a setback earlier in the year. We're seeing a cool down in the labor market. It's not necessarily collapsing. You've seen relatively resilient spending, retail sales and industrial and production data recently surprised to the upside. But on the whole, the data does appear consistent with normalization and pulling back that restrictive policy. Also, if you look at Taylor rule formulations based on the output gap and inflation, they also suggest the Fed should have cut by now. But of course, this is not a textbook economy. What may make sense in theory may not actually be delivered in practice. And our base case assumption is that the Fed is probably going to wait until the September meeting, not next week, to deliver the first cut in this cycle. And, one of the reasons for that is, first of all, they just want to accumulate more confidence in this disinflation path. The second is, at that point in time, they will unveil updated statement of economic projections, the updated dot plot. Back in June, those projections showed PCE inflation, core PCE inflation, higher than where it is at the moment. We have the latest data coming out tomorrow. Also showed only one cut projected on median relative to 3 back in March. And so if they're able to unveil updated economic projections and then explain the start of this gradual easing process, we think that's what would be their preferred choice.
Gurpreet, I hear a lot of words. Normalization. I hear about the idea of adjusting restrictive policy. I'm not hearing recession. I'm not hearing anything that suggests that this is going to be just a period of time in a very dramatic downturn in the U.S. economy or the labor market or anything else. How do you decide when the market's gotten ahead of itself in pricing in rate cuts, not just this year, but also next?
Yeah, I think on your first point, the data right now does seem consistent with an adjustment cutting cycle. It's not as if the central bank is needing to cut because you're seeing a sudden slowdown in hiring or sudden uptick in layoffs. You're seeing that gradual cooling. Now, I would caution, our colleagues in Goldman Sachs Investment Research have also highlighted this, that the labor market is rebalanced back to where it was pre-pandemic. And so any weakening from here warrants close attention. But Chair Powell has also told us this. They have noted that the balance of risks to both sides of the mandate are in close focus. I would say right now, what we think is interesting is that you are going to have this gradual easing cycle that is beneficial for fixed income investors. Fixed income yields are going to start to look attractive relative to what you earn on cash. And so that's going to be very supportive for fixed income. I think to your point about what does it mean from here on out, there's a lot of uncertainty for the path in 2025, but I think there's definitely interesting opportunities opening up in the global opportunity set for interest rates, because whilst the response to the pandemic and then the response to the inflation driven by the pandemic and energy shock was largely synchronized, there is no one-size-fits-all approach to these easing cycles, and that's creating interesting opportunities.
Gurpreet, let's develop that idea, because there is this feeling typically that when a central bank cuts rates, it's a good time to go into those debt markets because essentially they're supporting them. So are you going into Chinese bonds? It doesn't seem like people were that enthusiastic with the rate cut over there.
Yeah, look, we look at EM and DM space very differently. I think globally, this concept of focusing on country-specific factors is what is going to drive the opportunity set. In China, you have a different macro regime. You're trying to address structural issues. I think in the EM space, the opportunities are actually more in markets where we have more confidence that the central bank is easing in response to improved inflation progress. And so, you know, Hungary is one space. We saw a cut this year and other areas as well. And I think in the developed market space, there's greater opportunities in places like Canada. We saw the Bank of Canada become the first developed market central bank this week to deliver consecutive rate cuts. But there's also central banks on the other side of the spectrum in the developed market space. Bank of Japan, steady normalization. Reserve Bank of Australia, unlikely to cut anytime soon. So definitely an interesting global opportunity set, both in DM and EM, and it's driven by country-specific factors.
You say in the coming months you want to reinforce the importance of diversification to mitigate risks. What else could you do in that space to diversify?
Yeah, look, that's a great question. One of the things that we highlighted in the outlook is that you do have strong fundamentals. The economy is still relatively resilient. We're focused on what the picture is of corporate balance sheets as a result of the latest earnings seasons. But of course, you have tight valuations, you have policy uncertainty. And so alongside diversified exposures, be that your rates exposures within credit sectors, other strategies to boost portfolio resilience can include being overweight the US dollar, tends to be a beneficiary when you have these risk-off periods. Another potential option is to utilize currency options. That's a cost-effective way to position for a potential pickup in currency volatility around any associated policy uncertainty. And so, you know, diversification, active security selection, plus those strategies to boost portfolio resilience are all the best way for our clients' portfolios to be resilient to this uncertain environment.
Gurpreet, super smart. It's fantastic to get you on the programme. Let's do it again soon. Gurpreet Garawal there of Goldman Sachs on the latest in the fixed income market. High yield spread still in and around 300 basis points. That's super, super tight. Max Kettner of HSBC made that point on this programme earlier on this morning. We were talking about big unwind you're seeing in stocks, big rallies you're seeing at the front end of the curve in the bond market, big rally you're seeing in the Japanese yen, stronger yen, and you're thinking about risk aversion. Not seeing spreads getting wider at all, are we?
You asked a question yesterday, and this to me is the key question. Is this predictive of strength, or is this basically an asset class that has lost its predictive ability with respect to a credit cycle and with respect to economic weakening? And I say this because private markets have offered this huge cushion so that what's left in public markets tends to be higher quality, and people are looking at the all-in yields in a way that is different and really changes the spread characterization going forward.
If you think about the conversations that you and I used to have together literally more than 10 years ago on Bloomberg TV, I'm aging us here, I'm sorry. We'd talk about how cyclical the index was, this big energy tilt. Do you remember that?
Yeah.
It's changed a lot in the last decade.
Yeah, it's actually shrunk dramatically. And think back to 2014, 2015, energy, shale, that was so stress tested that a lot of those names were kicked out, bankrupt, et cetera. The ones that survived were much stronger. The ones that have continued to be in that index tended to have been the survivors. And that is the reason why, yes, you are seeing a gapping out in the lowest quality of names. But other than that, you see some of the tightest spreads going back years.
Get told repeatedly all the time by a lot of people in this market, it's a high quality index. It's changed over the last few years. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's get across to Danny Berger. Hey, Danny.
Hey, John. IBM shares up more than 2% in the pre-market. It reported a jump in its bookings for its AI business. IBM says bookings for AI consulting and software since mid-2023 have now exceeded $2 billion. Second quarter sales increased 2%, almost $16 billion. That beat the average analyst estimate. Boeing has agreed to plead guilty to criminal conspiracy over 2 fatal crashes of its 737 MAX jetliner. Details of the plea deal were made public in a federal court filing yesterday. In that agreement, Boeing faces a fine of at least $243 million. It will serve 3 years on probation with an independent corporate monitor. Boeing will also spend at least $455 million to bolster its compliance and safety programs. The Justice Department said Boeing violated a deferred prosecution deal after the blowout aboard an Alaska Air 737 MAX 9 jet on January 5th. And it was a chaotic finish, to put it lightly, to the opening match of the Olympics men's soccer tournament. Down 2-1 to Morocco, Argentina appeared to score a dramatic equalizer in the 15th minute of injury time. Morocco fans then stormed the pitch to protest the goal, and the match appeared to end in a 2-2 draw. 90 minutes later, with the stadium empty, news broke that Argentina's goal had been ruled offsides. The players then returned to the pitch to play the final 3 minutes. Morocco held on to the 2-1 win. And that's your brief. John.
I think the New York Times called this a circus, and I think that's fair to say that's what it was. Danny, thank you. Up next, Trump versus Harris.
We have a new victim to defeat. Lion Kamala Harris. Lion, L-Y-I-N apostrophe.
These extremists want to take us back, but we are not going back. We are not going back.
From New York City, that's up next.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
Equity futures on the S&P 500 negative here by 0.2%. Rally in the bond market, yields lower by 6 basis points. 422, 32 on 10s. Under surveillance this morning on the politics, it's Trump versus Harris.
We have a new victim to defeat. Lion Kamala Harris. Lion, L-Y-I-N apostrophe. The most incompetent and far left vice president in American history.
I believe we face a choice between two different visions for our nation. One focused on the future, the other focused on the past. These extremists want to take us back, but we are not going back. We are not going back.
So here's the latest. Donald Trump ramping up his attacks on Kamala Harris, criticizing her record as San Francisco district attorney and her stance on abortion rights. Harris taking aim at Trump and the GOP's ties to Project 2025. Libby Cantrell of PIMCO saying this: while Trump remains favored to win at this point, his chances, as well as the odds of a Republican sweep in Congress, are now lower than they were just last week. We now view the election as more dynamic, with likely more twists ahead. Libby joins us for more. Libby, I can't imagine what those twists might be, so let's not even entertain that. I've got a poll in front of me. It's just dropped, so allow me to share it with you. It comes from Emerson College, and it reads as follows. It's on swing states. In Arizona, 49% support for Trump, 44% for Harris. Georgia, 48% support for Trump, 46% for Harris. In Michigan, 46% for Trump, 45% for Harris. Pennsylvania, 48% for Trump, 46% for Harris. Wisconsin, they are tied in Wisconsin at 47% support, Harris and Trump, respectively. When we start to get polls like that, more polls like that in the coming days and weeks, how much weight do you put on them in the early days and weeks of this contest?
Yeah, so I would say that not a lot right now. I think that the polls will be much more telling if, after the convention and then really in September. And this is what we have been telling clients even before all this drama, is that really wait until September, because that's when just statistically polling becomes more predictive. Obviously, polling's never going to be completely clairvoyant in terms of who actually shows up to vote, but it becomes more predictive as you get closer. So, and I say especially this because it is so dynamic, because she really is reintroducing herself to voters. That's good and that's bad. I mean, she has a very progressive record that she ran on in 2020 that she's going to have to sort of defend and clarify and what have you. But I wouldn't necessarily, I would take all of this polling with a big grain of salt. So really, after the convention, really wait until September. I always tell clients, like, have a cocktail, go to the beach, enjoy your vacation, and then come back to politics in September, because that's actually when I think it's really, what will be much more indicative.
It's hard to have a cocktail given the past few weeks that we've been dealing with in U.S. politics, but now there's a lot of emphasis on who she's going to pick as her running mate. Who do you think is best for her? Not just to support her and expand her views, because you say she is very progressive, but also the math when it comes to Electoral College.
Yeah, and so, I mean, is she very progressive? We don't know. I mean, just to clarify, I mean, she ran on a very progressive platform when she was running the Democratic primary. Yeah, yes, no, and again, she was running for national office even when she was in the Senate. So for sure, she has a progressive record. I think that's the thing, though, it's unknown about her, is where does she stand on many of these issues? But you're absolutely right. Her running mate is going to be a really, really important, both because it is sort of the first public decision that she is going to make, and oftentimes, you know, picking your running mate is really a reflection of the top of the ticket's judgment, but also, as you talk about, is really the Electoral College strategy. Arizona, as John just said, I mean, she's lagging in Arizona. Mark Kelly, the senator from Arizona, who's more moderate, particularly on border issues, that's going to be a big liability for her, but also could help shore up support in Arizona. And then Pennsylvania, I mean, of all those 6 states that you just mentioned, Pennsylvania is going to be the most critical state for if Democrats are going to win. They have to win Pennsylvania, and it's necessary, but it's, you know, necessary but not sufficient. I mean, they will have to win other states as well. But if they lose Pennsylvania, Democrats have lost this race. So Josh Shapiro, the popular governor, who also has a more moderate stance on things like fracking,
which she had said she was going to ban. So
yes, no, exactly. And she says, she's talked about Medicare for all. She's talking about defunding the police. She's talking about banning fracking. I mean, again, she has a a platform that will be untenable for her to run on and win. And that's why I think she will need to start clarifying much of that. Now, the other challenge is that she's vice president and current sitting vice president, and she can't necessarily distance herself so much from Biden as well. So she has a lot of challenges, a lot of twists and turns ahead in terms of really navigating like the policy front.
You said the top of the ticket is the judgment of the candidate. What does that say about Trump and his pick of J.D. Vance?
Yeah, well, as we were just talking about, I mean, this decision to pick J.D. Vance was really a moment in time, right? It was on the heels of the assassination attempt. It was when Biden was still in the race. It was when folks had odds of Trump winning at 75, 80%. Republican sweep looked more likely than not. And so he wasn't necessarily as concerned about expanding his voter base. He wasn't as concerned about it as being tight as it might end up being. So, we'll see whether he, how he feels about that J.D. Vance, but it is much more a doubling down on kind of MAGA and on Trumpism than, say, a Doug Burgum or even a Marco Rubio or certainly a Nikki Haley, some of the other folks who were in the mix.
So you note that Michelle Obama is still not going to be the nominee for
I
Democrats?
saw that in the notes.
Okay.
So sorry to bring it to you.
Hold on a second. Well, but
I
hold on a
wondered
second.
who that was for.
Okay, evidently that was for us. But I'm not going to ask you about Michelle Obama. I don't think that I was the genesis of that. I do want to ask you, though, about the tenor of the discussions that you've been having with clients overseas, outside of the U.S., how they're viewing this, how that affects their investment decisions, what questions they're asking to understand the potential ramifications of this.
Yeah, so actually, I'm still getting questions about Michelle Obama from our Asian clients and about Jamie Dimon. So, hope springs eternal, I guess. So I would say they're sort of in two lanes. One is around fiscal, and of course, a lot of our clients overseas have a lot of dollar and a lot of treasuries exposure. So just trying to navigate that. And I think as we've talked about, really the punchline here is that the deficit is the biggest loser in November. So regardless of who wins, the deficit will remain high. And not only because there might be new spending and there might be more tax cuts, although I think that's going to be difficult just given where deficits are right now, but mostly because, as we've talked about, there won't be entitlement reform. And that's what you really need in order to, to consolidate sort of the budget and what have you. And the other concern they have is, of course, around geopolitics. And interestingly, mixed views here, because I think a lot of folks in Asia think that, well, at least President Trump, we can negotiate with him, whereas maybe a Biden or Harris may have more of an ideological view. So I'm not sure that's right. I mean, again, I think the direction of travel here around tariffs, around export controls, around even capital flows, around scrutiny around how U.S. investors invest in China is going to be sort of pervasive regardless of who wins. So in some ways, my view is there may be fewer distinctions than folks think, but that's really where our clients are focused.
The message from PIMCO: get a cocktail, enjoy the beach.
Yes,
sort of reconvene in
that's what
September.
she tried last week. How'd that work out?
Yeah, I mean, not well, I will tell you. Yes, this is what I'm trying to do. It's sort of self-soothing, but it's not really working out very well.
Thank you. I like that advice.
Libby, it's good to see you. Thank you.
Thanks.
Libby Cantrell of PIMCO on the latest. Coming up in the next hour on Bloomberg Surveillance, we'll catch up with Cameron Dawson of New Edge Wealth. We'll speak to the former New York Fed President, Bill Dudley. Bill, in the headlines in a big way in the last 24 hours with a big call to cut interest rates this month. Bill's just around the corner, as is Michelle Girard of NatWest Markets and Gennady Goldberg of TD Securities. Your equity market on the S&P 500 slightly softer. Been a difficult week from New York. This is Bloomberg.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg Power Players is back this September. As the top names in tennis take the court over in Queens, we are convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at BloombergLive.com/powerplayers.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
We're at a point right now where I think we can all agree the economy is slowing.
There's some evidence that some of that slowing in the macro data is starting to feed through to corporate earnings, and that creates a less constructive backdrop for stocks.
Policy rates today are restrictive. Why not have less restrictive policy?
To the market, what's going to matter most on all of these things is clarity. So long as there's clarity, the business environment will be able to handle it.
I got to say, we've never had this intensity of debates between bulls and bears.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
What a 24 hours it's been in this market, and it continues. So let's pick up on some of the price action for you and start in the equity market. Futures negative here by 0.25% on the S&P, following the biggest one-day loss going back to 2022. Likewise on the NASDAQ 100, down by about 1/3%. Just a little bit of weakness, nothing too dramatic. In the last 24 hours, though, big rally at the front end of the yield curve. The 2-year yields lower again this morning. So let's talk about the why. We could talk about the data. It drops in about 29 minutes. I think we need to talk about the commentary coming from a former Fed official, former New York Fed President Bill Dudley, who says he's changed his mind. They need to reduce interest rates this month. Bill joins us in about 15 minutes' time. Do not miss that conversation. And it's hot on the heels of a conversation we've had with Mohamed Al-Erin a few times on this program, that he thinks they need to make a move in July. This is what Mohamed has to say on Bloomberg Opinion today. Failing to ease policy in either July or September, an outcome that unfortunately can't be ruled out, would constitute another policy mistake for a Fed seeking to restore its credibility after fumbling the initial response, Lisa, to building price pressures back in 21.
The fundamental question right now underpinning some of the commentary as well as the action that we're seeing in markets is how much of this is fundamental, how much is this true weakening that goes beyond just a normalization in the economy versus positioning reset versus technical versus a market that has seen its longest streak of wins going back years and up for 28 weeks of 38, which is something that hasn't been exceeded since 1989. This is a tension point at a time we don't have a clear view of how quickly the labor market is weakening.
That Dudley commentary, though, being picked up. Andrew Hollenhorst this morning. Fed focus has returned to the labor market, reflected in the Dudley opinion piece, who we'll be speaking to, and the Fed should cut rates next week. Jobless claims in focus this morning, but it may take until August to confirm a concerning trend versus a seasonal fluctuation. That's really a debate.
Far more interested in claims in about 28 minutes than I am GDP. I think Andrew Hollenhorst of Citi speaks to that. To your point on the price action, we can do this cross-asset, we can do individual names. Cross-asset, we've described this a few times as just a massive unwind of consensus positions that you see in equities, you see in bonds, you see in foreign exchange. Everyone short the Japanese yen, all of a sudden things whip in the other direction. Dollar yen negative for 4 consecutive sessions. But within stocks, there are these company stories that start to add up. Just the consumer starting to push back. We saw it with Delta. We saw it with United. American has been a messy, messy story of execution misses over the last 12 months or so. But American again this morning, American Airlines having a difficult time. That's the airlines. Look at the auto manufacturers. The consumer's in one place, their production's in another. Ford's a big struggle. Stellantis is a big struggle. It's industry after industry in the last couple of days.
Where basically they can't raise prices as quickly as their input prices are rising. We heard that also from Nestle. This is a global story of margin compression and, frankly, consumers pushing back. This is the reason why not only today's jobless claims, but tomorrow's consumer spending numbers that we get will be important to give a sense of just how persistent this will be. Given the fact that some of these airlines, and I'm thinking of American in particular, is down already 26% so far this year. The fact that it's down another 6.3% as it ratchets back its profit forecast for this year shows maybe people aren't really pricing in a low enough bar for some of these consumer-facing companies.
It's a bad time to report bad news, that's for sure. Then we said that earlier this morning. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth as the S&P 500 sees its worst day since December 2022. We'll speak to the former New York Fed President Bill Dudley on his call for an immediate rate cut, and Michelle Girard of NatWest reacting to GDP data and jobless claims, which drop in about 25 minutes' time. We begin with our top story, the AI frenzy losing some steam. A global tech sell-off pushing the S&P 500 lower as investors reassess the AI trade. Cameron Dawson of New Edge Wealth saying there's still time for a turnaround. Writing this, is tech dead? No, but it needed this breather. Tech went parabolic and got aggressively overbought at the beginning of last year. Tech can correct, support, and will remain and still remain in an uptrade. Cameron joins us now for more. Cameron, good to see you.
Good to see you.
What is this that we're seeing? Every single guest we've started the hour with, we've asked the same question. I'd like your opinion to the same question. Is this a rotation, a broadening out? Is this an unwind of consensus trades? Is it a growth scare that's starting to emerge? How would you describe what we've seen?
I think that there is a very much a technical aspect. We got incredibly overbought, mostly in tech and growth. And I think the important point is the last 3 months of that move really didn't have anything to do with earnings moving higher. It was all valuation. So it was sitting on really fragile ground. You saw positioning get really one-sided. Everybody moved to the same side of the boat, whether we're looking at things like CTAs in the 99th percentile, households being just 1 percentage point away from peak positioning. So you had this setup for very high expectations, stretch valuation, stretch positioning, and this is just a digestion of that. The question is, do we have an earnings deterioration because of what we're seeing in inflation data, because of what we're seeing in growth data? If we see that, this is more protracted and it's deeper. If not, this is just short, shallow like we've seen over the last year.
Next week, Amazon, Microsoft, Meta, Apple. How low is the bar or high for them going into next week, given all of this?
I think based on valuations and positioning, the bar is very high. And we can see that throughout this earnings season, which is that there is absolutely zero tolerance for anything that even smells of weakness because positioning is so stretched. Now, this is good to take the air out of some of these areas simply because it allows you to potentially, over the medium term, extend the rally. We went truly parabolic in growth versus value in June and the beginning of July. It was going to end, and so this is good good and healthy to shake out weak hands.
That said, it's one thing to look at specific companies and understand whether they're facing a good profit outlook or not. It's another thing to extrapolate it a larger macroeconomic story, and you kind of can't avoid it when you hear the same thing from company after company about pricing pressure and consumers pushing back. How much of a normalization versus a true weakening is this?
I think it's so important because the deterioration in CPI, or the falling in CPI, which is good for the Fed, actually makes 2025 earnings estimates less likely. The lower inflation is, the less margin expansion and the less top line expansion we're going to get. We are hearing across the board that companies are having issues with pricing power. They are not able to pass on input cost increases to their end customer. This is very different than 2020 and 21. We saw input cost increases, but you were able to push that onto your end customer in a blink of an eye. Customers are now pushing back, which just means that that $277 a share that is now forecasted for 2025 earnings, we think is far too high.
Given that, are people conflating the idea of earnings coming under pressure, margins coming under pressure, with an economy that's truly rolling over?
I think that is the key distinction, which is that it's deceleration, not necessarily falling off a cliff. And we see that in the labor market as well. You're seeing these signs of fraying, but you're not seeing an outright surge in the unemployment rate higher. You're still hearing talk of labor hoarding from the likes of the NFIB, the Conference Board. People are still saying that they're having trouble finding workers, which would suggest that you're still in this normalization, not necessarily outright weakness. It's slower growth, but not necessarily growth that's falling off a cliff. The challenge is, how does that compare with consensus? Because consensus is still expecting really robust growth, acceleration in top line growth next year. I think that's where the two come to meet heads.
You also have an election call. What's your biggest probability you're watching that could be the biggest cause of concern for 2025?
I think it's about sweeps. It's if you see the probability of a sweep, whether it goes Republican or Democrat, and we know that we're seeing these probabilities of who gets elected start to swing around pretty materially. But I think the sweeps is what the market is going to be the most concerned about, because it would allow the most extreme portions of policy agendas to get pushed through. So those are the parts of the policy that could be the most inflationary or possibly be the most exacerbating of high deficits. So if you see stalemate, then I think that's the outcome that the market breathes the most sigh of relief.
And how do you prepare for that? Or you can't until November 6th?
It is hard to prepare, because what we tend to see going into elections is you pull forward a lot of performance. You have this expectation that certain areas will benefit. It doesn't necessarily translate into earnings, meaning that you can see run-ups in different baskets of stocks prior to the election, and then it becomes a sell the rumor, buy the news kind of situation.
Let's put a bow on it. You said the uptrend can remain intact. What gives you that confidence?
Well, we still have room to pull back to trend. We still see overall that the economy isn't falling off a cliff. We reserve the right to change our mind. The market is not oversold yet, and I think that's an important point here, is we think that this correction continues. You can measure it by looking at the RSI. We're not externally oversold. Internally, look at the percentage of names above the 50-day moving average. It's still at 58% for the S&P 500. That usually goes down below 20% in a true durable low. We think that there is more chop to come, but you are still in a medium-term uptrend that remains resilient. You were back in October of last year. You were back earlier this year when we had corrections. So seeing that medium-term, long-term view remains very important.
Futures negative by 0.2. Cameron, appreciate it. It's good to see you. Thank you. Cameron Dawson there of New Edge Wealth. This note just dropped. It comes from Baird. Apple price target raised over at Baird. New price target 240 was 200. Here's the quote. We believe Apple Intelligence could provide a much needed upgrade catalyst, boosting revenue and EPS growth meaningfully. Apple also had a difficult session yesterday, Lisa. There's some pushback from the south side. An upgrade.
Here's the real ultimate question, and that's why our conversation with Valdemar earlier this morning, Valdemar, was so interesting, of KKR, which is it's a matter of timing. How quickly some of this AI technology and sort of other types of technological advancements can become profitable. And a lot of people are doubling down and saying this is a bigger revolution than the internet was.
I'll let you know the big tell. It's when I upgrade. You know, get in the itch a little bit.
You're the bellwether.
Without a doubt. If it happens in September, this note is about people like me. who've got iPhones that are years and years old and have just sat on them and
You're the
haven't
main
upgraded.
character.
Let's
Absolutely.
see if it I'm always the main
I know. Well, can you then you need to come in and say, I'm going to upgrade.
Aren't you the main character in your story? Isn't that what life's about, Bramo?
Absolutely.
Let's get you an update on stories elsewhere. With your Bloomberg Brief, the main character of this show, it's Danny Berger. Hey, Danny.
Hey, John, thank you for that. Southwest Airlines reporting a better than expected second quarter profit, seeing a boost for summer travel. Shares still down 4 1/3%, though. The airline is also introducing a change to one of its defining passenger experiences. Seats will now be assigned as the company ditches its free for all policy that's been in place for decades. The change comes after it was under pressure from activist investor Elliott Management, which says the airline has failed to modernize its business to appeal to customer demands. For the first time in 4 years, Royal Caribbean Cruises is reinstating its dividend. It's the first cruise operator to do so since COVID ground the industry to a halt. Now, record demand is putting it on firmer footing. Royal Caribbean will pay out a quarterly dividend of 40 cents per share. Meanwhile, robust growth means it's reached its financial targets 18 months ahead of time. And Gen Z is showing its support for Kamala Harris. Vote.org reported that nearly 40,000 people registered to vote in the 48 hours after President Biden dropped his re-election bid. 83% of new voter registrations were for people between 18 to 34 years old. It's the largest number of registrations in a 48-hour period this election cycle. And that's your Bloomberg Brief. Back to the real main character.
Hardly. Danny, thank you. Everyone's a main character. Isn't that a Joe Rogan line? I think that's a Joe Rogan line.
I have no idea. All I know is
what would the main character do?
All I know is that this is sort of disclosing too much, but at home I was having a discussion with my son, and he said to me, oh yeah, you're the main character.
Is that where that comes from? I'm pretty sure that's a Joe Rogan thing. It talks about, like, if you were the superhero, what would that person do?
Everybody
like
should be.
In the movie,
but everybody should be in their own life. You know, that's an important thing. If you're not, I mean, who's going to be for you?
The problem is around this table, I think everyone just has main character energy.
Is that what's going on around here? This is a good time to go to break. Cameron wants to run. Up next, the morning calls. Plus, conversation you don't want to miss. Former New York Fed President Bill Dudley on his big call for why the Fed should cut right now. That's next.
Could face bigger challenges next.
It was going to keep winning World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equities on the S&P pulling back by 0.25% on the S&P 500. The rally in the bond market continues. We're down almost 8 basis points now on a 10-year to 420. 76. The rally at the front end continues as well on the 2-year. We're down about 6. The data drops in about 14 minutes. Let's get you some morning calls. First up, TD Cowen lowering its price target on Chipotle to 65, keeping a buy rating. The firm saying it appreciates management's attention to improving publicity regarding portion sizes through operational changes. The stock is up by a little more than 1%. Your second call from Barclays lowering its price target on Ford to 16, maintaining an overweight rating on the stock. The analyst noting the automaker's significant second quarter miss, which was disappointing versus elevated expectations. We're down there now 13%. And finally, Citi downgrading Lululemon to neutral with a $300 price target. The firm seeing slowing spending trends in the active apparel space, also noting likely promotional pressures in the second half. They're down about 3% in early trading. And looking ahead to next week, here's the big call of the last 24 hours. Former New York Fed President Bill Dudley saying this: officials must cut, and they must do it now. Dudley writing in Bloomberg Opinion the following: the facts have changed, so I've changed my mind. The Fed should cut, preferably at next week's policymaking meeting, although it might already be too late to fend off a recession by cutting interest rates. Dawdling now unnecessarily increases the risk. Bill joins us for more. Bill, wonderful to go on this kind of journey with interest rates with you, because I remember at the very start of the conversation coming out of the pandemic, you were one, together with the likes of Mohamed El-Erian and Larry Summers, warning that there were going to be inflation pressures and this Federal Reserve needs to hike. You've changed your mind, Bill, and in the piece, there are several points you've made as to why you've changed your mind. I want to pick up on what I think was the third one, the labour market. Bill, what's happening there that's guiding this call?
I think you can see the labor market is slowing, especially evident in the household employment survey, which is much weaker than what we've seen in terms of payroll employment. Over the last year, household employment's increased by less than 200,000. I think the labor market, and the second part of the labor market story is, of course, the rise in the unemployment rate. We were at 3.6% a year ago. Now we're at 4.1%. And these kind of rises in the unemployment rate are essentially warning signs. Every time the unemployment rate has gone up by more than 0.5% on a 3-month moving average basis, the U.S. has had a recession. This is the so-called SOM roll. Right now, on the SOM roll basis, smoothing it, 3-month moving average, 0.43% increase. So we're getting very, very close to triggering the SOM roll. You know, Chair Powell himself has pointed out the risks now are very much two-sided, not one-sided. Inflation is much more benign, 2.6% for the core PCE deflator year over year, and we're probably going to get another good reading on Friday. So I think it's time to start to focus on the risks of the economy, the risks of the labor market, to minimize the risk of recession, which always occurs when the unemployment rate goes up by more than 0.5% on a 3-month moving average basis.
Bill, let's talk about timing then. This was Chairman Powell in Sintra, Portugal, so not even a month ago. He said, we have the ability to take our time and get this right because the US economy is strong and the labour market is strong. Based on your piece, just on the timing, they might already be too late to fend off a recession. Why are they miscalculating how much time they have, in your opinion, even though they have acknowledged what's developing in the labour market?
Well, I think they put not very much weight on the SOM roll. SOM roll's perfect track record since World War II, 13-0. But their view is that the reason why the unemployment rate's going up is because labor force is growing rapidly. So that's not as disturbing as if the unemployment rate was going up because people are being laid off. The problem with that story is that in the 1970s, we had labor force growth that was also extremely rapid. SOM roll held. So I think you want to stick with the SOM roll until it's disproved.
That said, Claudia Sahm of the SOM roll has actually come on and said, people put too much emphasis on my SOM roll, and actually backed away from using that as one indicator to really end all be all. Is there anything other than that that creates new urgency for this sudden pivot, really a week before the Fed's meeting?
Well, you know, if the Fed doesn't cut in July and waits till September, it's not going to have a huge effect on the economy's trajectory, except the fact that when the unemployment rate starts to deteriorate, it seems to be a reinforcing negative feedback loop. Jobs are lost. People pull back on spending. That leads to further cuts in employment and investment. So the striking thing about the SOM roll is not just the 0.5% threshold, is the fact that every time you've gone through that threshold, the unemployment rate's gone up a lot. The smallest increase beyond, when you go beyond 0.5% is almost 2 percentage points. So that just tells you that once things start to unwind in a negative direction, it tends to keep going, and that's why, the risk here is significant.
Bill, your column got a lot of attention, and in large part because you are on the forefront, as John was mentioning, of this idea that the Fed would have to raise rates much beyond what people currently thought at the time, and that maybe even the neutral rate was going to be higher than what it was in the past. Based on the weakening that you've seen, are you rethinking that concept that inflation is going to be structurally higher and that the Fed's going to have a harder time combating it in the future?
Well, if the economy slows and the unemployment rate rises, then the downward pressures on inflation are going to persist. 2.6% is really not that far away from the Fed's 2% inflation objective. And in my mind, that difference is not sufficient to take a big risk of a recession. So I think it's time for the Fed to focus on the other side of its dual mandate, which is the employment side. Powell has talked about the fact that the Fed has two objectives, inflation and employment. And I just feel like the risks on the employment side are increasing to the point that you want to put more weight on that.
Bill, are there things you can say as a former Fed official that you can't say as a current Fed official? I'm just interested in the communication of this. You can speak your mind now freely with us. You can write the piece on Bloomberg Opinion. Can you imagine what the fallout would be if we had the current New York Fed president or the chairman of the Fed Reserve saying the things that you're saying right now at the July Fed meeting? Do you think they can even do that, even if they thought it?
Well, I think if Chair Powell was of the view that shared the same view as me, I think he would probably talk to the other officials and develop a consensus to move in July. I mean, I think one of the interesting sort of quandaries of the Fed is right now they've telegraphed it pretty clearly that they're going to move in September, and it sort of begs the question: if it's so obvious that you need to move in September, then what are you waiting for? Why not just move in July?
At this point, there are a lot of people who are associating political reasons for why someone might want to come out and say that now is the right time to cut. Since the data hasn't weakened that dramatically in the past couple of weeks, we have seen an ongoing deterioration that seems consistent with a normalization. Bill, how do you counter those accusations that this is being done ahead of an election, highly contested, where if the economy can keep doing okay, typically the incumbent or the incumbent party does better?
Well, I think my experience, and I think this is borne out by the Federal Open Market Committee transcripts over many, many years, is the Fed doesn't take politics in consideration at all in terms of this timing of monetary policy, rate increases or rate cuts. And I think that's the appropriate behavior by the Fed. They need to be independent. They shouldn't be taking the election cycle into consideration. And I don't think the Fed is doing that here. I think the reason why the Fed is delaying is I think they were surprised last year when they thought inflation was coming down, and it turned out we got a number of disappointing readings on inflation. I think they're also probably waiting because Powell probably wants to achieve a full consensus. I think he'd like to see a unanimous vote in favor of easing. And the hawks may be, there may be some people who are hawkish on the FOMC that are still a bit reluctant. I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting.
Hey, Bill, it's great to catch up with you, sir. Appreciate the insight. This piece yesterday on Bloomberg Opinion got a ton of attention. The former New York Fed president and Bloomberg Opinion columnist, Bill Dudley, there on his call to start cutting interest rates like yesterday, right now.
And he talked about the somber role. He talked about how it just the balance of the mandate just seems like the labor market should take on a greater degree. I just want to take it a step further, though, this idea that how much does the Fed not want to seem like they are perceived as being political? How much of a push that becomes for them not to cut rates, even if they feel like the economy might justify it?
They want this smooth glide path. They always do. They want this smooth communication. They don't want to rattle people with sudden turns and big decisions that seem to come out of nowhere. So they're setting us up for September. I think the risk here between now and September is a risk that Mohamed Al-Aaron has highlighted, that they've been so data point dependent, and this is the point that Neil Dutta made recently on this program, that it wouldn't take much to spook them. You get one hot CPI print and maybe they back away from September, and that's the ultimate risk here.
You get one bout of commodity inflation that causes a CPI print to look hot. All of a sudden, it's really difficult.
So the distance between a rate cut and not a rate cut apparently is a couple of months. End of July and September. It's that big deal? We'll talk about that in a moment. The data drops next.
The names that move markets are on Bloomberg.
We've seen story after story about companies delisting from the London Stock Exchange, listing in New York, listing in Europe. I want to turn that around. I want Britain to be the place of choice to make an IPO, to grow your business. That's why I welcome the reforms that the FCA put in place last week. It's also why I'm determined to change our pension system so we can keep more businesses here in Britain.
Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
60 minutes away from the opening balance, seconds away from a ton of economic data. Mike McKee's in the studio. He'll break all that down for you. The scores look like this on the S&P 500, pulling back a little bit. We're down 0.25% on the S&P. We take some more weight off the NASDAQ. We're down 0.4% after yesterday's big sell-off. The bond market is rallying into this data. The 2-year, the 10-year, the 30-year yields are lower across the board from anywhere between 6 and 8 basis points. The 10-year's down 8 at 420.37. With that economic data, let's get across to Mike McKee. Morning, Mike.
Good morning, John. Well, we have an upside surprise to GDP. 2.8%. The forecast was for 2%. Consumer spending comes in at 2.3%, certainly stronger than the 1.5% last time. I know, John, you've been dying to hear what's happened with jobless claims. 235,000, so we get a drop of 10,000 from a revised 245. There was talk last week of the jump that we saw being because of Hurricane Beryl in Houston, and that may have been the case. We'll look at where the big changes are. Durable goods orders down 6.6%. However, capital goods orders, non-defense, ex-air, up 1%. Remember, it was down by a 0.6 margin last month, and the expectation was for just a 0.2 gain. So business spending looks strong, consumer spending stronger than expected, GDP stronger than expected, and Bill Dudley says they got to cut rates. So, I mean, if you're at the Fed, you're just throwing up your hands going, I don't know.
Look, this debate's not going to change based on this economic data this morning. The pricing of everything might, though. Equity futures at the moment look a little something like this. We fade some of those losses. We're down 0.2 on the NASDAQ, down 0.1 on the S&P. We fade just a little bit of the rally in the bond market, just a touch. Yields were lower than this. They're still lower, still down on the day, but not as low as they were. We're down 4 basis points on a 2-year. On a 10-year, we're down about 6 basis points. Jobless claims, jobless claims, jobless claims. All the labour market data between now and the Federal Reserve's next decision is the difference, Lisa, between having time and running out of it. And if you look at that in isolation this morning, the picture around claims a little bit better. The people who are in the camp that they have time have a little bit more data behind them.
And the people who say that they don't have time will say that things can happen very quickly and that you've seen a gradual kind of weakening. This is data that makes it a lot more complicated and difficult for the Fed. And I would say that that's what you see, especially given the fact that when you look at the internals of this GDP print, you're seeing an upside surprise to the core PCE price index over the 3 months. So we're looking at a really pretty strong read there at a time where jobless claims aren't falling out of bed, even though there are other signs broadly in the soft data pointing to a dramatic weakening in certain sectors. This data doesn't show it.
Mike, you'll have some time to go through all of this line by line, but just an early read on things. That GDP surprise, that positive surprise, what's underpinning that?
Well, it looks at this point like what we're seeing is strength in consumer and business spending as opposed to an inventory kind of thing, although inventories appear to be bigger. I'll get those numbers in just a second. One thing I did want to point out, the price index for the quarter, which the Fed doesn't pay as much attention to because it's a quarterly average, comes in at 2.3%. That is significantly lower than what had been anticipated before. The second quarter PCE, 2.9%, I'm sorry, annual rate, 2.7%. That will give people the idea that we're going to get a decent number tomorrow.
At this certain point, it's not about whether or not the economy is falling off a cliff. It's about the balance of risks for the Federal Reserve in terms of the labor mandate and the inflation mandate. Is there enough confidence, given the fact that there is an upside surprise in this GDP print to the inflation metric, that you're seeing jobless claims actually go down from last week, so potentially the distortions you were talking about? Is there anything in this data to suggest that the inflation beast has been slayed and that that's sort of an ancillary question, and that really the focus is still squarely on jobless claims?
Well, I would go back. John knows Hammer Films in London with all the Dracula movies, and they'd kill it, and it would, you just pull the cross out and they'd come back again for another movie. That's what the Fed is afraid of at this point. You can't say it's been slain, but you can say that things are definitely getting into the territory where the Fed has said it would cut rates. Now, when you look at the GDP numbers, you have to figure that it would probably take a July surprise off the table, because the GDP is strong and the PCE numbers are going down. I mean, on a quarterly basis, 2.3% for the headline and 2.0 is their target. So they're getting pretty close here. So at this point, you have to figure that if they do anything, they'll be setting us up for September. And you were talking about the yield curve earlier. I mean, the markets have priced in a July cut, essentially. So they don't need to cut to get the effect that they're looking for.
Just how dark are these conversations you have with Fed officials down in D.C.? What are you talking about? I know, seriously. Scary stuff. Mike McKee is going to stick with us. Michelle Gerard of NatWest joins us now for more. Michelle, only 15 minutes ago, we just had a conversation with Bill Dudley, who was making the case to cut interest rates in July. You're making the case that they're going to cut in December. You've got some additional information. Why does this picture this morning validate your stance?
Well, let me just begin by saying we have backed off or pushed off our call for a Fed rate cut pretty consistently over the last year. We had been expecting the economy to be weaker and the Fed to be cutting rates sooner. We've had this December forecast in for a while, though the data and the rhetoric have mounted to suggest it could come sooner. We've just got a lot of information, as this morning's numbers suggest, the employment numbers next week, which times before. I think what morning, again, kind of complicating the picture for the Fed. Next week, we've got a forecast for 170,000 gain in employment and unchanged unemployment rate. Complicates the picture. Just how urgent does the Fed feel they need to act? I think the data, we don't rule out September at all, but we just don't want to get whipsawed as we've been so many.
If unemployment crept higher, and this is really a little bit of scenario analysis, I just want your opinion on how they might respond to this. Going into this meeting, I just wonder how they might respond to all of this. How would you expect them to respond to the disarm rule? How would things change?
Well, again, even as Bill Dudley points out, the rate are not quite as worrisome. It doesn't suggest that the labor market is, has. So I don't think the Fed would want to appear panicked. They've set of setting the stage for a September rate cut. Even if we were to get a sharp upside, a negative surprise in terms of the economy, an upside surprise in the unemployment rate, I don't think to cut rates in July. Again, the Fed doesn't want to appear panicked, particularly when the underlying breadth the broader economy is falling out of bed. So I would still expect that they would keep on the same path. It would just September would ratchet up dramatically, and the rhetoric at the Fed meeting, as well as the Jackson Hole August, would certainly, I think, definitively set the stage for action in September.
Michelle, just The balance of risks for the Fed are much more squarely focused on the labor market right now, and inflation is much less of a
I don't know if I would go so far as to saying we've shifted from the or mandates now more toward the employment or economic situation than inflation. From focusing primarily on inflation to a more balanced approach and looking at both of the risks. I think also stepping back, as you say, and looking ahead, we've mentioned the politics. I mean, the election may, on a near-term basis, factor into the market's discussion, at least, about the. When you think about the implications, perhaps, of a Trump presidency and the potential for inflation, there are offsetting risks on the inflation side as well. Yes, we've got a growing confident that downtrend can continue, but when it looks more outlook under certain political scenarios, and that too has to factor in. So again, I kind of risk is relatively balanced, and I think that's probably appropriate.
How much do you think, though, the markets would sell off if the Fed didn't?
Again, I think it would be a disappointment, and I think you'd see the markets react, but it messaging around it. If for some reason there's just an expectation that the move has been delayed, clearly the market's going to be disappointed because it's pricing in almost 70 basis points of don't move in July and September, and you're only going to get one cut in December. The market has to But as long as I think the markets are anticipating that the next direction the action is to cut, that there is some underlying support there that would be sustained.
Michelle, sticking with Gerard of NatWest, appreciate it. Thank you very much. Let's turn to the bond market. I just want to sit on the 2-year just for a moment. Was down about 9 basis points, now down about 3. Economic data better than expected, just pushing back some of these cores. Maybe even as soon as this meeting in July. Mike McKee still with us to break this down. Mike, GDP, durable goods.
The durable goods issue in terms of headline number coming down 6.6%. Non-defense air 27% decline. I wouldn't want to be in that business that way. Talk about GDP numbers, and its personal consumption 2.3%, non-residential fixed investment up. That was equipment 11.6%. Structures were a big deal last year. This factories now, they're putting the equipment in, so this should start to have an effect on the overall economy going. Big drop in net exports that subtracts about 7/10 GDP, but inventories added 8/10, so they kind of offset each other at this point.
Gennady Goldberg in New York. Gennady, let's get into this data first, and good morning to you. What stands out for you? Does this push back those calls for an
July is off the table. I think it's been off the table for at least the last few weeks. I mean, if you look at market pricing, we've basically weeks. I think it's really a function of September, November, December. That's the way I think about it. I like to think about it, is it 1 or 2, 2 or 3 at this point? I think the data leading up to kind of question of 2 or 3. So I think November potentially is in play, but we still think September is the first.
This is a very through it. What's changed that range for you from going 1 to 2 to 2 to 3?
Well, are they actually starting to focus on the labor markets? There's been a very subtle messaging shift over the last couple of months about weakening. It's no longer just about, inflation has to come down. Inflation has slowed quite dramatically. Now do have some weakness on both sides of the economy, and we actually have to be a little bit more careful about not over-tightening. For them, it's a function of, look, we want to take rates lower. We want to start cutting rates gradually. But if the labor, we have to go faster.
That said, it seems like there's this feeling that we're not getting a clear picture. Significantly, it can look very different a month later when we take a look back. How much is your sense that that show solidness and look more at the weakness and count more on that and protect against that? How low is the bar for them to point to the labor market as a reason to start making those adjustments?
I think it's much lower. Really surprised me in the last labor market print wasn't the actual print itself. It was the revision to the last couple of months. The fact that the 50K to 177 in a single month, that's not the kind of volatility you typically get. Moving average, for example. So we've been flying well above the break-even pace, which is around 175. Gone well to the bottom of it. And now the question for the Fed is, well, if that persists, are we actually
come on this show draws a distinction between weakening and actually a recession, and nobody has come on and said we're heading into a full. Bill Dudley, who said that, maybe they're too late, but other than that, everybody else seems on board with the idea that there still is quite a bit priced into the bond market longer term in terms of rate cuts has already gotten it over its skis. That, yeah, they might start the adjustment cycle so that they don't have to make bigger cuts later.
Yeah, I think, and that's why I think a third cut, September and December cuts, the more labor market softening that we get, the more likely in play. And I know, everybody talks about the election as a potential kind of, stumbling block for the Fed. Labor market weakness. The big question for them and the bond market is 2025, right? We've got the election coming up. We could take us very astray from the soft landing scenario. We could have a big spike in inflation. We're pricing in just over 4 cuts, and the scenarios have gotten wider and wider and wider in the meantime.
Cutting into an inflationary environment that Michelle was talking about. If we get high tariffs, that would, for the most versus the risk scenario, right? The baseline scenario, assuming there was no election, what would the Fed be doing otherwise? Maybe a little bit faster if the labor market was slowing down into 2025. The question is, if we do get this inflation, as some have said in the market, we think it actually would allow the Fed to keep rates on hold, so higher for highs. So if we get those couple of cuts this year, maybe to 4.75 or 5%, and we stay there for the first coming through, then the growth shock actually impacting, and the Fed needs time to assess all that. Tariffs, the tax fight, but you're talking about even a bigger fight that potentially is going to happen at the start of the year, and that's the debt. What the composition of the election could mean for that debate in Washington.
Right. I think the biggest risk scenario.
But isn't split government good for the market?
Technically, yes. This is the one instance where I think this can actually. Under Obama, that was split government as well. Nobody was really a fiscal hawk right up until the point where we came out of the woodwork and then started to negotiate all of this. It is tricky from a timing standpoint, right? The X date, or the point where the Treasury runs out of cash, is only around, we think, July to September of next August. So either they deal with this before vacation or after, and it's going to get close regardless.
So we've gone through a bunch.
I still think from a net standpoint, you want to be net long 10-year treasuries.
Okay.
We're still long quite well. We're still in 530s curve steepeners as well. That trade's done quite well. I think you want to risk is in that curve trade, right? We're not necessarily going to a straight line, back to neutral. If we stay at this higher for longer range, right? If we end up at 5% for the first half of next year from tariffs, from immigration, all of that can actually lead rates a lot higher. So there's not, unlike this year where everyone was in steepeners, next year is going to have a lot more trades. If
times has the word tactical come up over the last couple of weeks, right?
How could anyone be anything
Which is like code for
the honesty, because realistically, who could come on here other than Steve Eisman and say he knows with
program flying blind into 25, big time. Gennady, it's good to see you. Thank you, sir. Gennady Goldberg there of TD. What's the notion that the Fed has the benefit of time? In the Fed's mind, there is no need to rush with private domestic. July remains a set-up meeting for September. The title, See You in September. As well over at PIMCO, so there you go.
This is basically the collective scream for please let us have a vacation.
Go on vacation. Make it happen. Next week, right?
No, not next week, the week after.
The end of next week.
Yeah.
Good for you, Lisa.
Thank you.
All right, then. Stories elsewhere this morning with your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. I just want to recap some of that data we got. 135,000 last week. That is just a touch below estimates. As for second quarter GDP, that rose an annualized pace well above the estimate of 2%. The GDP numbers, as Neil was saying, does ease. Let's check in on shares of American Airlines, lower by 3.5% pre-market. It's last becoming just the latest airline to temper expectations as fare discounts and high cost pressure earnings. It is expectations this year. Americans saying they, quote, did not perform to initial expectations due to their supply and demand. And Kamala Harris is about to receive some big name political that Barack Obama plans to endorse Harris soon. NBC says that Obama and Harris have been in close touch since she announced Monday. And that's your brief, John.
Hey, Danny, thanks for that. Appreciate it. And thanks for this morning. Up next on the program, we'll set you up.
On Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. If you want to give it that moniker, but it's not the same intelligence that I have.
My special kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven.
Working in AI for a long time, it's great now to see other people using it and seeing what some of the challenges are.
Much more than just software. So you need long-term investments in science and research.
You have an ecosystem of new industrial revolution.
Nobody covers technology like Bloomberg. Contact. It's the world's second largest economy with a growing influence in global affairs. But The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis. Makers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time. Changes everything. The countdown is on. Of tomorrow's trading with The Close. Weekdays at 3 p.m. Only on Bloomberg Television. Contact trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF.
Counting it down to the opening bell, about 37 minutes away. It's improving following that economic data, but the bond market's still bid and yields are still lower. We're down about 5 basis points on a or so. And in foreign exchange, lots of attention. Lots of eyes on dollar yen. Dollar yen still lower on the day was 151.94, and right now we trade at 153.38. So that day session lows, jobless claims a bit lower than expected, just parking some of those calls, some of that urgency. What the rest of the week looks like: President Biden and Israeli Prime Minister Benjamin Netanyahu holding a bilateral meeting. Harris also with a meeting of her own with Netanyahu at 4:30. We'll round out the week Friday with PCE at Mar-a-Lago. Then we start to think about next week. I think we're already thinking about that with a ton of earnings coming up too.
Difficulty understanding the technicals from the fundamentals. People are saying there just was such a huge bid up in certain stocks. Popular trades currently. On the flip side, the earnings have not been great, especially from consumer. No one wants to go past the end of this year. Nobody wants to even wager what that might look like. So it means if the Fed cuts rates, if data responds this way, to sort of game theory out one another, because trying to do the
happen next year for the Fed to cut or hike into. It's very confusing, staring into the sun. Lori Calvasino, that's what it feels like. I feel like last night with the president finally addressing the nation, we've put to bed he was just going to serve out his term, and it is a brand new race. And now I think next week Kamala Harris goes, who her VP pick is, but actually the data becomes more important. This week felt like the politics was really important.
And a Federal Reserve decision as well, and all those tech earnings. Next week is absolutely stacked. Tomorrow's program is as well. Here's the lineup. With him about what's been developing in the bond market and issuance from the Treasury, and this recent paper, Stealth QE, coming out of the Treasury. We'll get his thoughts on all of that. We'll speak to Victoria Fernandez of Crossmark, Republican Senator. Idea who booked this, but the AC Milan CEO, Giorgio Falani, joining the show as well. Why are we doing that?
AC Milan's playing on Saturday.
I'm passionate about AC Milan.
Good. You better be tomorrow.
This is Bloomberg News Now.
News when you want it at the touch of a button.
We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app. Get your podcasts.
Bloomberg News Now. Context changes everything.
We're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive.
Strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver. It has derivatives in not only feeding, which is the core thing that you know most households where the against the pet,
but treating. And then you start to branch out to things like vitamins and minerals.
They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over.
The more that you learn about this case, the more the nature of the killings, the execution, the just brutality of it.
It wasn't be looted because they are considered so sacred.
And we did it the way you do every an elephant, one bite at a time.
It jumped off the page at me. Team taking the police.
Effective Fed funds rate 5.33% for July the 24th, unchanged from July the 23rd.
These are the holders of truth and justice. They cannot possibly be doing this. And the evidence is there. It's overwhelming.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings.
All right, GDP blowing away expectations, futures rising.
I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Airlines investors are digesting another string of disappointing earnings news.
And there is helping to ease fears that the Fed would need to rush rate cuts.
Plus, here comes this year's biggest of Lineage as the cold storage firm makes its trading debut. But let's get a check on where markets stand about wipeout yesterday. You can see that the S&P 500 pretty much unchanged. NASDAQ 100, your big tech names, 0.1% in the pre-market. Meanwhile, the bond market a rally underway. We are off the lows of the 10-year yield down about 4 basis points, Matt.
All right, as Cameron Kreis says, we took a collective trip to the well as long bonds, but stocks is where I noticed it. Take a look at the Mag 7. This is the biggest hit yesterday on record. $760 billion of
Couple of stocks I'm watching. Shares of American Airlines are lower by 3.3% pre-market. Remember, year. We'll talk more about that in the show. Ford also resuming its decline about 13.3%. Second quarter profit print that fell short of Wall Street estimates, Matt.
All right, so a lot of disappointment we've seen in stocks since 2022, and then this morning we get this economic bombshell. Flat, and it came out closer to 3 at 2.8.
And you can see the relief in futures right now with all on the street and in the numbers. Even still, we have an economy that's holding up. The Fed doesn't have to rush to cut. With GDP at what, 2.8%? That doesn't look very recessionary.
Yeah, and the risk-off tone at least came out just this morning. The call from Chris Harvey, the S&P probably sees another 2% downside. He says, let's see how many people agree.
Yeah, economic data in the last 30 minutes really changing things. Bloomberg's chief economics and policy correspondent. So, Mike, what do we know about the growth in this economy?
Thought, which has to make Fed Chairman Alfred E. Newman feel good. What? Me worry? He's got in the second quarter, that's up from 1.4% in the first quarter this year, and not. It was good composition. Personal spending up 2.3%, business spending up 5.2%. Trade, so it's really a spending story at this point. And you look at what we got out of trade and inventories there, you can see the fact that they kind of offset each other, and we're going to focus on the spending part, which is what the Fed wants to see. Now, when you look deeper into that, you can also see durable goods orders were up 0.6, but capital goods orders, the important one, comes in up by and that shows that companies are still spending money. And in GDP, much of that was on equipment. Maybe bad for tech companies because it's been good so far right now.
Mike, let's talk about jobs. Also is coming in less than expected. Where's the weakness coming from, if at all?
Well, retool a lot of manufacturers, so it's hard to get an accurate read. But what this does tell us is that we're not seeing kind of the in any way in the labor force, and probably the bulge that we've seen has been like the hurricane down in Texas. Texas had the most initial jobless claims the last 2 weeks, and so that down further. Bottom line is, at this point, the Fed doesn't have to move next week, despite we may see some repricing, but September is the date to remember.
I was going to ask about Bill. You know, his op-ed yesterday said the facts have changed, so I changed my mind as well. To that op-ed today?
I don't think so. I mean, his overall point is that the economy is slowing. Medium to longer term. So I think what we're going to end up getting is the Fed cutting rates. But take a look at the yield curve over the last couple days, and I haven't seen it in the last 5 minutes after we had these numbers. Priced in a September cut, and they've also really pushed down rates across. Doesn't move. They've got a cut already priced in there.
The control room
that
is
they
on
can
fire.
sit back on.
Mike, you mentioned. I mean, they're doing a stellar job back there.
It's amazing. We don't need to add more workers, I guess.
I have to say goodbye. Really appreciate your reporting and your insight as always. But let's bring this conversation to the markets because Gabriela Santos, she is Chief Market Strategist for the Americas at JP Morgan Asset Management. Great to see you. Let's pick up on what we were just talking about with Mike McKee. You had Bill Dudley out yesterday saying that the Fed should cut next. The Fed may be 2 meetings away from a policy mistake, but then you take a look at the numbers that we got this morning.
I don't think it's urgent to reactively cut rates in a very aggressive fashion, but what investors want to see, that's just to keep the economy on track. And if you look beneath the surface at the GDP report this morning, the first quarter, which was only 1.5%, so that's good. But last year, consumption was growing 3%. In economic momentum, and that's why it is important to normalize interest rates sooner rather than later. Now, sooner I don't think is next week, but September is still very much on the table even after this morning's data.
What happens between now and September? If you think about the data and how backward-looking it still is, and the earnings we're seeing, do you see a lot more pain between now and September?
So I think for the markets, there are 2 separate issues going on. Is an issue of expectations and also the delta of tech earnings, right? So expectations are high. You to see a positive stock price reaction, and the delta is slowing, right? For example, Magnificent. Still amazing. The level is good. but the delta and the expectations are not moving in the right direction. Then when it comes to cyclical stocks, I think there's some growth concerns. The data this morning helps calm those down, but the delta is still downshifting. So I think that's what's causing a little bit of readjustment in the markets, but we think this is a normal correction. 10% once a year wouldn't be out of the ordinary. And in general, the levels are still good and still support a broadly rising market.
I've heard a lot of people refer to the Magnificent Seven as lifeboats, right? And yesterday, Shonali and I had lunch with a couple of investors who said everyone is hiding in those stocks. As we see a broadening out in terms of earnings, and I wonder if you expect that, off? Can people get off the lifeboats and get back on the cruise ship?
I think there's a lot of fatigue. Is it accelerating? Is it slowing? Where's inflation going? And so there's been some hiding out and some structural themes while we sort out the data. I do think if we get proactive rate cuts and there's a little bit continuation of the soft landing, plus a broadening out in earnings growth, which we're starting to see, then you a rotation because we don't think tech sells off on a more sustained basis, but that you also get not the kind of data that would merit, going from mega cap tech to small caps. There's other large cap sectors, maybe some mid caps for a little cyclicality. But overall, I do think the earnings season is going to help see some of that broadening out.
Well, we definitely need to talk about AI, but let's talk about that earnings broadening out that a lot of people have been waiting for and predicting that this will be the quarter that we see it. But airlines, some of the consumer companies, Nestle, for example, in the last 24 hours, cutting its sales guidance.
So to hear the yen wipes out day's gains, trade little change at 153.88 USD.
Mag7 grew earnings 50%, the rest -2. But if you actually look at the sectors, 8 out of the 11 sectors registered. So that's encouraging that the earnings recession for a large part of the large cap market is behind. Positive 5% for the ex Mag7, and 8 out of the 11 still registering for those sectors that had been riding high on a lot of ability to raise prices above average. Those are actually facing a reality check. And that's where we come to travel and leisure. Very, very nuanced depending on the type of company and the type of sector.
Yeah, I think even in because Ford problems are Ford specific. Stellantis problems are Stellantis specific. GM, but GM, knocked the ball out of the park. So, and people are still buying automobiles. We continue to talk about that for sure, and we're going to continue to talk with Gabriela Santos of JP Morgan Asset Management. She stays with us. Let's get
You were just mentioning Ford. Let's take a look at these shares. Absolutely plunging, down 14% into today. The stock set to open down on the year with this big plunge, and it has everything to do with a massive 30%. Despite the fact that they beat sales by 10%, analysts saying this has to do with headwinds relative to an even bigger plunger on the morning, laggard. This is Edwards Lifesciences, the heart valve company, down after they missed the sales estimate. There's one particular valve that's at issue. Lots of price targets on the street taken. What this is from a superlative standpoint, what was the worst day before this? It looks like this could be the worst day in a brutal morning here for earnings movers. Take a look at Southwest Airlines and American Airlines, both to the downside. Order under activist pressures. Investors may be wondering what that will mean. American Airlines down and approaches with their sales outlook earlier this year, plus assessment of demand on the open.
Absolutely. Abigail Doolittle, we'll see you in about 15 minutes time. Now coming up, more on how on track for its biggest fall since October 2023. This is Bloomberg.
Times in Tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working right now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of new industrial revolution.
Nobody covers technology like Bloomberg. Context.
Let's take a look now at high interest, what's making headlines around the world. President Biden framed his unify the nation under a new generation of leaders in an 11-minute speech last night in the Oval to younger voices. Benjamin Netanyahu gave a fiery defense of Israel's war. U.S. Congress yesterday. The speech was boycotted, though, by dozens of Democratic lawmakers. The aide dismissed concerns about the war's mounting civilian death toll and mocked of the conflict in Gaza. Sustainable Metal Cloud and NVIDIA partner and a is raising about $950 million in fresh funds to try and tap the global artificial intelligence, which is expected to be the fastest growing market for the crucial AI infrastructure over. Shanali?
And Stellantis shares are plunging after net income fell 48% in the first half, as it introduces new models. The company's CEO spoke with Bloomberg earlier this morning.
The automakers are in a turmoil. It is true that the transition that we are going through is immensely challenging, and other bumps. This will last for a few years. This is not a short-term turmoil.
Joined by Bloomberg Global Autos editor Craig Trudell, and you think about what happened with Stellantis, with Ford, how much of these companies, and is there anything that they said that can be drawn out into the broader world of autos?
Yeah, I think as you guys were talking about before the last break, I mean, I do think that there's absolutely some, company by company aspects here of whether you look at, Ford and their quality and warranty issues is very unique to them. I think with Stellantis, you have more of really a sort of mismanagement of some of their, most prized brands. I think Jeep has had real challenges. Also has been shrinking. Those two brands are sort of, where that company makes their money.
They canceled the Hemi. They don't make the Challenger. There's no Charger. I mean, what cars does Dodge even sell?
To make an EV bet with Dodge, which was maybe a questionable decision given the vehicles. And I think over here in Europe, even in Renault, they were making efforts to split up the EV and battery business and sort of around different powertrain types. I think in the case of both of those companies, you've had was going to try and list that business. It's, in retrospect, a good thing they didn't, given the sort of way that Tavares, talked about turmoil for this industry. There's been a few years ago, everybody was struggling with supply chain issues. Now it's really more so a right, and it's proving really difficult for some of the players who are late to this. And I would put Stellantis in that camp.
You focus on quality control, otherwise you're going to be spending way too many billions on warranty issues. Craig, thanks. Trudell. Still with us is Gabriela Santos, Chief Market Strategist for the Americas at JP Morgan Asset Management. Just for a second, we showed some pictures of the Challenger, Dodge Challenger, gorgeous car, but they stopped making it in 2023. Environmentally friendly products. When we see the election in November, for example, the green energy push. I noticed after reading your notes, traditional fossil fuels, oil and gas, has done amazingly well under Biden and did horribly under Trump.
Biden says the GDP report shows the U.S.'s strongest economy in the world.
15 million annualized. 15 million. So there's just a broader fatigue around consumer durable purchases. But this really relates to a question clients are asking us. Is there any policy signal in the midst of all this political? And one prime sector is energy, where there are clear policy differences in terms of traditional versus clean energy. Policy right, you still might not get the actual investment implication right. Under Trump, we have 250%, where traditional energy fell 40%, and it's been the about global prices, valuations. It's not really about the policy in and of itself.
By the way, those numbers bear repeating because I'll get flamed by J6 Twitter again. Yeah. But the fact is, energy stocks, oil stocks fell under Trump. Biden, like bigly.
And that wasn't because of necessarily the policy in and of itself, right? But if we remember, fell quite precipitously. That was a challenge for the industry. In general, when you get more supply of oil, you would think something global happening as well. That's not necessarily good if you're one of the oil majors. Versus you had a yes, partly related to policy, but also because there was just a push, more broadly speaking, of unprofitable companies, of which clean energy was part of that trade, if we remember, 2021, 2022.
The outcome, getting the trade right, is a whole different story, and that's true for economic data, earnings, et cetera. But when you look at denominators, common themes in either administration, no matter who actually wins the White House, that you can invest.
The bond market is higher deficits. And that's going to be, unfortunately, the theme for 2025. What's going to happen with the 2017 Tax Cuts and Jobs Act, individual tax provisions that all expire at the end of next year. If you look at CBO estimates, the expectations for the deficit to stay very elevated at 6%, but that assumes all the individual provisions expire. So really the debate here, that increase in the debt, and that will very much impact long-end yields, which, as we've been seeing, of the inversion of the curve, and I think that's because long-term yields are going to stay anchored around some of these deficit issues irrespective. The last thing I'll say that's also really important is the rise of industrial policy, right? Both candidates talk about using government policy carrots and sticks to favor certain industries, and especially around this theme of reshoring production, self-sufficiency, friendshoring, and so a bigger read-through around, well, automation, can that help reduce costs, or can so those are read-throughs irrespective of the outcome.
Unfortunately, we have to leave it there. Hope to have you back very soon. course, of JP Morgan Asset Management. Now, coming up, we'll take a look at the companies making the most buzz today in our social climate. Bloomberg.
Bloomberg Power Players is back in tennis. Take the court over in Queens. We're convening the best of the sports world right here in New York. What's next for players and fans in this multi-billion-dollar global industry? Bloomberg Power Players /Power Players.
Bloomberg surveillance and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and
All right, time now for shares sinking as subscription and streaming revenue growth disappoints investors. The world's biggest record label such as TikTok and Meta. Next up, Harley-Davidson beat second quarter revenue estimates thanks to higher shipments. The company also announcing plans to buy back $1 billion of shares through 2026. And finally, Chipotle looks diners happy. The burrito chain's CFO says that these generous servings will contribute to some margin pressure. PREN Go on your Bloomberg terminal. Coming up, Michael Kantrowitz, Chief Investment Strategist at Pipe.
Saturday mornings, I understand you have off.
Yeah, Saturday is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife. We go for a swim all year round. After that, have a nice lunch, and then I'm on to a good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend.
So 1 minute now to the cash equity open and the market on open imbalance.
What we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, the bandwidth of your reflection is just too narrow. And I generally believe that Monday mornings I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis.
So we are looking now to the market on open imbalance. The S&P 500 is 60 million to the buy side. The NASDAQ 100, 20 million to the sell side. The Dow 30 stocks are 40 million to the buy side. Mag 7 stocks just 10 million to the sell side.
Down day on futures this morning. Then we had GDP data come out. A little bit. So now you can see the S&P futures are unchanged. NASDAQ and Russell futures are rising. As we have a couple of IPOs. On the New York Stock Exchange, Concentra starts trading today. Plans, and then Lineage, the cold storage company that we're going to interview in just about an hour's time. Let's get a check on the major averages with Katie Greifeld. Katie?
Well, like you said, Matt, a little bit of a turnaround going on. That looks pretty good after what we saw yesterday in terms of the worst day in almost 2 years. Big Tech up about 0.1% in the first moments of trading, and that rotation, maybe it's back. And those small caps currently leading the way, up about 0.3%. But one stock we're keeping an eye on beat expectations for its second quarter results in Chanel. You can see shares currently up about 6.6%.
I'm also keeping an eye here on Ford, continuing its plunge after second quarter profit. That fell short of Wall Street. Opens at almost 14%, more than 13% this morning.
All right, and American Airlines. The airline slashed its earnings outlook for the year. We want to take a closer look at the airlines at large.
Well, there's lots of pain here for airlines. The trend continues as demand for the current quarter, this all-important lows, these shares down just 0.3%. Earlier, down about 3%. They beat, but they also cut the current out because of this air pocket in demand. And they, in addition, in a real shift, they're going to meeting for those super loyal Southwest Airlines customers who like it the way that it is now. Time will tell. Down sharply, as you were mentioning, they slashed the profit outlook. The second time they've done this year, the stock down 4%. That they really got the demand picture wrong. Plus, one sales strategy around certain corporate customers. Lines down sharply, Katie.
Absolutely, an ugly day for those airlines. Abigail Doolittle, thank you so much. We're at Piper Sandler, and Michael, there are so many cross currents right now between politics, of course. You have and you have the Fed coming up next week. Take us through what your takeaway is right now. What is the ball that you're keeping your eyes on?
Well, I think investors have continued to be very myopic, so impacting the macro and the market picture today. But what seems to always be mattering most is we're in the thick of earnings season right now. We're just starting. I think about a quarter almost of the S&P 500 has reported. So we're going to continue to focus on how guidance evolves during this earnings season. We've seen a lot of tail events so far. We've seen this theme of transportation stocks missing, whether it's airlines, American Airlines, Ford today, Tesla recently, and even UPS. So companies with heavy cyclical exposure to the economy have been disappointing. And to us, that flies in the face of this recent rotation into small caps and risk taking.
One thing I'm wondering about, Michael, is how much more you're going to see volatility rise. You've seen the VIX rise to an 18 handle yesterday. It's holding the ground today. A lot of volatility under the surface, and the S&P 500 right now not figuring out exactly where to go. Is volatility in this market a good thing or a bad thing?
I guess that the answer is it depends. In some ways, it's a good thing for traders and for companies that provide trading as a business, and certainly something that's been missing for much of this year. But it's an echoing of the current uncertainty and this backdrop on the macro front, on the policy front, both in DC and the Fed, and of course on the earnings front. So, we've had really low volatility for a while as inflation pressures have come off. Now we're starting to see unemployment rise. So I think the volatility backdrop is not going to spike anytime soon, but we're probably going to settle in at higher levels than what we've seen for much of this year.
I'm looking at shares of NVIDIA falling again today after breaking through a key level to the downside yesterday. And I'm just wondering if we're going to get an answer to whether or not AI pays off this quarter, or if it's going to continue to be a Google kind of wait and see message from all of the companies that report. So much has been invested. Michael, when are we going to see companies monetize it and that show up in earnings?
Well, I still think that's a longer story that goes well beyond. So I don't think we're going to get an answer definitively one way or another anytime soon. Therefore, I don't think that's going to be the ultimate make or break on the story for now. And obviously, we're just early on in the Mag 7 earnings cycle. We've got Microsoft coming up. And so I think we got to wait and see before we can make any longer term judgments on where we are in that cycle.
And Michael, I want to get to the business of forecasting because you made waves earlier this month with Piper Sandler dropping your S&P 500 target, calling that the practice is basically futile in this market. At the time, you said that having price targets on individual stocks makes sense, but makes less sense nowadays for the index. I'm curious, when you take a look at your sell-side community, would you expect that more firms will follow your lead here?
I don't think I'm the first to do that. I believe there's some other strategists over the years that have also avoided that practice. I think there's some firms that kind of have to do it because they have more of a retail exposure to their product. Our firm predominantly focuses on institutional investors, so active managers and stock pickers, where the market, especially given today's concentration, is really less relevant. And I think yesterday was another great example of this, where the average stock in the market was down about 1%, and the index, because of the heavyweight losses in Mag 7, which I think is almost down 17% or so from its peak, made the index go down a lot more. So I think ultimately it's what we can do to help our clients is focus on which parts of the market to be leaning into and avoiding, rather than trying to forecast an index where the constituents are at a 30-year low in correlations with that index today.
And it's a fair point. I mean, we also heard from Mike Wilson over at Morgan Stanley that he was backing away from big calls such as that one when it comes to forecasting just the index level. But if you are tying this to the concentration of the market, do you see an environment where you return to forecasting the S&P 500?
It's funny. I've been thinking about that and getting that question. And, maybe the right thing to do, again, for my client base is to focus on the equal weighted index, thinking, again, from the opportunity set that institutional investors face. Perhaps that's given today's lopsided concentration makes more sense. But again, we focus on, three things: direction, momentum, and endpoint. And ultimately, whether you're bullish or bearish can come across without necessarily having to have a specific price target. And we're still doing that.
Michael Kantrowitz of Piper Sandler, we thank you so very much. Of course, very complicated market we're taking a look at, on the edge really. But let's take a look at some M&A action because it is a day of mergers as well as IPOs. We're taking a look at Bally's here, up on Bally's, for example, up 23%, significantly, because they have agreed to a an acquisition.
There we go.
An acquisition.
Yeah.
Potatoes, but I agree. Then the of course, is KKR agreeing to buy a software firm here in Structure for 23. Also up about 2% on the day on the heels of that deal. KKR down about 1%, but earnings ahead still. Keep an eye on it. All to say, guys, the deals are coming back.
Yeah, absolutely. Just check out MAGO on your Bloomberg. Results from American as well as the Southwest. Next, this is Bloomberg.
You learn about this case, the more it reads like a Hollywood script. The nature of the brutality of it.
It wasn't in the psyche of people that they could be looted because they.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
Mafia. Il sistema è perfetto, sono gli uomini che spesso non lo sono.
They cannot possibly be doing this, but then they are. They are. And the evidence is there.
It's the countdown to the market open as we bring you the first
debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy John.
Morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg.
Bloomberg and resources from more than 120 countries. The moment news breaks, thing. It's the world's second largest economy with a growing influence in global affairs. Questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need. In-depth market analysis and the most influential newsmakers in and around China. Bloomberg, the China Show. Context changes everything.
Futures down pretty big this morning, and they turned around after that GDP number came out. 2.8%. Considering we're only expecting 2 flat. The S&P 500 unchanged, the NASDAQ unchanged, and the Russell 2000 those smaller cap stocks. Katie?
All right, it's time now for our top calls. Some of the analyst action in focus this says that after years of benefiting from outsized growth in the active apparel category, trends have actually. Now, next up, Macquarie is downgrading Warner Brothers to neutral, citing the company losing its broadcast. The analyst says that losing these key rights means that it now loses a core content assets for both its linear network. Cutting Sirius XM to sell. The firm cites a valuation dislocation with the stock. Appreciation in the company's equity may be the result of a short squeeze, Matt.
All right, excellent. Or they were taking a hit, I should say. They've now turned around, and it's pretty eye-opening. +% because they slashed their earnings outlook this morning. Southwest as well. Seat count as well. There are real problems in the airline industry, it seemed, with. We see these two climbing on the day. Joining us to talk about why is George Ferguson. He is senior. What is going on that, in the space of an hour after a earnings outlook, the shares turn around and rock higher?
Also, thanks for having me. The story here probably is the guidance for capacity in 3Q. And so, a lot of the U.S. airlines brought a lot of capacity to 2Q. American was in the upper single digit. Couldn't absorb. As we look at their numbers for 3Q, we're actually looking at its growth there. I think they're so that's something closer in line with GDP, especially, I guess, if the U.S. economy is growing faster in GDP. South of 2% they're expecting in 3Q. Those numbers are starting to get closer to where they ought to be growing. They're going to turn around the pain they saw in 2Q entirely in 3Q with some of this. They'll start to ease some of that pain, and that's probably part of what's going on.
We need to pull up a one-day chart, which normally I prefer.
There you go.
A longer-term look, but right now we need to show a one. Because you can see the movement, the volatility has just been 920, and then we were up at 1080 all of a sudden. So I think the one-day, which is graph intraday price, is probably the most interesting. That's a two-day chart, which is also pretty interesting.
Another thing, beyond the stock price and beyond the numbers themselves, I'm really curious about what is changing with these carriers. You think about Southwest, for example, and them ditching the free-for-all seating, now doing assigned seating. What is all of this really about at the end of the day?
Yeah, so that's part of the, what's going on in the U.S. airline now is that everybody wants to move into sort of premium product. And you might be surprised that premium product isn't a business class seat, right? It's where you sit in the cabin. And so the good carriers are really generating a lot of extra revenue by making you pay up for an aisle seat, make you pay up for a window seat, make you pay up for, an exit row seat. And so Southwest is going to go the same direction. Southwest starting to look even more like the big three, United, American, and Delta. Look, I think this was probably a good change for them, as in they need to generate more revenue. This is a way to probably generate some of that revenue, separate themselves from the ultra low-cost carriers and the low-cost carriers, and not crush everything that they've sort of put out there as their product, which is things like bags fly free, free changes. I think this kind of works for them, as a modification to boost revenue without hitting some more of the sacred items in their lineup.
And George, specific to American, where are they when it comes to business travel, for example? Because we know that the company has been working to rebuild its relationships with corporate customers, with CEOs. Where are they on that journey?
Well, I mean, apparently from today's numbers, not as far along as they should be, right? So they lagged their peers, Delta and United, in every region for yields, right? Yields are the price paid per mile flown. So it really looks like, they've got a pretty decent deficit to Delta and United. Again, Delta United, I think, making better inroads for both premium passengers, premium leisure, and business, and I think that's what's supporting some of their revenue. So we don't get good numbers out of the carriers on how far back business travel is since the pandemic. I think United told us it's about 100% of what it was prior to the pandemic. So there's been no growth since 2020. So there's still a bit of a lag and a bit of a fight for that business travel. And yeah, American doesn't look like it's winning it right now.
George, we thank you so much for your time. That is George Ferguson of Bloomberg Intelligence. Now, coming up, we are getting ready for the biggest IPO of 2024. More on Lineage's listing next in today's Wall Street Beat. This is Bloomberg.
Morning from our world headquarters in New York. I'm Manus Krenning.
And I'm Danny Berger. Let's set your
Market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg.
Europe, I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets to know to kickstart the European Trading Day. Live from our European headquarters, we bring you the ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be.
Right now, and it's quiet, and that in and of itself is interesting after what we saw yesterday. Of course, the S&P 500 unchanged, the NASDAQ 100, it had been higher. Now we're trending a bit lower now, down about 0.3. Rotation continues. Small caps currently up about 0.9%, maybe helped by what we learned on GDP. Ollie.
And now it's time for the Wall Street Beat, because today we're looking at the year's biggest IPO so far, Bloomberg's Bailey Lipschultz, and of course the deal itself last night wasn't bad.
No, it was great.
$4.4 billion. What is the tone like out there? Is this just a matter of such little supply in the
to go public for years? And I've talked to real estate investors who have said we've met with Lineage over the last 3 years. Here, so raising $4.4 billion, they upsized that offering, so they sold far more shares than they range. So $78, that range was $70 to $82, so upper end, but they didn't push price, and that was the initial feedback.
I think Shanali mentioned this morning that it took 28 banks. Did you say 28?
I did.
20. Why? And all the big names working on it together, right? I mean, no.
kind of where we're at. It seems like that's what we've been dealing with. So when you look back, this is the biggest IPO since ARM back in September. We've seen a lot of banks on these deals just because there's not a lot going on. Sure, we're on pace to have year-over-year pales in comparison to where we were at even pre-pandemic, pre-2020, 2021 boom.
And we'll be speaking up at 10:30 a.m. So maybe you could do some work for us. What should we ask them?
What are they going to do? Because the expectation to folks on the buy side, acquisitions are ripe. So what is the company going to do? How are they going to put money to work? Because they did address some of the
initial stock sales doing just all right. People are still raising money, and now we're seeing that market broaden. What about secondary? They made it to market, super large pop on the first day, down the next day. What sentiment?
Had 11 million shares traded yesterday, so it traded about half the float. So we're still sub 400,000 shares. And back some of those gains, the thing, Sonali, that stood out to me was we had a massive sell-off yesterday in tech names, but yet OneStream Health. I see this big pops, and then the big question is, does it regress? What does it mean that it regresses to, and what is the next week or two? A week from now, where are we at?
The story we love and that there's a big debate about on the street is Wiz, right? Google, a couple of months after they had a $12 billion valuation, and they turned it down because they think they can do better. You know, and will they have enough cash to invest in the meantime to show the growth that IPO investors demand?
We want to get it to $1 billion in ARR. So that expectation
is... And they're
at
350 now. And by the way, ARR is like... Okay.
I'm not a CFA or anything special.
We just throw out acronyms.
Exactly. But the big thing is... class. Does Wiz sneak into the 25 class, or do they wait to 26? Remains to be seen, but they are growing really rapidly. They're super excited about the asset, and they really do think that that Google offer likely put a floor on what their valuation because they do want to acquire assets.
30 seconds. One of the theories I've heard out there is that if you continue to see this broad the small caps, it could encourage some companies to come out of the pipeline, actually go public. Does that hold any water?
Does a month and a half make a trend? When I talk to folks on the buy and sell side, they want to see this playing out through the entire conversation after Labor Day. But there's still so much uncertainty from a macro perspective, and also with the election. Weird calendar.
You should join us more often, Bailey.
This was fun.
Hey, man, I'm always in the office.
Come into the office.
I'm always here.
Bailey, hour, we're going to be speaking to the co-founders of Lineage about their trading debut. It's a cold storage. Psyched about. We're also going to talk to the CEO of NASDAQ.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and
Units in the Russell 2000 up 1% on the session today, with the S&P down 0.5% and a flight away from some of these mega cap stocks, more of a focus in the bullish direction on the smaller caps in the Russell 2000 today.
That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category.
That's the NASDAQ down 1% now as well.
Category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, households where most of the dollars go against the pet, but treating, and then you and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kind of playing out all over the world.
Next. Fed was going to keep rating World Cup. This is a 3
as the economic picture.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg.
We are 30 minutes into a really weird trading day. Welcome to
Stock stabilizing after a sell-off. Wall Street getting some relief as better than expected GDP data.
Biggest IPO. We speak with the co-founders of Lineage as the cold storage firm.
Friedman, and she'll discuss the IPO market, M&A strategy, and much more in just a few moments. But before you can see the S&P 500 taking a bit of a dive right now. The S&P 500 off by about 0.3%. Even more so, your big tech names down about 0.9%. Of course, had their worst day in about 2 years. Trading today shakes out, and then you take a look at the bond market, that rally there, maybe a haven bid underway. The 10-year Treasury.
We're heading back down in terms of stocks. Let's talk about it with Lauren Goodwin, New York Life Investments economist. Big slides that we saw, the biggest losses on the major indexes since last year. Tesla earnings and Google, both of which really showed that and like robotics start to pay off, right? So that theme that's been powering this market stocks looked like it was a little bit stale. What's your view?
Well said, Matt. Our high conviction is that the artificial intelligence trend is here to stay, but I think there's a that investors can take away from yesterday. The first is that a lot of the investment that's happening with respect to AI is incredibly capital intensive right now. That costs some of the mega cap tech companies a lot of money. It also means that there might be some beneficiaries that the market is underappreciating. The energy providers, the data and areas of the market that we think are likely to benefit from capital intensive nature of this build out may take a little more time. I think the second thing investors can take away from some of the jitters we've seen in tech the past couple of days is that these trends, even if we expect them to be long duration, interesting for the next several years, they are prone to cyclical events. And that includes just how concentrated that trade has been in a couple of names. All the more reason for investors to consider portfolio diversification strategies, especially if they haven't made any changes in the large run-up in these names.
Well, two things. First of all, really interesting point on AI that it's still investing in the hardware, the builders, and then in terms of picking winners on the application side, maybe it's a bit premature. But let's talk about diversification, and let's talk about what's going on in terms of this rotation into other sectors, but also into other sizes too, the small caps. It's been impossible to ignore, and it's even today, you have the Russell 2000 up about 0.6%, even as we see some of the bigger benchmarks take a leg lower here. I mean, what do you make about the durability of what we're seeing in terms of this broadening out?
This is a conversation that we have been having on the desk for weeks now. Is the rotation in small caps just about rates moving lower? We saw a similar bump for small caps and value stocks at the end of last year when the Fed was pivoting away from hikes and more towards a plateau. Or is there something a little bit more sustained, what we typically see for small caps on the other side of an economic cycle? In our view, we're not on the other side of an economic cycle. There's still slowing growth to come. And so while I expect that we could see tactical bumps in small caps on months like this, where economic activity is still pretty good, rates look like they're moving lower, but I wouldn't put all of my proverbial eggs in that basket. In fact, when we think about portfolio balance, one of the areas where we have the highest conviction is using the transition in interest rates that we're likely to see ahead to take some gains in equity and activate them in high yield. We've seen flows into U.S. high yield, including short duration bonds, accelerate over the past couple of weeks. That's a move that makes a ton of sense to me in an environment where the economy is still looking okay, but we're likely to see rate cuts ahead. Lock in those higher rates, still have some price volatility as small caps would, but much stronger yield potential as a result of the coupon.
You know, you think about market expectations, at least one rate cut, maybe two rate cuts. But if you only see one, Lauren, this year, the reality is that rates are still relatively elevated here. So how much does one cut matter? Is there more pain to be had when you think about sectors that are highly levered here, when you see through to the end of this year into next year?
It's such an important question, Sonali, and I'm going to take it in two parts. The first is just to acknowledge that even if one rate cut doesn't matter so very much for the economy, which I'll come back to, it matters a lot for market sentiment. And we've already seen some of that transition. Typically, when we see a rate cut, you see money move into the bond market trying to lock in higher rates. You see all kinds of deal flow unlocking in the private markets after a long wait, lot of fundraising, staleness, not a ton of deal flow. And so you're likely to see, as we've been seeing, a loosening in financial conditions. And that's real. That's real for the markets. That's powering some of the transitions we've seen. And it's real for the economy as well, because looser market financial conditions can provide a little bit of stability. That said, to your very point, higher interest rates, higher policy rates are challenging for more levered areas of the economy, and that can include small caps, which we just discussed. It's our view that the biggest risk actually to the economy and markets in the medium term is if we did see a reversal in higher for longer, because that's an environment where credit, which has begun to see some challenges in the economy. I'm thinking lower income consumers, more levered companies, that allows that to more painful.
All right, Lauren, great to get you on the program. I hope you can come and visit us of New York Life Investments, talking to us about these choppy markets. Take a look right now. Company after it came out and said huge headwinds in terms of warranty costs. At the Ford Pro unit that so many people had put a lot of hope in, and obviously it's going to lose a it did better than expected on Model E for the quarter, but they're going to lose $5.5 billion on EVs this year.
Since March of 2020. I'm going to ask the question Katie keeps asking, was do these stocks deserve? That's my question.
It's a great point. These are crisis levels, and it's interesting that you're seeing it pull down the rest with those good earnings, even with those nuances that we were talking about. GM also down 4.5% right now, Matt.
I will the automakers over a 5-year term, and Ford has done better bigly to today is the biggest winner over the last 5 years, but I think Ford is the second best
That's your word of the week.
performer. Former president made that up.
There you go.
Because it's so much fun to use. Abigail Doolittle, you're watching some of the other stocks. What's moving?
NYCB, New York Bancorp, Community Bancorp, back in the news, and for all the reasons it had been in the news earlier. Amidst that selling pressure, having to do with loan loss provisions that are well above the estimate for of $193 million for all the reasons before, bad bets on both office and multifamily. And is selling its residential mortgage servicing business for $1.4 billion. Net, investors not liking it. Let's take a look. They beat and boosted. To the other downside, though, we looked at this one before, Edwards Life Sciences down 25. The heart valve maker did miss its sales estimate, what the street was expecting. Investors sending. It's really interesting. You all were talking about how it's been this wild day, down, up, down. Well, right. NVIDIA at 107, the key technical level 118. This stock right now technically set to all these big tech names. Let's stay tuned to see if we're going to looking at another big down day for stocks.
5-year chart of all the automakers, and Ford has dropped a long way. Stellantis is still over the last 5 years about 35%, Ford about 20%. So some. Also, we're going to talk about NASDAQ earnings with the CEO and chair, Adina Friedman. She joins us. Market outlook, as well as their other businesses, really diversifying and making a lot more money.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF. Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
In the close.
Welcome to Balance of Power.
This is Bloomberg.
Stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got.
Here, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential.
The edge. You're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend.
On profit, and this year's biggest IPO, Lineage, also begins trading on the NASDAQ. And of course, there is a lot of excitement, investor excitement for the IPO market to be coming back. The largest On NASDAQ, what does the pipeline look like? Can you say the second half of the year has more room to ahead?
Well, first of all, thank you so much for having me. It's great to be on your set. And we are really, really proud of. We've had 29% growth in our index business and 16% growth in our financial technology business, which of course focus for us. As we look at the IPO landscape and the markets part of our business, we've seen slow. We're coming off of a very tough year in 2023, so we're seeing slow progression. Very excited about Lineage this morning. We're starting to see the investor appetite increase for taking risk with the IPOs, but I would have to say that we still think that it'll be slow progression as we continue through the year. The monetary policy outlook and other geopolitical, factors, I think, are still keeping investors a little bit more risk they have a little bit more risk aversion, but we're seeing some real good progress, and we think that going into 2025, we should see more momentum in terms of the pipeline of companies that we've been talking to.
When you think about the competition ahead in this market as well, do you think that NASDAQ has an ability to gain behind the scenes? Are you out there courting every 2025 potential right now? Years before they go public. So we really focus on the complete life cycle of a company. When they're early stage liquidity with NASDAQ Private Market, we work with them on their governance practices and making sure they're maturing their governance to our IR services before they go public. And then, of course, they go public, and then they become great public companies. But we're talking to companies well before their IPO plans. Markets, they think about NASDAQ. We had a 72% win rate in the quarter. We're continuing to show that NASDAQ.
IT outage a couple of days ago reminded the world how fragile things are. Now you offer a suite of IT services to exchanges to guard against those things and financial. Talk to us about the new businesses that you've diversified into.
Sure, yeah. So with the CrowdStrike challenge, markets and to the entire financial community were not affected. But of course, you can always learn lessons from those types of partners with our clients. We talk to them and work with them around resilience and redundancy and all of the things that manage those types of challenges, or at least prevent those types of challenges, I would say. Now, our FinTech division is where we crime, regulatory reporting, all the core challenges that banks and brokers. And that actually grew 16%, as we mentioned in the quarter. We're seeing a huge amount of demand from our clients sign up for our technology. We had almost 100 upsells and 4 cross-sells, which actually is really starting to across those vectors of risk.
As we look forward to an election in November, how do you think about the outcome of the November election for your clients?
Yeah. Successful in any administration. I think that NASDAQ as a company, we really focus on managing. We've been here for 52 years. We expect to be here for another 252 years. But I think that when it comes to corporates really look for, I think they look for consistency, predictability, and innovation, because that really fosters economic growth. And so regardless of who's ultimately in office, can they create some predictability in the regulatory environment, and can they put in policies and practices that companies in general look for?
I want to go back to what Matt was asking about, these other businesses that are not IPOs. When you think about artificial intelligence, generative AI, where are you seeing the biggest payoff? Because people are investing. So where are the dollars at the end of the road?
Well, first I would say solutions. So NASDAQ has been investing in moving all of our technology solutions into a cloud environment. You're modernizing your data infrastructure, you're modernizing your architecture, and you're making it so that you can bring new technology offense much more quickly. So a couple of things that we've been looking at, that we've been doing. First is in our markets, extended life order, which is an AI-driven order type, the first one that's SEC approved. We've seen a 20%
So we're looking now to the fear and greed index. So they're currently sitting at 40 out of 100, which indicates fear, while the crypto fear and greed index is at 60 out of 100, which indicates greed. We're keeping an eye on the VIX as well. It's up 5% on the day at around 19 points.
Take those capabilities in. So in Verafin, cloud-based anti-financial crime tool, we launched an entity research. The process of researching entities that have generated an alert in the system takes down the time to do that research. Those workflows, and we have a new one that's come out in our investment tool for asset managers to summarize gives them really quick insights into the strategies of the pensions, allows them with their business development to engage better.
Gen AI. Is most of that investment going toward new technology or retraining your workforce?
Well, it's and in the product. So we're quickly launching these capabilities in the product and then teaching our clients how to efficient. But then we're also introducing new tools. So we've introduced the Copilot developers by the end of Q3. But then you have to educate. And so we've been managing our education throughout the year, making sure they understand for where do we see the most benefit. And we've had hackathons. We've had over 650 employees.
So in 10 minutes time now, at the bottom of the hour, we see the release of the weekly EIA natural gas change. Forecast is for a build of 11 BCF on the prior 10 BCF build.
How can we drive new capabilities in the products? And to us, that's a big part of our future.
I want to ask separately from NASDAQ. And we got some pretty stunning GDP numbers in today, 2.8%. We got higher claims than had been expected. What's your view on the economy here, and do we need rate cuts?
Yeah, I mean, at the highest level, quite resilient. Now, we are seeing that inflation is coming down, and so it's coming down in normal. Fantastic, but you are seeing the higher cost of capital start to impact larger parts of the population, and that cost of capital. So that's all of that's an interesting calculus for the goals at 5.5%. You do have a pretty big delta between GDP growth and the cost of there for the Fed to start to think about how do they moderate that and get that more in line now that even though it's really still coming down quite precipitously from last year.
Do rates and IPOs, I mean, is there an from private credit lenders is higher and you might prefer an IPO, and the opposite must be true?
Well, when investors evaluate a company for an IPO, they look at what is the potential future earnings of that business. Cost of capital is higher, they're going to discount the future cash flows more. And so it actually has the cost of capital, the lower value they put on future earnings. And that seen on IPOs. Why has the IPO environment been so difficult? It's because the cost of capital has gone up. Starting to think that perhaps the cost of capital could moderate. That makes it easier for them to I think that could be a catalyst for more IPOs going forward.
It's a whole market working on that valuation. Of course, that is Adena Friedman, Chair and CEO of NASDAQ. And in just a few minutes, we're going to be speaking to the co-founder of Bloomberg.
Welcome.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto. The
Of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only. Bloomberg's surveillance covers the latest in global markets and the political events that influence your world.
So in 5 minutes time now, at the bottom of the hour, we see the release of the EIA natural gas change. The forecast is a build of 11 BCF on the prior build of 10 BCF.
With crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Market's about an hour into the U.S. trading day, and pretty interesting. You can see the S&P 500 again. It's off its percent. Big tech really taking the brunt of the selling right now, off about 0.8% on the NASDAQ. When even bid here, 10-year yields down about 6 basis points at the individual stock level, guys. Particularly in the airlines. You think of American shares currently higher by about 4.5%, despite that. I don't really know how to explain the reversal, but as you can see on the screen right now, American up bigly to steal. Well,
yeah, it's really interesting, and we were talking to George Ferguson, our aerospace and maybe it's about the constrained capacity, because you saw, for example, Southwest say that it's going to take some seats out.
Yeah.
So they've all European airlines, but if they constrain capacity a little bit, then they can justify, I guess, at least holding price.
To the big lanes, if you could charge more, you make more. I think that maybe that's the end of the story.
Supply and demand lessons we continue. Now coming up, we'll be speaking with the co-founders of Lineage, this year's biggest IPO. That's live. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized as a surgeon brought a set of credible things to the table. One, if surgery is not much of our training reinforces that. It reinforces skill, not necessarily emotional awareness and emotional intelligence. What they bring to the table of leadership are three fundamental things. Everything in teams, their operations, their patients they see is
1 minute remaining.
They value process, but they hold themselves very much accountable to execution. They understand you take the tumor out. And then number three, they make difficult decisions on incomplete information. Realized that I could bring to the table as a leader if I had a sort of a passion for working.
Ten seconds. A build of 22 BCF, a build of 22 BCF, higher than the expected build of 11 BCF. And noting some weakness in natural gas prices following that larger than expected storage build in natural gas.
Public in a deal that raised to trade at $80 each. That is above the IPO price of $78. And joining us now, Chairman of Lineage. It's great to have you both with us, and with any IPO that talk about timing. So Adam, I'll start with you because there's been chatter about your company for a couple years now in the public markets.
Yeah, look, we set out to build a forever company. Good long-term decisions. To continue growth at scale, which is what we've been doing, it was just the right time for us to be a fortress balance sheet to go out and continue to bring in the best assets in our business and to invest in our customers.
I want to ask what you're going to do with this money that you've raised, $4.4 billion. You think about Lineage acquisitions over the past decade or so, 75 in just since 2020. Just more acquisitions from you now that you have raised this capital?
Yeah, certainly. We
have posted out the weekly EIA natural gas storage report on the feed for anyone interested.
And we're going to buy the best companies. We're fortunate that Lineage stands for the lineage of our family-owned companies to bring more people into the fold. And so we think there's a really exciting opportunity.
Choppy session for the US indexes here. The S&P 500 just pairing some losses, still down around 0.3%.
In the world of real estate, warehouses are perhaps the hottest place to be looking. What does this mean for your cost of acquisitions? Are you just facing a lot more competition today than you did?
We got it in the industry. We're bringing the sexy back to cold storage. And a couple other people have found it now. Separated from the general dry industrial warehousing space. And we think it's really special to have this fortress balance sheet. Companies create the best assets and then really overlay this amazing piece of technology that our team's built. Really puts us in a unique situation, so we couldn't be more excited about the growth ahead.
Telling us their life's work, their team members, their customers. It's more than just a transaction. Home for the very best companies in our industry. That is our lineage, our family pedigree.
One thing I'm very curious has committed a very substantial sum, for example, to the IPO big anchor investor. People are sitting out there waiting to go public and are finding that those anchor investors in particular help you get the deal done.
Yeah, look, we've been privileged to raise a tremendous amount of equity from. In doing that, we've gotten to know incredible investors on the public market side as well, and so, we've got this milestone. It was really about bringing in the very best investors we could that will be long-term partners for the future. Getting to know our business, really spending time with us, and just want to say thank you to them.
Hey, I wonder how important they are to you. Kevin, maybe you take a stab at this one. Where do you ensure that you have enough?
Yeah, that's a wonderful question. I think it's really unique. We are if you think about our warehouses, they can be large thermal batteries. So we can cool them when power is cheap and turn them off. Reduce the waste in the energy. And obviously with data centers, there's a huge concern about power. And we really see the first warehouse that's completely off the grid using solar and linear generators, our partner at Mainspring. So set up to charge our trucks, and really, you know, we couldn't be more excited about what we're doing to help enable the world.
Adam, when you look forward to the election and the potential regulatory change, do you think that your business would do better if it were easier, for example, to put up cables?
This has been a durable growth business since we've been in it, and you know we've been through different cycles and different. We just do what we do. You know, the food is a global food supply chain. It flows like water. We like to have a view on it being, you know, any different in a different environment here.
People are going to eat no matter who.
Fair point. You definitely need food. And on that note, Kevin, I'll ask you a follow-up. Obviously, the majority of your customers look to the future. Where are you thinking about possibly expanding? I mean, my mind goes to potential blood types of food, such as pet food. What are you thinking about when you map out the next couple years?
Our focus, 90% of our time is focused on the food industry. If you open your fridge or freezer, to say like data centers are for technology companies or cell towers are for cellular industry, we are the food infrastructure. We move packets and food. And you mentioned we can do that in the pharmaceutical space, blood plasma. There's all. So we kind of feel like our growth is somewhat unlimited. And that's why being public and having the best cost of capital our growth.
Really curious on how fast you think you can grow. At the end of March, you owned or had a leasehold of more than 200 temperature-controlled warehouses. Can you double that, and over what time frame?
And so, yeah, look, we think we can continue to grow this business. I mean, since the first warehouse, we've grown our EBITDA at a 48% CAGR. And look, we built this. We've invested the time and effort to have a team that can develop new assets, including brand new, fully automated. Look, we think we're the best capacity provider and the best owner for this industry.
There and Kevin Marchetti of Lineage in the biggest IPO that we've seen so far this year. Right now, as we've had really an up and down day, Abigail Doolittle has a look at some of the stocks that are moving. Abigail?
Or moments ago, I should say, on the NASDAQ 100 down 1%. This after dropping precipitously yesterday, the worst day. This is a three-day view of the NASDAQ 100, and here is that dip down to about 1%, down 1%. Down 4.4%, so lots of selling. Let's take a look at what's driving some of this action for the NASDAQ 100. The reason that we are off of those lows, NVIDIA now at 112 as opposed to 108, but below 118 support. Sub 100, suggesting that the chip complex and the big tech complex from a sentiment standpoint to Microsoft, Apple, and Meta, we're going to have those upcoming earnings reports, those outlooks. NVIDIA, not until the can they do it again, put up another blowout quarter and guide. Until then, it could be a little bit soft. Context of all of this, well, on today, yesterday we sliced below the 50-day moving average. Now we're down. When we had that weakness, we basically went below the 100-day moving average, then back up. However, right now, technically, it does look like there's probably some more weakness ahead. And then finally, Ford, which is having its worst day since 2009. They missed adjusted profit. Investors clearly not liking this one. Also surprised, Katie, this stock absolutely sliced. There's not a lot of support in sight right now.
Yeah, just brutal to watch. I mean, Ford down 18%, not something you see all too often. Bloomberg's Abigail Doolittle, thank you so much. Now coming up, the difference between volatility and risk. PGIM CEO David Hunt warns that investors shouldn't confuse the two. That conversation coming up next. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg covers the world with unmatched reach and resources. From more than 100 breaks, 24 hours a day. Bloomberg. Context changes everything. Are on Bloomberg.
We've seen story after story about companies delisting from the London Stock Exchange, listing. I want to turn that around. I want Britain to be the place of choice to make an IPO, to grow your business. That the FCA put in place last week. It's also why I'm determined to change our pension system.
Bloomberg. Context changes everything. Earnings season is here.
Opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
I'm Menace Credit. And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data. Bloomberg. Context changes everything.
Are balancing election risk with an underwhelming earnings season, but there's still one risk that ranks higher. Out for geopolitical risks.
It may be heightened relative to the longer-term sweep of history. We've actually had a period of real, I would say, moderation in terms of political flashpoints, and it's really been the last few years between the health pandemic. We've started to see these reemerge, and I would say it's more of a getting back to normal than of the averages. I would also say that I think that this kind of summer of democracy, which we're only heightening that as well. So I think we have even more geopolitical risk. And indeed, as their number one risk is geopolitical. It is not what's the Fed going to do. It's not where are we in the interest rate. I want to talk about the heightened geopolitical risk and what that does for their portfolio construction.
Economic growth and the path forward a long term, because you're a long-term investor.
Right.
How that intersects with the politics potentially affect the long-term growth of a Europe, of a Japan, of the United States?
Well, toward, I think, volatility in general, and that's probably the biggest. I think a lot of the popular media confuse volatility and risk, and they're. When I say we have heightened volatility, that actually can spell as much opportunity. The only way you lose money is to sell an asset for less than you bought it for or take a permanent impairment. But simply because market and long-term investors tend to look through those cycles, and they use changes in market level to the increased volatility. Our key focus is, do our clients so that they can move and move in size when the time is right. And I would say that as more into illiquid assets, that liquidity has become a bit squeezed, and a lot of the work we're doing with clients is that they can move when the timing is right.
It's one of the things your institutional investors take a look at.
So seeing comments come through from US Treasury Secretary Yellen says US second quarter GDP and inflation data today affirms that the US is on a path to steady growth and declining inflation. Strong US growth due to Biden-Harris administration's economic plan, with 15.7 million jobs created since taking office. It does note the prices are still too high for many Americans. The administration is working to address cost pressures in housing and healthcare, as well as energy.
Than it was in 2018.
Yellen adds that the US concerns over China's excess capacity and its threats to workers and firms are shared by many at the G20 meetings.
Meanwhile, you then go to Asia, and you find, on the one hand, Japan, which is kind of
Yellen says the global economy remains resilient, driven in large by US economic performance.
Some of the reforms that they've made to corporate governance, and I would say there's more investors looking in than we've had in a long time. And in fact, I would say that Japan has been the leading with China, because many people are now building their plants and building their supply lanes around a strategy much more positive. China, on the other hand, is probably in a more difficult position. We did not see the kind of concerted action that we all thought was going to be needed. So I think people are of consumer spending, which is what's really need to rebalance the economy, but rather continue. So there's no new money at the moment going into China. Then you come back to the U.S. Difficult, and we like to focus on all the problems of the U.S. Actually, productivity has looked, like it's powering through this.
U.S. Treasury Secretary Yellen also noted that we will keep pressing China to change their economic model.
Doing very, very well.
And noting it channels too much savings and too many subsidies into manufacturing, creating excess capacity.
David Weston, meanwhile, take a look at the stock market right now in interesting territory. And Shanali, as you know well,
100 just trying to scrape into the green. The NASDAQ 100 keeping up its losses of about a quarter. Some green on the screen in the banks. That's probably my favorite area of the day today. Steepener in the yield curve here, and of a loan book, and the KBW Bank Index up more than 1% now.
Fixed income fix.
So in 10 minutes time now, at the top of the hour, the US Kansas City Fed Manufacturing Composite Index is due to be released for July. Forecast is -5 on the prior -8. The manufacturing, the saw a prior of -11. But keep in mind as well, we're expecting comments from ECB's President Lagarde at the top of the hour, who attends the Paris Summit 2024 Sport for Sustainable Development, titled Faster, Higher, Stronger, Together for a Better Future, again in Paris, France.
I tell them it's the best investors you can
So in this rebound in the US indexes as well, keeping an eye on the markets, just noting Nvidia shares turning positive after raising a 7% intraday drop.
What we try to do is combine some of our insights from the fundamental business with external.
Good morning. This
Opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Bloomberg.
Let's get to the trading diet. Minister Benjamin Netanyahu will meet with President Biden at 1 p.m. Later on, he's going to go meet with Baker Hughes' earnings, and we round out the week with the Fed's preferred inflation gauge, PCE, out tomorrow. Numbers out tomorrow. And then the University of Michigan, those Wolverines, had their sentiment.
And I do want to quickly mention that NVIDIA shares turning positive. They were down 7%. Now they're in market for sure, and an interesting political scene as well, because earlier today, former House Speaker Nancy Pelosi Kamala Harris for president.
What's your name? It's all over. That's not how Washington should run. Voices will be heard in a very different way than you're trading at the table with big money. It's about the people.
So better late than never. He is the host of the Bloomberg Big Take podcast. He joins us on set, and obviously we all want to know who. We got some news on the timeline that it seems like she has until August 7th here.
Likely when it's going to happen, there's going to be this as the nominee. So that's sort of what she's shooting for in terms of when that might happen. Obviously, we have the short list, a lot of every day who's at the top of that list and not, but she's interviewing them with Eric Holder, the former Attorney General. We'll figure that out in the coming days. And I just commenting on what Nancy Pelosi there said, I think that the reason for her speaking today was she wanted Joe Biden to have the opportunity to give the American people an explanation of why he's done this. We got a little bit on that and kind of situate his presidency in history, had that in that speech as well, but he talked about passing the torch. Now that that's out of the way, I think that she feels liberated to endorse Vice President Harris.
He was on time, too.
Speaking of liberation, well, you had to get to bed.
Yes.
Quickly. Speaking of liberation, does Biden, now that he's not running for re-election, to do things differently in terms of policy, in terms of his support of Israel against in Palestine in Gaza? Does he feel liberated in terms of, the more progressive goals that
in these next 5-6 months, and he was really adamant that he's going to keep working. Of course, there have been calls from all these Republicans for him to step down, that if he can't run, why should he be in the White House still? He wanted to put that to rest. He ticked through all the accomplishments he's he's going to keep working. But on the podcast today, we talked to Nick Wadhams in D.C., and we talked to for this visit, and something we chatted a bit about is is this the moment for Joe Biden to take a big swing? He's had very little success when it comes to scaling back or stopping the conflict right now in Israel. Could he do something here in these next few months? I think it's really interesting to see sort of if something like that may come out of these meetings. So we have Prime Minister Netanyahu meeting with President Biden today at 1. Kamala Harris comes back from Texas to the White House. She'll meet separately with Prime Minister Netanyahu at 4:30. And then, as you said, Matt, he'll go to Mar-a-Lago tomorrow to meet with former President.
So in 5 minutes time now, at the top of the hour, we do get the release of the Kansas City Fed Composite Index, forecast -5 on the prior -8, and the Kansas City Fed Manufacturing Index, so a prior read of -11. Keep in mind, we do see this data released early sometimes, so keep your eyes out for that if you are interested in this data point. Also at the top of the hour, comments from ECB's President Lagarde, who's attending the Paris Summit, Sport for Sustainable Development Conference.
That what's shifted is there are now more undecided
She's going to want to leave
voters.
Netanyahu to Biden, right? She's going to want to let Biden hold that back.
I don't know either, and I think that we don't know enough about her stance on Israel, if it's the same as it was with Biden. We've seen her in past speeches. Palestinians in Gaza suffering as a result of this conflict. So how she reframes that, how she sort of sets the tone with Netanyahu, and indeed what she see. But just to get back to the polling quickly, I think that there's more movement in those numbers now, and that's what the campaign, I think, really wants to take. Donations that we've seen, can she carry that to move higher up in the polls?
All right, David Gura, it's always great to see you. Really. He is the host of the Big Take podcast. We've got to talk about markets right now because we are seeing quite a reversal. We've just about erased that decline. It was down 1.6%. Now we're just back to unchanged. The S&P 500 of 1% right now.
I guess when you've got these big concentrations and these, 3 trillion, any little move is enough to change the direction of the index, right? So in 1%. It had been down at 1.7%, and now it's up.
All right, we're that. Looking ahead to tomorrow on open interest, we've got Caterina Simonetti, Ellen Hazen, and Brian.
The biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So 1 minute remaining for this US data and possible comments from ECB's President Lagarde as well.
Insurers are not good because people say, well, there's going to be more hurricanes. Good because you got to pay a lot of claims.
It depends. I would say it's good because it creates, more prevention. What we see today is that, as I said earlier, there is more events. It becomes more. Therefore, we work a lot with our customers around preventions.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like Bund.
Composite index minus 13, minus 13, lower than forecast minus 5. Manufacturing at minus 12, minus 12, off the prior minus 11. Just getting the short-term US Treasury sales for next week as well. So the US is selling $70 billion in 6-month bills on 29th, settling on August the 1st. And they're selling $76 billion in 3-month bills, 29th. They're settling on August 1st as well, so unchanged from the prior auction amounts.
Saw after GDP data calms the AI rout. Plus, we turn to the micro picture on earnings. And we talk venture funding with the CEO of startup Vanta as it raises 150 capital. But first, we check in on these markets. We check in on what was in market capitalization was erased from the Magnificent Seven on Wednesday, a total wipeout. More broadly, but today, maybe some signs of calm creep back into the market. All after what seems to be a Goldilocks reading on GDP. I'm pleased to say for more is Isabel Lee, who can this market. Before it was all AI anxiety, and now it seems to be more about GDP not as bad as we had worried.
Today, we have GDP data that showed that U.S. growth grew faster than expected, which really just implies that the Caroline, because it was a huge reality check. We saw a lot of superlatives, the S&P 500 and the NASDAQ 100. And I'd like to think that the tip of the iceberg was really the lukewarm start to the earnings seasons. We have Alphabet with bloated capex, Tesla again postponing the robo-taxi, and investors got thinking, when will we see the ROI of these AI investments? AI, yes, is revolutionary, and it really drove the market to beat one record after the other, but it's not going to happen overnight, and I think that's what they're slowly coming to realize.
It's interesting that we've actually had some decent numbers coming out of, well, ServiceNow we're going to dig into a moment. So there is generative AI revenue in certain areas. But the key question has been valuations, right? There are some great quotes in the stories today just being that valuations just became, well, absurd.
Definitely, and this is why yesterday investing in Tesla and NVIDIA actually, but he likes the rest of the Magnificent Seven or the Magnificent Five, so to speak. So it stock pickers market because it's not anymore track the benchmark and see gains. You have to be more nuanced in how you pick, and of course levels of tolerance. They have different levels of entry points, but traders are now really hedging themselves against wild in NVIDIA. It's now rising to the highest level since mid-March, and even premium puts for Broadcom also at 3 risk off. They're more cautious in how to approach this because what goes up will not always go up. It will seeing, but also we have to note that we only saw 2. There are 5 more to go. Microsoft is scheduled to report on July. On after that, and NVIDIA, of course, on August 28th. So it's still a wait and see for now. I think it's too early to declare that.
Options, and the options seem to be small caps. Isabel, can you just talk our tech-focused audience in the broader markets?
Exactly. So there has been a rotation and rally for the whole first half of the year. It's been the mega market higher, but now small caps are shining. We saw a huge rotation beginning actually when there were the softer reports. Going to be a huge sector to watch out for because as the Fed cuts rates, and now it's looking to be September, all called for in June, which is like July rather, which is like next week. Small caps stand to benefit and outperforming for the 10th time in 11 days their larger cap tech peers. And a factor of that is the US. If we see lower taxes, they will stand to benefit. So again, AI is not the only sector anymore. We see other parts of the
They're higher today, and for now, so are the benchmarks, but only just. Bloomberg's Isabel Lee. We read micro picture. ServiceNow actually managing to push away some of the AI anxiety itself by on Wednesday after the bell. Increased sales, bookings up. The company also reported, though, that the president after a probe into the hiring of an ex-CIO of the US Army, Raj Iyer, who had also down with the ServiceNow CEO, Bill McDermott, just moments ago. Take a listen.
I've been blessed. I just every day come to work for our customers. And, you know, we built this AI platform. And in this moment in time, CEOs need to grow their businesses, and they can't do it. They're very complex, and you have to clean up the mess to serve your customers and your employees and your on one common platform with ServiceNow, powered by Gen AI. And the Gen AI revolution is we built it into our platform. And we have something we call domain-specific LLM. The customer's data, we have zero latency in terms of speed because it's the customer's data. So we're able to innovate and build net new innovation constantly. Why our Gen AI business is doubling quarter after quarter, and we're beating and raising. It's a real thrill.
Let's talk about, and I hate to name names, but some other enterprise software companies. I mean, up to be offering generative AI products. Are you worried about that?
It's perfect. I mean, if you think about let's call it departmental solutions. You know, one might be focused on the customer, one might be focused on it's been around decades now. So we use the data in those systems for customers. This new brave Gen AI world on the ServiceNow platform. Because what good does it do? But they are not included in a workflow that deals with the customer from the and ultimately the product that the customer uses and gets satisfaction from. We take the whole you know, it's one thing to have a system of record where, you know, I know my employees and I pay them to recruit them, hire them, onboard them, train them, give them every service that use cases on the mobile so they have a beautiful life. So we just do something different. They do something. Job is to make sure that the customer wins.
Are you taking market share?
If you look at our business, we are the unicorn in the enterprise software industry. I think that today, he basically said that this is an exclusive brand in the enterprise. Unicorn. No one's growing as fast as we are. You know, they say you're world class when you grow at the rule of 40. That 40. We're operating in the mid-50s. And we're not only beating quarters, but we're raising guidance. Because the Gen AI revolution was carefully thought through on our platform, our brilliant engineers, our go-to-market machines unstoppable, and all the supporting functions in our company and our ecosystem to work for the customer. Whether you're in the private sector or you're in the public sector, we work for % loyalty rate.
I want to talk about that public sector and indeed some of the analysts noting happened that's unique to you, and this is in the hiring sphere. And in fact, the president and COO, CJ, largely because of policy violations, we understand. You did a deep dive into what had occurred in terms of the hiring of the former US Army official. Now, for those out there who don't know legalese, who aren't aware, explain really simply what happened and the action you took.
Well, I can tell you what I told the Capitol. Basically, we received an internal complaint. We take all complaints sector entity. We love our federal business, and we care deeply about and all also the service professionals of the United States and how we serve them. We take that extremely seriously. A special committee of the board was formed, along with outside counsel. We investigated all the facts very that our policy was violated, and we openly reported this to all the entities that are and we were proactive with the whole situation. So we have that behind us, hopefully. Those things where integrity and our abidance by strict adherence is just something that we care deeply about in our culture, and we don't grade that on a curve. You know, tough decisions have to be made.
Bill McDermott, CEO of Service with Bloomberg's Brody Ford. You broke down the numbers yesterday. You looked into, of course, that hiring and who had been the head of the Army in terms of digital transformation. What do you make of that? What's the market making of it?
Yeah. CJ Desai, he was a big deal, right? I mean, this was probably the number 2 person capital markets days, things like that. He was thought of as their product leader. You know, usually that's a little more riveting to investors in the immediate because that can mean short-term disruption in sales. Roadmap. So a lot of investors I was hearing from were concerned, but they numbers they saw. So I mean, maybe the CJ departure was not the greatest thing.
So noting the S&P 500 in the green now, up around 0.1%.
Ruffle the sentiment too broadly.
Yeah, Morgan Stanley saying, look, does not expect disruptions. The strength was broad-based across product, verticals, geographies. Gen AI momentum is building. Or are we seeing it on other software plays like IBM?
Yeah, and I mean, that momentum, I think, for slightly open question, ServiceNow spoke heavily about Gen AI helping to fuel the big deal. Super clean number about, hey, it contributed this much. During a capital markets day earlier this year. So it's maybe helping get people excited about the software in general. Is Gen AI? IBM, as you said, they're largely a consulting company. So yeah, I mean, consulting at this point, God, can you help me figure out what I should be buying here? And that's great news for IBM that has.
Yeah, they were specific. They gave a number and they broke it down as to largely that is consulting, but that percentage differences when we were speaking to the CEO just yesterday. Anything else jump out from IBM briefly?
As a consultant, right now, most of those Gen AI revenues are in consulting. Over time, does it go to software? Is ding, 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 IBM. And then over time, they continue to use it, and it helps grow in software. OpenAI models like many others have. That's, I think, what a lot of investors are watching for.
Well, as we head to break, we've been talking about some individual stock movers. Let's look at the broader market. We are being topsy-turvied by the to claw our way back slightly. We're still off by 2.25% over the last 4 trading days of market cap to the tune of $1 trillion yesterday. How much can we push back?
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
In conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
Me, I put everything I had into it.
I get asked more about our relationship than I do my wife.
We talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
The deal.
The deal. That deal. The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
US Treasury Secretary Yellen says higher US rates induced capital influx, boosting the dollar.
Let's talk about the world of crypto. Asset management that he has. Of course, the unit has just raised $113 million for a venture fund, investing in early software, as well as infrastructure and financial applications. The fund expects to continue fundraising to reach $150 million. I want to talk about animal spirits in the world of crypto, how tied they are to perhaps a sell-off. Kavita, I want to just go more broadly to what Bitcoin and Ether are up to at the moment, because they have been dragged lower. Whereas, how much is this an alternative asset class? How much ultimately is it still tied very much to?
I think this market is very interesting because we are continuously seeing got approved, and we saw even on first day a huge amount of money coming into ETF proposed, but at the same time we saw Grayscale ETH ETF Trust actually have. At the same time, we saw Mt. Gox, amazing big $1 billion amount of money getting released, which were locked when they were priced $100 to $500, and suddenly you are getting them at 65, 64. Now within the space are getting more than the inflows, and that's why we are seeing a lot of volatility. Actually did take off, has sort of plummeted because of the crunch of liquidity. Raising money in the space, we are also seeing that a lot of them are keeping their fund open. Not much liquidity in the space, both for equities or for liquid tokens. So it's been interesting.
Adoption within this. I mean, when people are fundraising, looking to back startups, where is the LP money coming from? Of ETFs, the more broad adoption of crypto as an asset class?
I think at different places, in the VC platforms, you are seeing lot bigger fund of funds really coming in multi-billion-dollar funds. But at the same time, in a mid-level fund, or a lot of individuals and individuals like HNIs and big family offices jumping on the ground with it. So we are seeing more and more adoption and openness after the ETF approval.
In its adoption, as you were talking about, but let's bring it back to the United States. How much is their election a Bitcoin event on the weekend?
Yes, I mean, it's fascinating, right? The president rumors that
So in 10 minutes' time
Vice
now, at the
President
bottom of the
Kamala
hour,
Harris
the
may
US is
show
due to
up.
sell $90 billion in 4-week bills. The prior high yield was
Got up
5.27%,
there and
the
called
prior bid to
himself
cover
a
was
crypto president,
2.59.
which definitely has given a huge legitimate life. Whole crypto ecosystem, which 10 years back was very speculative, considered very, very risky. But we least to see whether Vice President Kamala Harris, what's her views about crypto? Because we really over next 2 weeks to hear, is this going to be a continuation of White House or no?
Delta Blockchain Fund General Partner, we appreciate it. This is Bloomberg Technology.
Bloomberg Surveillance covers the latest political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Bloomberg Power Players is back this September as the top name world right here in New York. We'll host some of the most influential voices in the business and identify what happened in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register /Power Players.
Roblox. Well, it's widely for kids, but is it really safe? As the platform is fighting to keep predators away, a Bloomberg investigation may find the subject matter disturbing.
Gaming platforms, all internet companies have struggled with X-rated content and trying to protect kids. Or what's different about this story and this reporting is that we're seeing examples of these where kids are being physically kidnapped, abducted, and sexually assaulted by predators who have connected with them on Roblox.
I've seen so many horrible things. I've seen games that fully simulate sex with penetration, with fluids. There's been predators in real life. There's been predators who have transported children hundreds of miles away to their home.
77 million daily users, and more than 40% of them are under the age of 13.
We're going to be in there looking for victims to procure.
Who's ever seen a room full of underpants, like their avatars?
Some really full-on. It's subtle the way it starts.
What do you remember him saying to you that was bad?
You know, the younger they are, the tighter the hole.
There's predators that will pay children sex acts on camera. And all of this is happening while at the same time Roblox is for children.
We've got to start thinking about how we do Roblox differently.
So in 5 minutes time now at 11:30 a.m. Eastern Time, the US is due to sell $90 billion in 4-week bills. The prior high yield was 5.27%, the prior bid to cover was 2.59%.
You can view the full document. We want to dive deeper into one of the authors of this investigation, Bloomberg's Cecilia de. Incredibly important work that you've done. And some of the statistics are just horrific. Since 22 dozen people accused of abducting or abusing victims they'd met or groomed using Roblox. Grooming coming offline, and what is Roblox seemingly doing about it?
It's under 13 log on to Roblox every day. Parents know it, Roblox knows it, and according to it takes a minute or less to sign up for a Roblox account. And unlike other social media platforms, age to sign in. Also, unless parents go into safety settings, kids who log into Roblox, anybody, any stranger. So we were interested in understanding abusing children using Roblox, and we filed dozens of Freedom of Information requests for police documents that explained how predators were doing this. And, some do communicate over those open chats, abusive acts using the Robux currency.
Right.
One pattern we noticed was that
Cecilia,
and then move them to another platform like Discord.
Saturday is always a day where I power down, so I run at a relative high pace. Is a quiet day for me in terms of work, and I start typically by playing. And we go for a swim all year round. After that, have a nice lunch, and then I'm on to. And then Sunday, I try to prepare for the coming weeks, but through either no emails or very few emails, because I want to drive a culture where I spend the weekend as.
So shortly expecting results of the 4-week bill auction.
I think what we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, your reflection is just too narrow. And I generally believe that Monday mornings, say Friday afternoon, I also take all my vacations. I generally believe I'm a much better vacation than I am before vacation.
Bloomberg covers the world with unmatched reach and resources. Breaks 24 hours a day. Bloomberg. Context changes everything. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in London. Look, we want to get a check-in on the... Let's turn over to Abigail Doolittle. Are we trading higher still?
We are mixed right now, Caroline, but the major day, because at the lows, the S&P 500 down about 0.7%. You can see this index up 0.4%. And that's true too for the S&P 500 yesterday. At the lows today, down about 1.7%. Now up off of its lows, but still down about 0.6%. So let's dig into this a little bit more, because the major stock really, well, not surprisingly, it is NVIDIA. Take a look at NVIDIA around the time of the open, down just slightly, but then yesterday. So that would have been at that point that it was a 14% slide just in 2 days. Reached and now up ever so slightly at about 115. That key technical level is 118. Surprising to see this stock go below 100, basically too far, too fast rally. And the big quarter, we won't know until the end of August. So there will certainly be a lot of speculation, but there will also be some other now soaring up 13.4%. The software company put up a very good quarter. They boosted. There's some green shoots there for Gen AI. And then Tesla, all through the day, this very a bad quarter. I would argue long term the quarter was just fine. They beat
So high yield of 5.285%, 5.285%, with a bid cover of 2.77, 2.77. The US sold $90 billion, awarding 55.42% of bids at high.
Other chip names down. This helps to describe why, even with NVIDIA up slightly, we have down, and then Meta down 1%. It's going to be so interesting to see how this day ends in this negative week and to a third down week in a row. But it seems anything is possible. Stay tuned until 4 p.m.
Yeah. Most in 4 years after they lowered their sales forecast. We dig deep on those chips earnings. Abigail.
Also noting Brent crude turning positive now after falling by $1 a barrel.
Investments is with us, and it's so good. I want to go first to the macro picture. This rotation, this move to small caps, this idea that maybe we've been too high.
Hi, Caroline. Thanks so much for having me. I don't think so, and I could easily be wrong. Small caps, they tend to be a trade more than an investment. And I just went back and looked at performance 10 years and 20 years. And the 20-year, which is when a period when you had index, S&P 500, by 250%. And over the 10 years, they were about half. I think if you expect interest rates to come down dramatically and quickly for all the right reasons, that will be. I just don't think that's the case. I think we'll see a slow decline in interest rates. Many of these companies are highly, and generally speaking, in either index. And so I think for now, if you think the economy's like ServiceNow that have delivered consistent mid-20% growth for the last 3 years.
To ServiceNow, I just want to stay on the macro ideal. And we were speaking with the NASDAQ CEO just a little bit earlier on the show. Whether we're being affected in animal spirits by broader macro policy. Just take a listen for a moment.
The monetary keeping investors a little bit more risk they have a little bit more risk aversion, but we're seeing some real. Going into 2025, we should see more momentum in terms of the pipeline of companies that we've been talking to.
still risk averse at the moment, or actually are we? It doesn't feel like that when we're near all record highs on the.
But also remember that we still have about $6 trillion in cash on the sidelines. So I think their bets on where we're going. We think we're in the early days or the early innings of a new bull driven by technology and generative AI, which we think is sustainable and will drive the world. What you see is that we've hit a 25-year high, and productivity drives earnings, earnings drive stock prices. So from a macro standpoint, the GDP number would indicate that we're slowing. That's always going to be good for risk assets that can generate reliable. No, the data is so mixed, Caroline, and then it gets revised dramatically. So I think you just have to look at information.
Let's go company level. Let's go to what Bill McDermott was just telling me over at Service. And have been in this stock and committed to it, Nancy. What I was hearing from him is, look, our generative AI pipe porter, because of their new optionality and way in which that you can be organizing your workflow. I think it was 70 deals in Q1. They've now doubled that. They're saying overall more than doubled that. Just listen to Bill for a moment on ultimately how real the generative AI hype is. Take a listen.
AI and pretending that they've got something. Ask to see the demo, the use cases. Do you know my industry? Do you know my business? Is there a use case there? And how can I turn value add from my stakeholders to improve the way my company runs? There's a lot of pretenders. We're a winner.
Well, today his stock is a winner, Nancy. Who are the pretenders?
Well, I think, and proving why he's such a great CEO, he's also a great salesman. His portfolio where we do own ServiceNow. We also think that Microsoft is a winner. That may seem super obvious, but integrate and already have integrated generative AI throughout the product offering. I think suspects, I've always talked on your show, we own the poor man's Broadcom, which thankfully we trimmed pretty dramatically. I think they're a winner. I think Dell's a winner. And then I think just application-wise, Adobe's probably a winner. But I do think that the CRM Workday joint venture, and I heard your interview, it was excellent, is indicative of the fact that they penetration into both of their business lines, and they're doing it seamlessly. So they do need to join together, and I think CRM, because we're not convinced they are a winner.
Nancy, it's always good. I appreciate it. Nancy Tengler of Laffer Tengler Investments on where the winners and the losers are right now. Meanwhile, time for talking tech. Giant has participated in new financing for $691 million Chinese startup Baichuan. A leader in the generative AI space in China, and that's as one of the first firms to win government approval for a public. Raising $950 million in new funds. Now, the Singapore data center upstart is finalizing an initial, according to sources. Now, the company hopes to spur growth by tapping into, guess what, the global AI boom. This company says it's received its UK banking license in a move that could challenge traditional banks like Barclays and HSBC. License was authorized by the Prudential Regulation Authority, but comes with some restrictions for the time being. Revolut will UK banks. Coming up, we're going to be joined by Allraise CEO, Paige Hendricks-Buckner. It tells us of the investing landscape for women founders and VCs. Stick with us. This is Bloomberg Technology.
Reporting from our world headquarters in New York, I'm Menace Credit.
And I'm Danny Berger.
Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Changes everything.
It's the countdown to the market.
Stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Opening trade live at 7 a.m. here in London.
Only on Bloomberg. Context.
The top names in tech are on Bloomberg.
It is got intelligence, if you want to give it that, moniker. I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me, I want to be myself. Intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investment.
Ecosystem of companies coming together, it's causing a new industrial revolution.
Nobody Context changes everything. It's the world's second largest economy with a deflationary pressures and questions about foreign investment linger. Bloomberg, The China Show, brings in-depth market analysis and the most influential newsmakers in and around China. Bloomberg, The China Show. Hong Kong time, right here on Bloomberg. Context changes everything.
Treasury 5 years faster than a key advocacy group that's always expected. Still, leaders equality and inclusion initiatives, but it's now threatening the progress that has been made. Let's bring in Allray's CEO. This report has, the highs and lows. Let's focus on the highs first of all, because you non-binary decision makers, check writers in VC than perhaps you anticipated.
That's Raise as an organization that has been committed to propelling the success of women and non-binary investors. And what's really exciting is we've seen progress, as you said, we've seen a doubling, so from 9% to 17% decision makers in VC firms. And for the amount of funding going to women founders at the earliest stages, percent. And so now we're excited to see that it's up to 27%. So like you said, big opportunity here.
Meanwhile, though, the pendulum has swung on a DEI perspective. How is it affecting the amount of women non-binary being invited to write checks, being invited to VC superstars when we're thinking about, say, the latest AI company that everyone wants?
Community members are out investing. And what we also know is that firms who are part of the Allray's community, and it's exciting because if you look at the data, what you discover is that of all of the firms, makers at the table. And so what's exciting is that the data's there. We just need to continue to talk about that story. What really excites me is that when you look at venture capital firms who increase their hiring of women partners by just 10, average spike of 1.5% in overall fund returns each year, and they had 9.7%. I think that there's a really big opportunity for us to not just talk about the data, but also tell the stories of the check writers who are making our community.
Of course, all of this comes in the context that it's been a really hard environment for venture. And I'm interested as to whether or not we are seeing more diverse VCs, ultimately meaning we're backing more artificial intelligence. Bloomberg, for example, just shone a light on what they see as some of the 10 must-have companies at the moment in AI, but none of them were run by women or diverse founders.
Is that some of the biggest funds that were raised by companies with women-led teams at the top of AI teams. And I think there's an opportunity for us to continue to grow in that space. That's actually about talking about the people in our community who are making investments in AI and who are experts in AI. So the second part that I want to bring up as well is that when we look at diversity on the founder side of the equation, who writes checks as well. And there's some really great research that says female partners invest in 2 times more stages. So there's a great opportunity for us to continue to lean into diversifying teams so that we see and healthcare and education and more.
Love the data you bring.
We love
Thank you, Paige, for bringing it. Paige Hendricks-Buckner, Allraise CEO. Great to have you. Because leading trust management platform Vanta recently raised $150 million in a Series C funding round, sending dollars. The company plans to use this funding in part to work more in, you guessed it, artificial CEO Christina Cassiopo. Thank you so much for joining us, Christina. Look, you raise money, the artificial intelligence and basically making what more safe trust. How are you going to invest in it?
Yeah, we're very excited to take this new money and invest in new. So a big part of what Vanta does is replace manual GRC and risk. Teams running those at companies take advantage of all of the information within their companies, but synthesize it. Think about what AI and LLMs are really good at. It's basically that, right? It's taking a bunch of information and one. We started making some really heavy AI investments at Vanta. We've already shipped a few products to customers that they're really enjoying. We're excited that the new funding allows us to kind of double and triple down here.
What does that investment look like? Is it compute? What is it that you need to invest in?
Yeah, it's a great question. It is I talked to other founders of AI startups in San Francisco. It's a combination of engineers, and I think we talk a lot about that. Again, it's also subject matter experts, and so for us, it's security professionals. Well, and then it's that pairing of engineer and subject matter expert that really helps us.
Christina, boy, like you were founded in 2018, all after breaches. Data breaches keep happening. Doesn't AT&T know it? I'm really interested as to how you're finding.
We are, and I think the data breaches that keep happening, like you're talking about, there's a lot of skepticism. There's also a lot of optimism. But I think what we see is overall tech companies and Vanta was really founded to help tech companies sort of restore some of that trust in a real way, right? What to do with trust management is implement best security practices and then demonstrate to their customers kind of assurance and trust that the software they're using is built in as trustworthy and reliable.
Christina, it's been great speaking with you. Thank you so much, Christina Cassiopo, CEO of Vanta. Coming up, the NBA has just announced an 11-year-long broadcast contract with Disney, Comcast, and unable to match that Amazon offer. We'll get more on that story in a moment, but first, let's check in notable names that continue to be volatile. Look, Nvidia sinking once again. ST Microelectronics over in Europe, cutting their annual revenue outlook, blaming depressed demand and inventory glut, lower sales to car makers, in particular Intel off by 6%. We're still questioning those valuations and the AI hype around some chip names. This is Bloomberg Technology.
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you...
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Spesso non lo sono.
These are the holders of truth and justice. But then they are. They are. And the evidence is there. It's overwhelming.
DOJ or other authorities
Could face bigger challenges. Britain's next.
Fed was going to keep
Economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond. Morning, this
your agenda. Taking you from the U.S. markets close to the overnight session in Asia. We'll start the European trading day. Live from our European headquarters, we bring you the day's top market. Weekday at 6 a.m. London time, only on Bloomberg Television.
Let's go to another European stock on the downside, Universal. The decline in streaming revenue, marking the biggest decline since the company's IPO in 2021. On YouTube and barriers with social media platforms like TikTok, Facebook. Music, but sport, NBA, announcing long-term TV contracts with Disney, Comcast, and Amazon. The media giant was unable to match Amazon's offer. The new contract is expected to generate $76 billion in fees. Randall Williams, I'm pleased to say, joins us for more. This was a real tussle up until the last minute.
Absolutely. They had an exclusive negotiating period where they had an opportunity to be a partner, and they couldn't match a NBC or whoever they'd wanted to match, and evidently they tried Amazon. The NBA said no yesterday, and rather quickly.
For what reason? I mean, obviously money talks, but they must be thinking that there's a viewership addition here.
Three reasons, and I want to make sure I get them right. But number one is that TNT, when they matched the offer, they wanted to cable network and its streaming service, Max, whereas Amazon is just a full-fledged streaming service. Second, the NBA believes 3 years of its deal up front, while Warner Brothers Discovery came in and tried to get a line of credit. It reached out to its new partners. They wanted a streamer, and they got one in Amazon.
Just very briefly, what does this mean for Amazon? What does this mean in terms of other sports rights?
They have Thursday Night Football, and now they have the NBA. They have a lot of docu-series as well, and so this is the beginning of a new era. If you want to watch the two biggest media sports deals, you're going to have Amazon.
We so appreciate it.
Thank you
so much.
Thank you for having me.
Now, that does it from this edition of Bloomberg Technology. Want to forget to digest it all. Our CEO interviews, the earnings, the questioning of AI hype. Terminal, as well as online on Apple, Spotify, iHeart, wherever you stream.
So we're shortly expecting the Freddie Mac mortgage rate stats for the week.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Tech. You're watching the close. Welcome to Balance of Power.
This is
wrong. It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm
Insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street. Television and radio. Centralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto.
Shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be part.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be
only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait.
It's exciting.
Nobody covers earnings like Bloomberg.
US 30-year fixed rate mortgages little changed at 6.78% for the July 25th week from 6.77% from the prior week, and according to Freddie Mac.
Bloomberg Markets, I'm Shonali Bassick. Investors on a wild ride this week. We see cracks in the tech markets now. The S&P 500 had been fluctuating throughout the day. You are watching it seep into the green. Higher though. The NASDAQ 100 also now in the green firmly, about 0.2% higher. 1% lower still on the day. Two-year yields, however, now down another 2 basis points off that strong GDP data this morning and a day ahead of that PCE data, of course, the Fed's preferred gauge of inflation. We're going to get a closer look at the market here with Abigail Dillon.
Well, it's been a wild day, as you were just mentioning, Shelley. At the lows, the NASDAQ 100 down 1.7% this after yesterday having its worst day since 2022. The big movement that we're seeing here from a micro level takes slightly, but at session lows down almost 7% after falling 7% yesterday. We are seeing 0.5%. What makes this so interesting, the stock well below a key support level of 118. So this suggests that investors are really awaiting that quarterly report, but at the end of August. So there's quite a beat and boost in such a big way. That AI story is there. Let's take a look at some movers on the day. A little bit of that bull. Up 3%. Interestingly, throughout today's volatility, Tesla after falling yesterday on a somewhat mixed up all day, about 3%. ServiceNow up 14%. Very strong. And AI. Microsoft, this is one of the stocks to the downside. This is one reason that stocks aren't though, and currently joined NVIDIA trading to the upside. From a macro level, though, something that's been interesting. Yen has rallied. The Canadian yen has rallied. If we take a look at a 4-day chart, we are going to see that the dollar yen that Canadian yen is a flight to safety. In the carry trade, that the cheap yen is no longer as to why NVIDIA dipped down when there was less cheap available, and now that the yen is coming off of its lows, it creates the opportunity for investors to have a little more liquidity. I think we're having this flight to safety. Of course, too far, too fast, but election 20. Because the VIX relative to 2024 has been a great tell all along this year. For much of this year, including out of the assassination attempt on Donald Trump, on President Biden, and then Kamala Harris, VP, stepping in. Lots of volatility. Who will be in the White House next year? In other words, who will win in November? Volatility.
We're going to talk a lot more about this hour. Abigail, thank you so much for your time. And on the economic quarter, but moderating still from last year. It's a positive sign for both the Fed and the Kamala Harris campaign. We're going to discuss this with Guggenheim Securities co-chairman Jill Stein. And Jim, you're very GDP numbers. You have to wonder what the pain looks like under the surface. Where are you seeing this?
Look, the economy, obviously, by these numbers remains very strong. Growth, continuing to take a look. Definitely having an impact in the corporate sector. Borrowing, I think about corporate borrowing, right? Borrow for a 5-7 term. So you had very low interest rates, at the pandemic. And then, since the Fed began fighting inflation, higher interest rates, the sector has changed. So you have, 20% of the S&P 500 or less than its debt service. As those corporations now seek in a much higher interest rate environment, we are seeing an uptick in restructuring activity.
Talk about this a lot. It comes to small and mid-sized firms, but this is true also for the S&P 500. The risk, especially when you see how much money is floating right into bonds.
No, I don't think. With it, it's obviously with what is it, the magnificent 5% of the total market capitalization of the publicly traded securities. I mean, you've got a very robust technology sector, but underneath that, the broader economy, there is this impact of interest rate policy is real.
Quickly, the conversation will turn even more strongly to that November election. What is between Kamala Harris and Joe Biden, and how that feeds into policy into the markets?
That campaign is new initiatives the vice president may propose, but you have to assume it's going to be historic programs that President Biden achieved, on infrastructure, on climate. It's been the most. I mean, he says this, and I think in terms of shifting the direction of the economy in my lifetime.
The steepener in the yield curve is a Trump trade.
I don't continue to show a slight lead for President Trump, or former President Trump, over the Democratic. 100 days to the election, that's a lifetime in politics. So I don't know whether it's a Trump trade or greater concern with the federal budget and the federal debt. Is now the second largest category of spending for the federal government after Social Security. Look at the federal budget, the things that the Congress argues over. Number, we spend $6 trillion a year. The discretionary budget is $1 trillion of that $6 trillion. In so-called mandatory programs, that's what's driving, our deficits. And they're tight on either side of the aisle to deal with the mandatory part of the budget. Steepener may reflect the fact that there is no appetite to deal with a federal budget that is really out of balance.
Under a Democratic or a Republican administration, you still have that debt problem ahead. You don't have any future President Trump if he were to win in November.
Well, let's first talk about the reining in of spending, right? So the Congress of the United States, in their infinite wisdom, under former President Trump in his last year, created $4 trillion of new spending to deal with the crisis in the United States. That spending those programs had that is now winding down. So we were spending, $7.4 trillion in $0.2 trillion. So that pandemic spending has come off, and we're now dealing where we're collecting, $4 trillion in revenues, mostly from individuals through income taxes, Social Security taxes, constituting 85% of revenues. We collect about $4 trillion. Pandemic spending now abating. And that structural deficit of $2 trillion, I think that's of the curve.
Well, what's fascinating too is even if you had President Trump or former President Trump able to really extend those tax cuts once they expire, there's a lot of skepticism that could happen.
Now say revenue's got to be on the table because they're just, unless you really want to take care and Social Security, there's not a lot left in the discretionary. Or you could eliminate the Department of Education, as you hear the Republicans say from time to time. It's a drop in the bucket. But in terms of changing the trajectory of the federal government's deficits, it's not a.
Of course, a steeper yield curve might look pretty, but it has some dire implications. That is Guggenheim Securities co-chairman Jim Milstein. He's sticking around. Now, we're going to talk next about Jim's pitch for a federal program to finance new home construction. It's a big topic of discussion, especially today. Stick with us. This is Bloomberg.
Why does this business model work? Because it's virgin space. And it'll never be done again. When you step back and you look at golf through institutions as being the way it has been for. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's when you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision. They're going to get there.
The names that move markets are on Bloomberg.
We've seen story after story about companies delisting from the London Stock Exchange, listing. I want to turn that around. I want Britain to be the place of choice to make an IPO, to grow your business that the FCA put in place last week. It's also why I'm determined to change our pension system.
Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. I want to take a quick check here at the flagship mortgage operations here of New York Community Bank. You have Mr. Cooper shares now still plunging really more than 6%, almost 7% on the day. Of course, worries about selling off a subsidiary dealing with residential mortgage servicing. Now, this all ties Guggenheim Securities co-chairman Jim Milstein, who has pitched a new federal program to provide mezzanine financing. Out this plan to our colleagues in an Odd Lots podcast with Joe Weisenthal saying that it was probably episodes ever. How do you plan to really restart this housing affordability crisis?
I think we are in a serious affordability crisis. We have, depending upon which economist you talk, 5 million shortfall of supply of housing units against the demand that's there. So when these markets price appreciation, and that's what we've seen since the pandemic, house prices are up 20%. The long term, over the last 200 years of American history, house prices appreciate on average about 2%. Appreciation as well, because there's such an imbalance between supply and demand. And so, because of the move of various people during the pandemic to Austin, Austin had a surge. And now rents are softening because the market is coming into better balance. But that's not true in many parts. Enormous shortfall in housing availability.
What you're pitching is sort of a capitalist dream in the sense private partnership of sorts. How do you, though, encourage builders to get into the places that matter? Yesterday about how the real estate market is broken for everyone except the ultra rich. Affordable housing outside of a city in particular, how do you encourage people to build in those areas?
Well, you got to break the because if you have excess supply, it'll affect the housing costs, both affordable, middle, and high end. You know, as middle income, that creates availability. It creates availability. So my idea, and I'm not in this, there are a number of people who think this is a needed federal program, is to financing. Typically, construction is done 60-40, 60% senior debt, 40% equity. The idea and allowing the equity to be slightly more levered.
Through Fannie Freddie.
Well, it could be done. Could create a new financing bank, or they could authorize the Treasury Department's federal financing bank to do this kind of Fannie today. It could be reauthorized by Congress to have them do it across the board.
Well, this brings up another mortgage, bond hedge fund sent out a letter to investors pretty recently saying that they believe under a future Trump administration. Yeah. How do you think that works?
Well, look, in terms of the government's intervention on September 8th, 2008, the government created a conservatorship, put $192 billion of taxpayer money into them to stabilize their financings. More than $300 billion back on that investment. So the taxpayers have been repaid handsomely, but they conservatorship and have done for the last 16 years. Former President Trump, during his conservatorships, there was a real effort made, but he lost the election and they ran out of time. That if he were to be reelected, he would try to end the conservatorships again.
What else would change?
Well, the biggest change would be, instead of being controlled by the Treasury Department and the federal, in effect, their equity in their board of directors.
I mean, in the economy under a Trump administration.
Well, the Republican platform has been published and is out there. The former president, tariff on all imports in the United States. We import about $4 trillion worth. That would be a $400 billion increase in the price of goods and services coming into the United States. And, well, it's a price increase. Tariffs are ultimately paid by the consumer. Now, I'm not an economist, but economists, say that would have an inflationary impact. The other is, the largest deportation program in American history of he talks about 15 to 20 million people to be disruptive of labor markets, and that could be inflationary, right? If you have fewer workers or the agricultural fields or food processing plants or restaurants, and that could build in some significant inflation as well.
Jim, we thank you so very much for your time as well.
Okay.
That is Guggenheim Securities co-chairman Jim Milstein. Now, coming up, we're going to continue the real estate with Sean Heher of Trinity Investments. Stick with us for that conversation next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. From the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear
across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what was going to
than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg.
Continues to suffer, and so you take that with a rate environment which is higher for long. It's just math. We have not yet lent to regular way office buildings in the United States, right? And one of the questions I got, right? And so it's hard to have conviction to go in and do that.
This is Bloomberg. Was BGO's Sonny Kalsi. And right now, Bloomberg's Abigail Doolittle is with Trinity Investments managing partner. Stress surrounding commercial real estate, especially one area that might be standing out amid all this concern.
It's been about a year since we last spoke, and you, of course, know Sonny, larger than life. His assessment there, and he was very honest with us yesterday, the good and the bad. So starting off with the good, and we'll return to it in a moment. But when we spoke last year, your assets under management, about $5 billion in luxury hotels around the U.S. Added a property in Europe, now $6 billion. So in this environment, you are actually increasing assets in office. Are there ripple effects? And in terms of this slow-moving crash through real estate, so many people are trapped. What inning are we in?
Well, thank you for having me, Abigail, and I feel honored to follow Sonny. But, you know, I'm a hospitality investor. I've had experience in other asset classes, but I'd say hospitality, we've had the benefit of being able to release every night. So we've been able to adjust prices dynamically, both on the room rate side and food and beverage. In addition to that, we typically trade at wider cap rates. So if we're typically buying at a 7% cap rate and interest rates are now 8%, there's slight negative positive leverage. The other asset classes are tougher, where you're buying at a 4 cap and used to be fixed rate loan to make the math work. So we feel privileged to be with the type of assets we're in our asset.
Office and other areas of commercial real estate could take a little while to work through this.
It is tough, and the one thing I've learned COVID is the power of relationships. So we've been able to acquire assets through our relationships with the hotel. We've been able to continue to finance our acquisitions through our relationships with the lenders.
We'll talk to you had just refinanced the Westin Maui, which was no small feat. What is that environment like right now? Are you able to get areas aren't? What is it about your company and hospitality?
Yes, thank you, Abigail. So we've the financings or refinancings over the last 11, 12 months. Again, it's back to relationships. And again, it's of assets we own in the markets where we are. So we're disciplined about Florida, Texas, Arizona, California, Hawaii. They're all destination type markets. These are all assets that are sort of 400 rooms and larger, more disciplined with the brands who have been strong partners.
And what are the travel trends like? It's interesting. American Express reported recently sort of a mixed quarter, but they were talking about spending being light in soft areas of discretionary. Are you seeing that enter the overall travel picture, or is it pretty strong for your properties?
Well, I'm watching Now, I read a statistic today that Jan Freitag put out that luxury had a 9% demand. The economy end of the hotel segment, I think, was about a 2% drop. So we're in the right segment. New York the weekend before July 4th, and that Friday was one of the busiest travel days in the history of the country. So.
Yeah. Well, I'm so happy for you for all of your successes, and we'll look forward to speaking with you again. Sean Hare, Principal of Trinity Investments.
Absolutely, Abigail. We thank you so very much for your time. That is, of course, Sean Hare and Bloomberg's Abigail Doolittle. So joins us for a large conversation about a big deal.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. Platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5.
I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereal. Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company, where we treat all the
of pets is actually the biggest driver of pet food and pet treating growth. It has, which is the core thing that most households where most of the dollars go against the pet. We start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets. Global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently, and Europe playing out all over the world.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else.
Welcome to Bloomberg Markets. I'm Shanali Bassick. Stocks, what a wild session it has been. You're looking at the S&P 500 now up at about 0.8% higher nearly, and you're looking at a 2-year yield here. 440, I believe, and you're looking at a 10-year yield at 420. Economic data that we have seen out there, but really the bond market moves really starting to moderate on the day ahead of that PCE side. Ford is having its worst drop since at least 2009 on a closing basis. On a 2020, it comes after it announced a second quarter profit that fell short of estimates, and it lowered its vehicles. Ford attributed the results to quality problems with its vehicles that led to a surge in. Again, on those New York Community Bank shares, also down after credit losses were worse than expected. There are still concerns. The company's CEO works to transform it into a, quote, relationship-focused regional bank. High-grade issuance for July is nearing $100 billion. Blue-chip companies like Occidental sales to the fastest rate for any July since 2017, as borrowing costs trending downward since elevated volatility this week, yet you have had both bond markets and equity capital markets wide open. Search in the bond market. She joins us now. What is the risk appetite out there right now? Because it seems pretty.
Hey, Shonali, thanks for having me on. Yes, risk appetite has been insatiable in the corporate bond market. Deals. We had Occidental Petroleum coming, selling $5 billion to help refinance a bridge loan it took out. What was really interesting, though, was United Health's $8 billion deal for a refinancing. You don't typically see people in one slug. That was the fourth largest deal of the year, and it was received very well by. Even though we're in the summer period where corporate bond sale issuance typically tapers off, we're
of demand in credit markets. You're seeing high yield bonds getting a bid, and there was this fascinating column on that the real Trump trade is a high yield bond. Is it true?
That's what my sources are saying. For many reasons, and a big reason why high yield would be advantageous in a red sweep. So not only side as well, and that's because, well, one of Donald Trump's main platforms is to lower of the weaker corporate issuers in the U.S. junk bond market. It would help them shore up their financials and their fundamental tariff and protectionist policy attitudes that would help a lot of high-yield borrowers.
Olivia, always with the next hot trade. That is Bloomberg's Olivia Ramonde. We thank you so much. Now, investing. We've been talking about it. It's been a very hot market for private lenders right now. And Discover sold its private student loan portfolio to investment vehicles and accounts managed by KKR and Carlyle. We're going to discuss strategy solutions, Akhil Bansal, and large deal we were looking at here, $10 billion like this are out there in the market. Can you imagine another one like this getting done even in the next 6 to 12 months?
More representative of this shift of lending away from traditional deposit-taking banks. If you look at how many assets are residing on those bank balance sheets, it's trillions of dollars. And so even I think it's actually a tip of the iceberg of the amount of high-quality lending that resides on the private markets. And it may not be only portfolios that exist on the balance sheets today, but it's also about the future lending. That's another area we're very active in.
Pretty fascinating, because even beyond the banks, this was a large credit card company as attractive to you.
When you think about private student lending, it's just a very attractive. A lot of these loans are co-signed by parents, so you have not only the student's credit to look to, and the fact that the person you're lending to is getting an education, that makes that borrower education have higher earnings, they're more recession resistant, and so those are very attractive credit attributes. Portfolio, and I'd say private student lending more broadly.
So you were talking about this multi-trillion-dollar opportunity. Talking about what other types of assets are interesting to you? Yeah,
I think we're really focused on really high quality. We We have some really thematic views at Carlyle that we're expressing that through. For example, we think that a recession-resistant cohort of population of borrowers to lend to, we think that the homeowner has been very much insulated in this inflationary environment because 40% of inflation is your mortgage. You've been really insulated from that, and in fact, you've benefited from the wage growth you've seen. Things like residential solar, which aligns with the deal we did earlier around SunGauge that we talked about. Mortgages, where people don't want to refinance their first lien mortgage, but are still take money out of.
How do you scour the market for decent credit quality? One thing I've been taking a look at here is for residential homeowner there getting a loan or a auto loan borrower. 770 or above, sometimes above 800 in FICO. How do you think about the quality of the discover?
Yeah, we're always looking for Carlyle where we have an information advantage. FICO score. It's about how can we use our platform and the breadth of it to actually buyer of those pools. And Discover is a good example. We have a portfolio company called Monogram. That company has a 30-year proprietary data set on private student lending, as well as many other capabilities on student lending. That gave us a real edge in that asset class, and I think that's how we try to approach the market.
Of the giants like Discover. If you're talking about a regional banking kind of opportunity here, right? Community banks sell a large asset to a non-bank. What types of assets would quality as firm there as it is elsewhere?
We are seeing regional banks of loans, and what we're seeing them frankly focus in is on the higher quality loans, because that's where they can get something that's more challenging and where they're going to take a write down and a loss and create a hole in their equity balance sheet. So there is consumer lending, small business lending, equipment and finance lending. That's all high quality that
resistant. You're looking at things that can kind of make it through the next cycle. More and more people are worried about a recession data this morning, but you're seeing a slowing of the economy more broadly. How do you feel about the risks out
there? We have to be cognizant of the risks, and one of the big risks of our strategy is the risk of credit losses. I think we're seeing a tale of two. Higher quality, a higher income, more assets, own their home. That bar where we're seeing the stress is actually down with the less credit-worthy type of borrowers.
Okay, we thank you. Bonsall on the heels of a massive deal. Now coming up, we're going to talk about Royal Caribbean the pandemic. We're going to discuss the strong demand we're seeing in the travel sector and the risks out there with the Liberty. Stick with us. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a Dean, who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon to the table. One, if surgeons have a measure of emotional intelligence, not much of our first is skill, not necessarily emotional intelligence, but if a surgeon has some self-awareness, table of leadership are three fundamental things. Number one, they do everything in all team focused. Number two, they value process, but they hold themselves. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. They make difficult decisions on incomplete information. Those things I realized that if I had a sort of a passion for working with people and had some sense of self-awareness.
What is the key to being a really good investor? And I tell them it's to surround yourself with and work with. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing
business with external and data set signals. And I think that's a lot of times where the opportunity is.
Bloomberg Surveillance covers the latest in global markets. Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg Markets, and I'm Shonali Bass. They're up around 20% this year. They're under pressure today, and it comes despite being the first cruise operation. Profit outlook for the third time this year as it sees record demand. Analysts, though, are concerned that the growth will slow. And we have the perfect person, of course, to talk about it. That is the CEO himself, Jason Liberty. Put up a dividend and raise your forecast. What do you say to investors today?
Yeah. Well, I don't think we can really understand the reaction to the share price. And so I always say, which is delivering the best vacation experiences in the world. I think clearly we've been doing that, and that is producing record earnings in the second quarter. We significantly outpaced our expectations year even further, raising our guidance for the year. Our year-over-year earnings per share. As you mentioned, we reinstated the dividend, and we've talked about very strong demand as we're at full load factor on our business, and so it's really being all driven by price. Is that one of the big drivers on the price side is that we still trade at a
The Fed bids for 7-year notes total $2.4 billion.
Small sliver of the $1.9 trillion travel industry, and we wake up every day and make more share and close that gap to land-based vacation.
Do you think investor expectations are just for rapid growth here? Because you get out of the pandemic, people are very excited to get back out there and travel without any sign of a weakening consumer. How do you gauge that fear?
I think sniff out is a really good phrase to use. Is they're trying to find some type of crack, and of course, we're for this year, our yields are 25% higher than they were in 2019. And so a lot of it is just the comparables, that there's a reality of a level of normalization in our business. And so I think for us, we because they keep trying to sniff out that and they're not seeing that in our, it's a little bit of a conundrum for them to try to figure out, why are we not seeing this in cruise? And I just go and I point, we used to trade at a 10 or 15% discount to land-based vacation. The industry probably trades at somewhere between 20 to be able to go out there and close.
Let's talk about pricing as well. How much wiggle room?
Well, we have through the course of this year. I mean, when we entered this year, we expected our yields to be up about for the year, and that's all driven by price, and some of that has been close-in demand. As we're taking in new bookings, which we get to see each and every day, the willingness for our guests to pay are very welcoming to them. They're willing to pay it, and they're also willing to book much further. So we have, our visibility is building more and more for 25 and 26, and also they really want to have on the ship. So we see a lot of pre-cruise sale bookings, and we know that if you book with us before you get on the ship, $1 again when you're on the ship.
To that end, how does 2020 and how much price pressure could there be on the upside?
Well, from all that we can, taking 25, 30, 35,000 bookings a day, depending on the day, we see the cash register ring. And what we see is a consumer that is continuing willing to pay more money and to really capture the experience that they want to have. So we feel really good, and our brands are just so well positioned. They're the leaders in their segments. There's a flight to quality, and we're focused on this concept of deliver a lifetime of vacations, and that seems to really resonate well with our guests. And now that we have combined our loyalty program, that's really giving them a great reason to make sure that that experience.
I'm really curious about how you think about this macro story as well, Jason. You look at inflation, there are signs that it's starting. The expectation for interest rates coming down later this year. What does this all mean to you at the end of the day? Is it helping you? Is it inspiring you to maybe take on more debt if rates do come down?
We've now gotten ourselves back into more or less our pre-COVID balance sheet. We got a little bit more work to do. But I think for us, lower interest rates obviously can free up, some of the credit. Yes, but I think, Shanali, one of the things that we look a lot into when we think about macro trends to our customers, right? Our average customer for our Royal brand, has household income somewhere between 110 to be homeowners. They have pretty strong balance sheets. They have great jobs, and then of course as you go up the $50,000 to $400,000, a lot of that is passive income. And so when you look at that customer who we're addressing, and their willingness to spend and their willingness to plan into the future, seems to be very.
Jason, we have to leave it there. That's Royal Caribbean CEO Jason Liberty. Now coming up, OneStream's company could be an outlier because tech IPOs are getting harder and harder to appeal to investors, but that doesn't year's largest listing today. More on the IPO market up next. We'll talk more about it. This is Bloomberg.
So in 10 minutes time now at the top of the hour, a US due to sell $44 billion in 7-year notes. So the prior bid's cover was 2.58. The prior high yield was 4.276%. So today, Treasury yields are lower by kind of 3 to 7 basis points across the curve ahead of this sale, which is suggesting that it would draw the lowest yield since at least March. So the auction sector has underperformed in this month's rally, driven by signs of weakening economic data and mounting expectations for Fed rate cuts beginning in September. of the last coupon auction until August 6th follows mixed reception for the 2 and 5 year sales earlier this week, though both have risen from their auction levels since then. As it is noting the latest CFTC positioning data, which shows that speculators were net short 637,000 10-year note futures, a possible source of covering demand at the auction.
For me, I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actually,
I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a time. It's great now to see other people using it and seeing what some of the challenges are.
to stay ahead in science and research.
You have an ecosystem of companies coming together. It's causing new
to technology like Bloomberg. Context changes everything. The Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being
Bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff?
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance. The Fed decides.
Ollie Bassick, and pour one out for the deal makers. We're looking at investment banks today. Evercore stock jumping to the biggest degree since March of 2020 with a more than 11% gain. Moelis also rising. Lazard hitting a record first half revenue under new CEO. That's all amid what they hope is a continued investment banking rebound and a rebound in capital markets. Remember that the sharpest tech sell-off in nearly 2 years is threatening to make sell for investors, but there are some significant outliers. Shares of fintech platform One controlled storage and logistics giant Lineage, going public in the biggest IPO of the year. All of this, she joins us now. And you think about the fact that we had a major sell-off yesterday. How much demand is there for IPOs in this market?
Well, it's hard to actually say because Lineage is because it has run up so much. And then if there's anything, I would rather kind of look at OneStream. Yesterday was the kind of demand for it was strong. But then what we've heard when it was about to price was $20 more than what it went for. It went for $20, which is above the range, but it could also be up.
It's been 5 minutes time now at the top of the hour. The US is due to sell $44 billion in 7-year notes. The prior bid to cover was 2.58. The prior high yield was 4.276%.
We know, as you've been saying, the interesting thing about Lineage, not a tech company. Do people want things than tech in this market?
And also it's very interesting that the two biggest or three biggest so Amer Sports and also Viking as well. So this stock in particular, and also is a very interesting stock in itself, right? Because the only other listed peer is just Americold. Kind of unique environment segment of the market that people are trying to diversify into. Huge as well. And then, so yeah, it might actually go into a lot of the REITs index. Yeah, put money to work in things like this.
fascinating too. You're seeing that 5% pop at the open of IPO market as part of the frustration here that the pipeline is just not that big for more deals.
That's probably true. And also there are quite a number of companies that probably should have gone or still eyeing time frame, might not even go. So the timeline is, the pipeline is very fluid at the moment.
It gets even more attractive. That is Bloomberg's Amy Orr. I'm Shonali Bassick. That does it for Bloomberg. Next, though, FTC Chair Lina Khan joins Balance of Power. Certainly the woman.
Bloomberg Power Players is back this September. Court over in Queens, we're convening the best of the sports world right here in New York. We'll host some of the and identify what happens next for players and fans in this multi-billion-dollar global industry. BloombergLive.com/powerplayers.
With unmatched reach and resources from more than 120 countries, the moment news changes everything.
So we're shortly expecting the results of the 7-year note sale. The Treasury's pre-sale when issued yield for the 7 years comes out at the top of the hour. The auction results often follow a couple of minutes after this.
Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Context changes everything.
With crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, this is Washington, D.C.
Joe Biden gets back to work.
When issued 7-year yield 4.166% ahead of the $44 billion auction.
Politics as the president sits down this hour with Benjamin. Same Oval Office. I'm Joe Matthew alongside Kaylee Lines here in Washington. Welcome, Kaylee. This is a key moment. Fire in Gaza, a priority.
So again, we are now shortly expecting results from the 7-year sale. On release, I'll be leading with the bid to cover ratio.
He confirmed to the nation in that Oval Office address last night that was in part a speech about democracy, frankly, and of trying to protect democracy, but it was also about the legacy that he thinks he already has and the one that he wants to leave. And peace in Gaza came up, and I wonder to what extent that will be expressed behind closed doors to the Prime Minister of Israel.
We're going to be watching Joe Biden's body language, listening to his tone a little bit differently now that this Day, knowing that he has the freedom to speak without running for re-election could bring some interesting moments.
Certainly, and of course, it's worth meet the Vice President Kamala Harris will be meeting separately with Netanyahu as well after not presiding over Congress yesterday. She caught a lot of flack for it, although J.D. Vance, I would point out, was not in the chamber either.
Also
he was on
noting,
the campaign trail.
Arbit from the Atlantic Council a little bit later on as well. Josh Wingrove, Bloomberg's White House correspondent, who was on pool.
White House on such a momentous occasion for the president. So that's still ahead. First, though, as always, let's get a check on the markets.
Thank you very much. Lots going on in terms of financial markets today, and a very different tone to the market. The numbers, and you'll see what I mean. We got the S&P up 52 right now, 54.79, an advance 491,
bid to cover 2.64, 2.64, the high rate of 4.162%, 4.162%. The US sold 44 billion, 9% of bids at high. Primary dealers take 8.87% of the sale, direct 16.76%, indirect 74.38%. Again, the high rate 4.162% and a bid to cover of 2.64.
0.41%. Spot gold down $33. And West Texas intermediate crude up 0.8%, 78.18 a barrel on W. Stellantis shares down today by 6.8%. Meanwhile, Ford, after earnings, plunging by $55, up by 1%. Balance of power continues. Another busy day in Washington.
Thank you so much. I am Kaylee Lyons, back alongside Joe Matthew here in Washington, where it's been a busy week. A second term, something that he formally announced to the nation in an address from the Oval Office in prime time. You may not have gotten that answer, but we did get this.
I've decided the best way forward there is a time and a place for long years of experience in public life.
Of course, one of those voices belonging to Kamala Harris, and we'll be talking questions about why they're not up on the air, even though it's been only 3 days. But we want to stick with this for one moment. Stating his intentions last evening was important, and we're joined to talk about it by Josh Wingrove, Bloomberg White House. Give us a sense of what went into this speech. There were a lot of questions, to Kaylee's point. They did a good job. Did they get their job done through the eyes of the administration?
Okay. This felt like a capstone for him. A couple hundred staff poured into the It felt like a goodbye. It felt like a retirement party at the White House. So that was the lens on it. Happened here, right? It was the growing revolt, and in particular the questions about whether Joe Biden would drag down. Remember, he said there were only 3 things that would let him step aside. One, the Lord Almighty.
Yeah.
go. We have no indication of that. And number three, if his aides told him he could not win. So it looks like it was rapid coalescence around Vice President Harris since then, and this speech yesterday. Biden was defiant. Kick at the can to run at a second term. Yeah. And, you know, Jill Biden's exactly. She's from Philadelphia, I will note. So that, I think, he is
he actually had family members in the Oval Office.
Yes. Yes, many of whom boarded the plane with the First Lady right after to go to the you know, he's insisting on running, on serving out the end of his term.
Yeah.
The press secretary spent all the brief speech that a lot of people are going to tune in on for what Joe Biden has to say. Now, there is work calling for it or attempting to do it by executive order, which would be a fight at the very least, but perhaps
yeah, it's scheduled to begin any minute now at the White House, Josh. And he did talk about how he wants to see an end to the war and that as well. So knowing that Biden is looking out for his legacy here, that he knows today, what kind of Biden is Netanyahu about to meet with?
Netanyahu seems to believe the I suppose it remains to be seen. I think Biden does have now more leeway to strike a deal that might be more bandwidth to do it. I will say, like, you know, last week as we sat here 1 week ago, I do not believe that he was days and days hiding a decision. In the last 24 hours since his speech, there have not been a lot of second thought. Seems to be the opposite. It's a sigh of relief that the tension, at the very least in the party, is over, and Harris really of all systems go. I will note that both Biden himself in speaking to staff and the First Lady in
It's great to have you. Thank you for sharing that with us. As always, Josh Wingrove, Bloomberg White House correspondent with the view inside the White House. Not staged following the speech. It was not part of the programming. And the same will be today. He's sitting down. Press pool will be allowed in the room for a moment to get some video, get some brief remarks. Gathering for that opportunity right now as we add the voice of Carmel Arbit, Senior Fellow for Middle East Program. In radio, it's always our pleasure to have you here, coming off of the speech to a joint session of Congress last night, in which he implied the ceasefire in Hamas is going to be his priority as he finished.
Well, thank you so much for having me on again. Bibi is coming off a speech to Congress where especially substantive in terms of the commitments that he was willing to make towards achieving that ceasefire, which achieving. And on the other hand, his political interests have been served much like they have Hania in the that they're getting closer to an agreement that would look at some kind of a short term, less than 2 months. A longer term ceasefire. So I think the moment is more hopeful than it had been in the last few weeks and months.
Well, that's absolutely true. And Carmel, I think we should all remind ourselves of the kind of tenor of the speech that we saw. What he called his vision for Gaza. This is how he laid it out.
The day vision for that day is of a demilitarized and de-radicalized Gaza. Overriding security control there to prevent the resurgence of terror, to ensure that Gaza never again
and could get behind, Carmel?
Look, I think this is something that Bibi has been saying multiple times. I think the real question is how to achieve a demilitarized and de-radicalized have been taken out, about half of the leadership. They're still very far from getting to the for a Gaza that is not occupied by Israel, that is independent, that is peacefully between both parties.
How different will Joe Biden's meeting be with Benjamin Netanyahu?
Yeah, it's very interesting that they're having these two meetings separately. Of course, as we kind of get ready for out. He thinks that whatever happens, he's going to get a better deal if Trump is in power, because Trump is to deliver anything that would seem to bolster Biden or kind of help him. Biden Gaza or a de-radicalized Gaza, he's also looking for a grand deal, something that would bring and I think that's going to be a huge focus for him in his final months in office, and he'll have time and space connected to the state of Israel, but increasingly frustrated with Netanyahu. I think Harris is going to be coming to this conflict, but ultimately she's going to continue to toe the line of this administration as vice president. Relationship with Israel.
Well, Carmel, as you talk about the idea that Biden does seem to want some kind.
So we're shortly expecting the results from the Fed reverse repo facility
In the Middle East. So while he may be most immediately focused on the conflict between Israel and Hamas, I talked about Hezbollah and that Israel will do whatever it can to secure its northern border. He said, and this is a whole, not just in Gaza, a bit of a reach even for this president?
So I think we have to alliance, something that's been worked on behind the scenes a bit to bring together all of the countries who help potential to bring together, Gulf countries, allies with those who are already allied with posed by Iran and its proxies. So I think we have to differentiate. There's a space for cooperation.
69 counterparties take $377.433 billion at the Fed reverse repo operation.
The Houthis are willing to not just strike Israel. The Houthis have and then that prompted an Israeli response. I think we're going to continue to see that escalation, but we're going to see on the one proxies.
Benjamin Netanyahu moves on to Mar-a-Lago to meet with Donald Trump.
There's going to be a number of different things discussed. One is that there's some tension right now between Bibi and Trump. Trump into Trump's claims of election fraud. So there had been some personal friction points. Formalities of it, and they're going to talk substance. And what I would expect is that Netanyahu and Trump are support Netanyahu, irrespective of what is happening domestically or what is happening.
Especially on a week like this one, where we see Netanyahu spending so much time on U.S. soil, not just here in Washington, but programs at the Scowcroft Middle East Security Initiative. We always appreciate it. It's going to be pretty remarkable as we look to get the intensity of these various private meetings with 3 different either current or potentially future to your point,
That's
Jeff.
for sure. And sometimes you can read into that a bit with the extent to which the press is allowed to be exposed to what's happening. Fire, and I think the idea was to get them in, get them out, because this might not be the most comfortable meeting.
Yeah.
Same could be said for
well in between those meetings. So a lot is ahead on the White House. We're going to have more on radio.
It's the deflationary pressures and questions about foreign investment linger. Bloomberg, The China Show. Influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m.
Headquarters in New York, I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These
We'll walk you through what you need to know to kickstart the European Trading Day. Live from our reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg. Market. Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
You're over.
Instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
DOJ or other authorities.
Could face bigger challenges.
Welcome to the world of decentralized finance.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg.
It's Uber, Lyft, and DoorDash can keep classifying California drivers as independent. Not wrongly curtail the legislature's power over worker protections. Today's ruling was unanimous. 2.1%, Lyft shares up by 0.2%, DoorDash up by 1.4%. Up 465 points, 40,319, a gain of up 44 right now, up 0.8%, while the NASDAQ Composite Index is up 119. For the Russell 2000 index, that index now up by 2.5%. Traders betting that the corners of the market, stocks rebounding after yesterday's sell-off that jolted markets around the world. Thursday, we've got the 2-year 4.42%. Spot gold now down $37 the ounce. Recapping, stocks are higher. S&P up 43, a gain there of 0.8%. Balance. Matthew and Kaylee Lyons.
All right, Charlie Pellet up in New York. Thank you so much. I'm Kaylee Lyons. As President Biden sits down in the Oval Office with Israeli Prime Minister Benjamin Netanyahu. This, of course, displeasure with, especially for some of his rhetoric when it comes to the protesters that were here in D.C. and frankly charged nature of this entire visit. And it comes against a backdrop of course, President Biden having just spoken
There are images of Netanyahu and Biden in the Oval Office. They took a couple of moments to talk with later on. And then tomorrow, Kaylee, it's on to Mar-a-Lago. And apparently a much closer friend in Donald Trump. November.
Yeah, it was interesting to watch Netanyahu's speech yesterday in which he did thank Joe Biden of intercepting the Iran missile and drone attack back in April. But his words about Donald Trump were a bit president. It seems like there may have been a little more love there, although I guess that's open up to
right. Carolina, one of the 7 swing states we're following here, of course, in our Bloomberg swing state poll. The rhetoric, though, is Harris as a DEI hire, a DEI vice president. We have
we have a new victim to defeat. Lion Kamala Harris. Lion, L-Y-I-N. Far left, a vice president in American history.
So let's Davis and Jeannie Shanzino, both Bloomberg Politics contributors. So we saw that kind of throughout the rally. Harris, not Kamala Harris. Rick, is this going to work for Donald Trump, or does this risk backfiring on him?
Unity. Now he's just back to being the Donald Trump we've known for a decade. Yeah, I don't think he can help. Worried. They saw his speech, in Milwaukee after all the claims that he was going to has really reversed itself completely. This is the Donald Trump that started the campaign 2 years. His bearings with Kamala Harris. And the reality people I've spoken to are worried that this kind of approach is not going to work with a fresh, young since the convention. So, and since the president's withdrawal from the race on Sunday. So, he's going to be looking for a change in approach if they want to win this election.
Certainly, the speaker is. Conference meeting this week to ask them to tamp down the rhetoric after we heard Tim Burchett said she got the nod here by Democrats this week, quote, because of her ethnic background. Address this kind of talk, if at all.
It is a many of his MAGA supporters. And so the fact that it doesn't seem to be landing. We have the reason so many Americans are not willing to entertain. To win elections, you have to reach out. He wanted to run against Joe Biden. It is not. This is going to be a hard fight for her. She's going to have to put up with this race. And so I think from her perspective, she sticks to her argument. She is a former prosecutor. She is the She is prepared to go head to head with him on policy issues because those are areas where she can.
Well, I would point out it's not just Donald Trump whose comments have gotten some attention here, but as well his quote unquote childless. We now have the ex-wife of Harris's husband, Doug Emhoff, like Jennifer Aniston. So, Rick, what about the J.D. Vance aspect of this? And do you think there might before Kamala Harris was understood to be atop the Democratic ticket?
Yeah, these comments made Vance as, insensitive on issues related to women, picking a fight. A public apology on a neutral network by J.D. Vance in the coming days. Killed with women's voters in all the targeted states. There's some new polling. Democrats with women voters, and frankly, a kind of stagnation with really only appeals to male voters, that they would get some uplift, and if anything, they've got a running mate who's started out with kind of a lose-lose approach to being Harris, and how to really juxtapose them on a substantive basis. That said, performance of our country right now, and finish the campaign there, because that is where most of the voters are. They care about
Zeno here on Bloomberg TV and radio as we stand by for an important conversation. Bloomberg's Emily Chang. Bloomberg TV and radio. Jeannie, it points us to the Veep stakes. We just spent a lot of time for Kamala Harris's decision. Who are you looking at right now, and is it in fact
It is. Well, I think there's also the Sun Belt senator you can look at as well. People's support and vote for obvious reasons. I would say one drawback to both prosecutors. So you wonder if in doing something like that, she would be doubling. I also think that Senator Kelly would be a remarkable choice. He might open up wrong. He isn't quite as energizing on the stump as some of the other folks, but he one of the reasons why we saw Donald Trump down in North Carolina yesterday. I think there is some fear that getting somebody in reproduction is something that could elicit some fear. So I think there's a lot of really good
like it, and we'll be talking to Jeannie Sheehan Zaino and Rick Davis about it, our signature panel. Bloomberg Politics contributors, thank you both. Do it right now with Amy Morris in the Bloomberg 99.1 newsroom in Washington. Hi, Amy.
All right. Hi, Joe. Former House Speaker Nancy to victory in November. New polling shows Donald Trump leading Vice President Harris in 4 swing states. Trump leads by 1 percentage point and by 2 percentage points in both Pennsylvania and Georgia. All of those are within the margin. Arizona by 5 points. And New York Governor Kathy Hochul being sued over her pause on the city's traffic congestion price. Whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
It reads like a Hollywood script. The nature of the killings, the execution, the just
be looted because they are considered so sacred.
And we did it the way you do every.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
Sono gli uomini che spesso non lo sono.
These are the holders. And the evidence is there. It's overwhelming.
The biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. Significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
There's going to be a hurricane or a flood. It's just based on the past or the projection of the future? Or what, how do you do that?
Who understand what the warming of the Earth and climate change will mean for the question.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people claims.
It depends. I would say it's good because it creates the earlier. There is more events. It becomes more and more difficult to insure, and therefore
the names that move markets.
Listing from the London Stock Exchange, listing in New York, listing in Europe. I want to turn that around. I want Britain that the FCA put in place last week. It's also why I'm determined to change our pension system.
Changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the open.
Welcome to Balance of Power.
This is Bloomberg.
People and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors.
In terms of the fundamental business with external and data set signals. And I think that's a lot of times where
He's here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
No.
And it's 1:40 on. Risk on after this morning's economic data. S&P up 38, now up 0.7%. 2.34%. 10-year yield 4.25%. The 2-year 4. Washington, and once again your hosts Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, we thank you. An important conversation that you will not hear anywhere else. Our colleague Emily Chang sitting down now.
Thank you so much.
Chair Khan, Lita Khan, joining us now from San Francisco. Thanks so much for You just got out of speaking with the folks at Y Combinator. Talk to us a little bit about who you're speaking to and why.
And an important part of my job is going around the country and hearing from Americans across trying to work in, compete in, buy in. And so I'm so glad to be here in San Francisco. Startups and trying to understand, how do we make sure that our free and fair enterprise especially at this moment of technological change and a potential inflection point.
Obviously, how open source AI model ever this week and really double down on what he thinks are the benefits.
On this and make sure that we have access to leading AI is by building it and having it become an industry.
Where do you stand, Chair Khan, on Meta's open approach versus closed?
Well, look, without weighing in on any specific company, as a general innovation, right? I mean, what happens traditionally when you render some of these ecosystems more open is that it enable them to innovate much more freely. And so we want to make sure that that tradition really means in the AI context. Our team has been focusing on this idea of open to make it easier for startups and entrepreneurs to compete on a level playing field. Of course, we need would it adhere and could those be foreclosing competition? More generally, we also need to be aware of because they have key control over the raw material and key inputs, and so we need to be that could inhibit innovation and inhibit competition. And so that's what we're going to be talking with founders and
AI is being used to rapidly change pricing based on consumer behavior, and there are some really dystopian scene of this, and what are you hoping to find?
So as you know, for years, a whole set of companies in ways that can really threaten people's privacy. What we see now is that person-specific prices based on what they know about you, based on what you're feeling, who you're seeing. Going on here. So for example, you can imagine that a hotel that knows you've already where they're going to visit. You can imagine a restaurant that knows you have a 1 hour the types of practices that we could see take hold if this type of surveillance pricing is allowed.
And so many people are shocked about how a company that is so small could just shake up the world like this.
General matter, I think this really underscores the trade-offs between kind of fragility and resilience. Or a very small number of companies that can make it so that a single disruption can happen. For example, we saw over 3,000 flights grounded. We saw doctors that were no longer close off proceedings. And so the impact here was significant, and it's really underscoring the like this doesn't lead to so much outsized disruption.
I do have to take a moment to talk about the but I've heard specifically multiple tech executives and investors complain about how they can't do alienated the tech community or could impact the impact of your
to serve in the Biden-Harris administration, and we're just focused on doing our work. What is that they want markets to be more open and more fair and more competitive rather is one where the best ideas are supposed to win. And we've historically seen that it's the disruptors and antitrust laws is to make sure that our markets stay open and fair and competitive. And that's something that
former President Trump's running mate, J.D. Vance, has actually praised your work. In fact, I believe he's and what do you make of the irony there? And how do you see the FTC
of our initial that's an area, for example, where we see enormous bipartisan concern on both sides.
Interesting. All right, Lena Khan, Chair of the Federal Trade Commission, spending a couple of days out in San Francisco. Thank you so much for joining us, Chair Khan. Joel and Kayleigh, I'll send it back to you.
All right, Emily Chang with the chair of the Federal Trade Commission, Lena Khan. Great interview. Thank you so much, and especially interesting to us here in Washington. Her comments on the presidential race, which of course she did not want to weigh in on whatever the outcome may be in November, but this idea that it does seem to be more bipartisan now potentially than it was. Politicians on both sides of the aisle are in favor of an antitrust agenda, maybe more pro-competition, less pro-M&A.
Well, certainly if you ask J.D. Vance, I'm really glad that Emily asked that question because this is all we were talking about in Milwaukee. How does this happen? How do you have this on the same ticket? But of course, we know that Donald Trump will probably set the table when it comes to policy if he wins. But also, the way she framed that question, I think the second to last question, she's still hearing from a lot of folks in high tech who say they just can't do deals as long as this is the architecture. And you wonder how long that can stay that way.
Yeah, interesting to see in the last 24 hours the circulation of Reid Hoffman's comments around the FTC after just donating millions of dollars to Kamala Harris. He, of course, one of the big donors to first come out and endorse her after Biden dropped out on Sunday. So it's definitely a live conversation in this election cycle, but it does have an impact potentially on merger activity as we move forward into 2025. So here with more is Jennifer Rhee. She is Bloomberg Intelligence antitrust litigation analyst. And Jen, you have a piece out that effectively looks at how the election ultimately matters for the antitrust environment. And is the answer potentially that either way, a Trump-Vance administration or a Harris-whomever administration, there may be a lot of similarities?
Yeah, I really think there are similarities there. And I think that Lena Khan is right, that there is bipartisan interest right now in antitrust. But I do think there could be some slight changes. And I think that the odd thing here for me is I am beginning to see a little bit of a flip of this sort of standard political orthodoxy about about how we think about these two parties vis-a-vis antitrust. I mean, for many years, the Republican-led administrations tended to be more business-friendly, and the Democratic administrations less so. Now, I think it was really mostly on the edges, but that really has been consistent. And in this case, I'm actually beginning to feel that if a Trump-Vance ticket wins in November, that we could actually see the continued toughen antitrust exactly as it is, and maybe even more so than we've had for the last 3 years, and perhaps a little bit of an easing under Kamala Harris.
Wow, that's saying a lot.
Yeah.
Jen, is that because of the J.D. Vance effect, or just the sort of more isolationist view that Donald Trump brings to the table? Because people thought if Trump gets reelected, it's open season.
I think it's both. Now, we have to realize that antitrust really started to tick up under President Trump. You know, it wasn't just Biden administration. He kind of took the ball and ran with it. But the challenges to mergers started to tick up under President Trump much more so than the 3 administrations before him. And also, all investigations of big tech companies started under Trump, and the lawsuit against Meta was filed under President Trump's administration. So we already know that to some extent, he's willing to go that direction on antitrust. And then you add J.D. Vance. Now, Lena Khan is also correct that, or actually you said this, Joe, that it's Donald Trump, if he's president, that's going to be making policy. But J.D. Vance, as his vice president, has his ear. And if they're aligned on this, then he may defer to J.D. Vance's views or defer to J.D. Vance on who to appoint at the FTC and DOJ, who will be the ultimate decision makers on antitrust matters.
Well, it's an excellent point, Jen. The idea that what the president has power to do to control an antitrust agenda is to appoint the regulators who oversee it. The problem is you have Congress to consider here, too. It's not just the presidential outcome that is uncertain, but also the balance of power in the House and in the Senate. How should we be thinking about the actual legislative chances of some, like, antitrust legislation getting through?
You know, antitrust legislation is really tough. It's been hovering out there for 4, 5, 6 years. But I think the problem is that even where there's bipartisan interest, the parties are coming at it from 2 different perspectives. The Democrats are a lot interested in curbing power, more interested in curbing power, curbing dominance, controlling the conduct of companies, particularly big tech firms, and in the healthcare markets too. Whereas I think the Republicans are more interested in what they view as censorship of conservative content, where the message is placed out there on a platform. So they want to do the same thing, but they're coming at it from different directions, and I think that makes it really hard to get together on the details. And that's why I think it's going to be tough to get any antitrust bills passed. Now, it definitely depends on the makeup of Congress, but at least if things are divided, I think it's tough.
Jen, we've only got a minute left, a bit less. I don't want to cut you off, but can we assume that Kamala Harris will have the same approach as Joe Biden when it comes to antitrust?
I don't think so.
Should we not make that assumption?
I just don't think so. I think she's a little more measured. I think a little more pragmatic from what I've been reading about her, what I've heard her say in the past, and maybe not quite as rigid. There's been this real rigidity in the antitrust community, the enforcers under Biden, and maybe some of that rigidity will loosen up under a Kamala Harris. Again, it depends on who she appoints to the decision-making positions.
Jennifer Rhee, Bloomberg Intelligence Senior Litigation Analyst, with us live from New York. Jen, it's great to see you. Thank you so much. We wanted to have a moment to distill that conversation. And thanks as well to Emily for bringing us Lena Khan, Kaylee. Really interesting stuff today that gives us a sense of what we might be stepping into, or at least some options.
Yeah, what the regulatory environment could look like heading forward into 2025, no matter who wins the election, is certainly something to consider as we tease out these policy ideas, how markets should be looking at this election, which I think we can all agree has gotten a whole lot more interesting in the last week.
You said it. We'll have a lot more on that. And of course, Benjamin Netanyahu's visit to the White House on the late edition of Balance of Power. We'll meet you there at 5 o'clock Washington time, only on Bloomberg.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Saturday mornings, I understand you have off.
Yeah, Saturdays is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife. We go for a swim all year round. After that, have a nice lunch, and then I'm onto a good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend as they fancy. I think what we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, the bandwidth of your reflection is just too narrow. And I generally believe that Monday mornings I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
Bloomberg Power Players is back this September. As the top names in tennis take the court over in Queens, we're convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at bloomberglive.com/powerplayers.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody, live on Bloomberg Television, Radio, YouTube, and Bloomberg Originals. I'm Carol Masser along with Tim Stenevec, and yes, indeed, this is Bloomberg Business Week. Gotta say, Tim, the setup on this Thursday, July 25th, a little bit different from yesterday.
Quite a bit different than yesterday. U.S. growth doing okay, so it gives the Fed a little bit of breathing room. On that, we're seeing stocks settle down after that sell-off that wiped $1 trillion off the NASDAQ 100 yesterday. We're going to have much more on today's trade and the economic data behind it in just a minute.
Yeah, and top of mind for us, let's just go there, is that U.S. growth report showing both consumers and businesses are still spending. We've got the details, and we're going to get a little bit deeper into the trade off of it when it comes to the U.S. rates curve and U.S. Treasuries, as well as a little bit more on the equity side.
Yeah, and plus, have you seen shares of Ford today? They are just sinking right now. We're going to break down the report and get into what feels like the woes of big auto. At one point, Carol, down 18%, now down over 17%.
It's a huge drop. And one more thing, Chipotle actually going to splurge on bigger portions to keep diners happy. That's going to make you happy.
Was it Chipotle Summer? What is it? Chipotle Man? I don't know.
What?
There's like the Chipotle Boy Bowl. I don't know.
Anybody?
Yeah.
Bueller?
It was something like that.
Nobody. All right. We'll get back to that. We'll check on that. We'll Google that. First up, though, let's get a check on the trade today on this Thursday. Here's Charlie Keller.
All right. I thank you very much. Chipotle right now, downsizing. It is trading lower. Chipotle down 1.5%. We've got stocks pushing higher. As Carol mentioned, a dramatically different tone to the market right now compared to this time yesterday. S&P up 32, 54.60 where we stand, right to the numbers here, by about 0.6%. We've got the Dow up 362, up 0.9%. The NASDAQ Composite Index now higher by 106, up by about 0.6%. The outperformer by far cannot ignore what is going on with the Russell 2000, again surging another 2.2%. And to put that in context, S&P up 0.6%. The 10-year right now yielding 4.2%. 4.26% with a 2-year, 4.44%. Spot gold down $40 the ounce, a drop right now of 1.7%, 23.57 the ounce. And West Texas Intermediate crude up 0.7%, 78.18 a barrel. Carol mentioned the automakers. Ford having their worst drop in 4 years after that big earnings miss that the automaker blames on a surge in warranty repair costs for older vehicles. Ford shares trading lower by 17.4%. Elsewhere, Stellantis has started floating the possibility of selling one or more of the auto giant's 14 brands. Stellantis down now by 7.1%. General Motors down by 4.2%. So again, recapping, stocks higher across the board. S&P right now up 30 points, a gain of 0.6%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. And it was the Chipotle Boy Bowl.
Yeah,
Sorry
we
about
talked
that.
about
I couldn't
this,
remember.
Carol.
I know. Well,
Yeah.
there's a lot that's coming at us.
It's been a busy
if you haven't
summer.
noticed. All right, including lots of surprises, including this morning when it comes to the U.S. economy. U.S. economic growth accelerating by more than forecast in the second quarter, illustrating demand is holding up under the weight of higher borrowing costs. The economy's main growth engine, personal spending, advancing 2.3%, also more than projected.
Meantime, a closely watched measure of underlying inflation rose 2.9%. It eased from the first quarter, but it is still above estimates. That's according to the Bureau of Economic Analysis in the report this morning. So let's get to it, Carol. The latest on the economy and how it's reflected in the U.S. rates market and what it means for Fed policy.
All right, back with us are two Michaels, Bloomberg News international economics and policy correspondent. In fact, for the next 20 minutes, it's all Michaels, guys. I'm just going to tell you. Bloomberg News international economics and policy correspondent Michael McKee, along with Bloomberg News rates reporter Michael McKenzie, both lucky for us in studio. All right, Mike, I was listening to you breaking it down this morning. This was a strong report.
I'm hungry. I want that bowl.
You want the Chipotle Boy Bowl.
Chipotle Boy Bowl?
This was definitely a stronger report than anticipated, and it was the composition of it was very good for the overall economy because it was basically stronger consumer spending and stronger business spending, and this wasn't one of those where it was inventories and trade that tricked things up. Although trade was a big drag and inventories a big gain, but they sort of offset each other. So you look at the spending numbers and consumption was still good. Now, since then, we've had some data that suggests the economy is slowing, but you can see the way the market repriced after the data today that people are thinking the Fed doesn't
Seeing from the Financial Times, OpenAI to launch a product called Search GPT in order to challenge Google, according to the Financial Times. So OpenAI is launching an online search tool in a direct challenge to Google, opening up a new front in the tech industry's race to commercialize advances in generative AI.
Blackout period without suggesting that, because the markets had done their work for them and started pricing in 3 rate cuts over the next 4 meetings, and that would include September as a start. But since they'd priced ahead, they basically had a rate cut. Now, a lot of that's washed out of the market today on the strength of this, but it hasn't changed the view that we're still going to see a September rate cut and then probably one in November and maybe December as well. So it doesn't really change it a whole lot. The inflation numbers you mentioned, Tim, they were not as good as expected, but they're less important to the Fed because they're quarterly averages, and the PCE inflation numbers we get tomorrow for the month of June will be much more important to them. But the thing about both of the numbers that came out today, the headline and core on a year-over-year basis, they went below 3%. And so we're getting into the territory where the Fed has said it will cut rates.
Getting ready to bring out the champagne. So, Michael McKenzie, come on in on this. Should we get ready to break out the champagne? How are you seeing it?
Not yet. I think the bond market got pretty excited this week, but it's now back to sort of pricing in 65 basis points of cuts for this year. So you're sort of looking at 60% odds of a third cut. It's come back a bit from this morning. We had an October Fed funds showing there's a 20% chance of a 50 basis point cut in September. That's now come back to around 10-12%. So that was sort of doing the rounds. I mean, I think if you look at what's happened in the last few days, we kind of got a foretaste of this when we saw a record demand from investors on Tuesday for the 2-year sale. And that told you that people now know that the Fed is in play. It doesn't matter if it's going to be a couple months down the road. You need to start moving from cash and start parking some money in that 2-year around 4.5%.
Because this might be as good as it gets.
This might be as good as it
For a
gets.
while, yeah.
There's a lot of chatter in the market about how lower income consumers are suffering. We've had a lot of earnings reports where companies have talked about, the consumer isn't happy. We don't have pricing power anymore. You've kind of got Chipotle now saying they're going to go back to giving people bigger orders, which will really make my son and his teenage friends really happy, because that's where they go
Bring it
after
on.
school.
Yeah.
So the bond market here is beginning to sniff out a slowdown in the economy and a need for some rate cuts. And in particular, as Mike McKee just said, as inflation's been coming down, that funds rate's been stuck there for the last 12 months. So policy is becoming more and more restrictive, and it is starting to show up. And this is why the bond market feels pretty confident. And you're seeing this because the yield curve is getting closer and closer to no longer being inverted between
Right.
2s and 10s. 5s and 30s broke out this week again to new highs since last year. And that's where a lot of asset managers are very happy, because they love owning the 5-year. They don't really want to own the 30-year at this point.
Well, so does this mean, Mike, we escape a recession? And that the soft landing, like, here we are, guys?
Well, it's not a guarantee, but it certainly puts a thumb on the scale of the idea that we have a softer landing and not a recession. We'll have to see how the third quarter numbers develop as we get deeper into it. But when you're looking at GDP of 2.8%, that's almost a full percentage point above what people consider potential. And then you've got inflation going down. Markets obviously are fickle, and tomorrow, if we get good numbers on inflation, they could go down, but maybe there's an upside risk to personal spending given what we've seen today. So they'll try to figure it out, but at this point, you just have to say the Fed is probably going to not do anything next week and then signal a September cut. And when that happens, then the market probably reprices, bonds go up and yields go down because people are starting to think they're coming that way.
Mike McKee, it's interesting because we have gotten a couple prominent voices calling on the Fed to make certain moves. For example, Bill Dudley yesterday said, I changed my mind, the Fed needs to cut rates now. We talked about this yesterday a little bit. And then Mohamed El-Erian out with the Bloomberg opinion piece that says the Fed may be 2 meetings from a policy mistake, urging that they should not delay an interest rate cut beyond September. How should our audience take these?
Well, Bill Dudley was on Bloomberg Television today at 8:15, right before the numbers came out, and I wonder what he would have said had he still been on the air, if he'd still think they need to cut next week.
Maybe higher for longer still.
But my good friend Mohammed raises kind of a straw man about 2 meetings, because the Fed doesn't know what it's going to do. It's really taking this meeting by meeting. They're moving towards rate cuts, and there's no reason to think they wouldn't do one at this point in September. So I think the idea that they would skip September is maybe kind of just a rhetorical thing at this point. They haven't given us any reason to think that they would.
I want to go back to Michael McKenzie asking Mike about, soft landing. What are you hearing? Because I still think about how long we had that inverted yield curve, and doesn't at some point that kind of smack us in some way? But, I don't know. Do you think we just see this soft landing or what are you hearing from traders?
There's a lot of concern about the sort of lower income consumer. We're still in this K-shaped economy.
Bill Dudley kind of brought that up. Right? Wealthy consumers are okay, but
wealthy consumers are fine. The key point here to watch is the labor market. If unemployment starts to pick up, if layoffs begin to accelerate. I mean, today, the other good part of the data today we saw was jobless claims. Continuing claims has been something that's been on a lot of investors' radars. That came back a bit. So again, but there's a long stretch between the July meeting next week and the September meeting at the Fed. And that's what a lot of people in the bond market are looking at, saying, okay, we're going to get a lot of data into that September meeting, and by then we should have a pretty good idea whether or not the Fed can go 25, but more importantly, do they do another 25 relatively quickly after that? Or if you get a real sign of weakness in labor, does it begin to sort of arouse that 50 basis point cut? And again, it's very unusual for the Fed to start any easing cycle with a 50 basis point cut.
Very, very briefly, the sizable change in labor. What's the number, Michael McKenzie, to look for? Very briefly, what would scare the Federal Reserve?
something close to zero or negative. I always remember back in 1992 when the August payrolls were massively negative and the Fed actually cut.
So
in
it has to be
September
that
of 92.
drastic.
It has to be very.
Okay.
I mean, it has to be a genuine shock for the Fed to sort of say, okay, we are behind the curve, and nothing suggests that they are at this point. And what the market is saying is that they're just pricing in that sort of tail risk. And part of that's because there is such a long gap between the July meeting and the September meeting.
It's a long time, those dog days of August or dog days of summer or whatever you call it. Last question to you in terms of the job market, because we have seen increasingly the Fed, Jay Powell in particular, remind us it's a dual mandate. You're talking a lot more about the labor market.
Well, they've been watching the labor market because it has been weakening a little bit. The bad thing about next week is that they don't get the jobs report before the Fed meeting. But if the unemployment rate rises to 4.2%, which is not what's forecast, but if it did, that would trigger the Somme rule, and then that would scare the horses, because then everybody starts to think, well, we're going into recession because it's always said that before. Now, Fed doesn't think this is completely accurate because a lot of it's driven by a rise in the labor force, but Bill Dudley noted that happened in the 70s too, and we still had a recession. So next Friday is going to be a very interesting day too.
It's just all these points, as we said, a lot of stuff keeping us on our toes. Michael McKee, thank you so much. Always appreciate it. Michael McKee, of course, international economics and policy correspondent here at Bloomberg News, and our thanks to Michael McKenzie, rates reporter at Bloomberg News as well. And I feel like our Michael Palooza continues.
Michael Palooza it is. We now get to the equity play off of this morning's stronger than forecast GDP report. This after yesterday's stock sell-off, which wiped $1 trillion off the NASDAQ 100. Wall Street traders betting that the Fed will be able to engineer a soft landing did spur a rally today in riskier corners of the market, with stocks, Carol, rebounding after a sell-off that jolted markets around the globe.
All right, so let's get to it. Let's bring in Bloomberg Intelligence equity strategist Michael Casper here in studio. So, Michael, we've talked about kind of the equity, certainly the equity reaction we've seen to that better U.S. GDP report. We've hinted on it. Walk us through it, because we're almost 1/3 of the way through earnings. Are earnings justifying some of the moves that we're seeing in the market? Maybe a slight pullback, but maybe some momentum once again to the upside?
Yeah, certainly in the S&P 500, right? So you've got significantly better than expected earnings results for the S&P 500, so large cap stocks, and that's driving a lot of this rotation, right? So you've had tech leading the way in 2023, and now you've got that kind of seeding some of the growth towards some of the cyclicals, so stuff like energy is coming online, healthcare coming online, a lot of different sectors starting to kind of confirm the rally in EPS, and that's kind of driving a lot of the rotation, at least within large caps.
There are some mega cap tech stocks, though, that have reported in recent days, and it hasn't been so good. Tesla and Alphabet certainly are the ones that I'm thinking of. And then in a totally different area, you had Ford report yesterday, and you're seeing shares just slide today. How do those numbers... how do you think about those numbers in the context of what you just said?
Yeah, I think they were relatively mixed. They were kind of somewhat in line, at least with Google's big report, but
no sort of canary in the coal mine.
Yeah, no, not necessarily a canary in the coal mine. Actually, what I would say is that this rotation feels very healthy within large caps, right? So you've got the tech component and the tech-related component trading at pretty high valuations. They peaked around 28, 29 times historically. That's right about where they are right now. And you've got earnings growth for the rest of the index starting to catch up. So it's pretty healthy rotation, I think, in large caps.
Having said that, I got to say, one thing that struck us this morning on our read-in, research, I believe, from your team, from the Bloomberg Intelligence team, about how with almost 1/3 of S&P 500 companies reporting those second quarter results, spotlight increasingly on sales, only 43% of companies have managed to beat revenue expectations, which would be the lowest reading in 5 years, according to BI data. Is the quality... Earnings, we know things can be done. Top line revenue growth, not so much. The number, excuse me, is the number. Is the quality of the quarterly results, especially when it comes to revenues, coming down?
I don't know that it's coming down. It's certainly been a margin story, both this quarter and for most of 2023. So if you think about last year's results as we were clawing our way out of the earnings recession for the S&P 500, it was really a margin-driven story, and that continues to be the case. Now, if you look at forward expectations...
So margins are holding up?
Margins are holding up. Margins are improving significantly from those inflation-driven lows from 2022, and that's still the story now in 2024. But as you look at the forward expectations for revenues, those are still pretty solid and improving, and Also, I would even note in the small cap space, the revenue expectations are improving for the next 4 quarters. So you've kind of even got these economically sensitive small caps, maybe going along with the GDP report, also showing stronger revenues over the next year. So while it is a margin story right now, revenues are expected to come online soon.
When do we start to see the promises of efficiencies of AI, from AI, actually starting to affect margins?
If he could answer that, he would be on his island in the South Pacific.
Because the investment has been so big from some companies out there right now. When do we start to see that investment pay off?
I think that's definitely a longer dated story, right? So we're talking years out. It's something that's not necessarily going to filter through 2Q. Obviously, it's spending on the revenue side for the companies that are having that allocated towards them. That'll help, but I think it's a longer dated story for AI to drive some of these efficiency gains.
I mean, so at this point, we just talked with our economic and rates team, and it feels like that soft landing seems to be in place. Is that safe to say that's what we're seeing from earnings so far, easily, or if not better?
It seems to be the way that we're definitely trending, right? So you've got the better GDP report, you've got CPI starting to come down, PPI also coming down. The Fed has a lot of leeway to do whatever they feel like they need to do, be it more rate cuts than consensus expected just a few months ago, or taper the balance sheet even less than they have been, right? So giving them a lot of leeway at the end of the day, and that certainly can help companies going forward.
Always nice to have some leeway. All right, going to leave it there. Hey, thank you so much, Michael Casper, Bloomberg Intelligence equity strategist. Coming up next, a major speed bump for shares of Ford on a profit miss. I mean, that stock is just getting hammered here today.
Yeah, down 17.4%. A worst day, Carol, in more than a decade at this point.
All right, that story, we're going to get back to that in just a moment. It's coming up on Bloomberg Business Week. Right now, the S&P 500 up 22 points, the NASDAQ 100 a gain of about 32. We're looking at the Dow Jones Industrial Average up more than 350 points. You are listening and watching Bloomberg Business Week. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks advancing. Wall Street goes risk on after this morning's economic data. The Dow, the S&P, NASDAQ all advancing. We're off session highs, but still looking at a 20-point gain in the S&P to 5447, up by about 0.4%. The Dow, 40,200 right now, up 345 points, up 0.9%. And NASDAQ is up 33, higher by 0.2%. Perhaps the bigger story, though, the resurgence in the Russell 2000 index of small cap shares. We've got the Russell 2000 rebounding today by 2%. 10-year 4.25%, the 2-year 4.43%. Spot gold down 1.7%, down $40 the ounce to $23.57. And West Texas Intermediate crude now up 0.8%, 78.23 for a barrel of WTI. Traders betting that the Fed will be able to engineer a soft landing spurred a rally in riskier corners of the market. Stocks rebounding after yesterday's sell-off that jolted markets around the globe. A Colorado judge has issued a temporary order blocking the proposed $25 billion merger of Kroger and Albertsons, which has been challenged by the state attorney general. Shares of Albertsons, they're trading higher by 0.7%. Kroger, meanwhile, down 0.8%. Again, recapping, stocks are higher. S&P right now up by about 0.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, ouch. Ford shares tanking, down the most in more than 15 and a half years. Right now, down about 17.5%. At its lows, down more than 18%. The biggest intraday fall since November of 2008. Remember that time period? Ford's drop coming after the automaker posted second quarter profit that fell short of Wall Street estimates. The company talking about quality problems with new vehicles, Tim, that led to a surge in warranty costs.
It's something that the company is focused on to fix. That's according to Ford CFO John Lawler on Bloomberg. Check it out.
We're working on reducing our costs intensely. It's an incredible focus by the team. Really, it's a quality and cost reductions. That's our opportunity in the near term to really improve the business. The team's focused on it. There will be additional cost reductions.
That's Ford CFO John Lawler earlier on Bloomberg. With more on Ford and the Global Auto Group is Bloomberg News Detroit Bureau Chief David Welch. He joins us from our Detroit Bureau. David, it certainly feels like a rough road for some of the automakers who have reported thus far. I do want to start with Ford and get an understanding from you about why we're seeing investors react like this. After all, John Lawler did say that we can't read this quarter as the year is coming off track. It's not.
Well, look, you've got a couple fundamental problems that are going to be difficult to fix. They've been trying to deal with this warranty cost and quality issue for a couple of quarters now, and it's just been a constant drag. So in the eyes of investors, this is a moving target, and they just can't seem to hit it. And it's difficult for analysts and investors to see where and when they're going to get that problem fixed and when it will stop being a drag. So that's number one. Number two is, $1.1 billion loss in their electric vehicle business. Well, like everybody else, Ford needs to sell EVs to a certain degree to build this business because it is the long-term future for transportation, but also they need those credits to meet their regulatory requirements going forward. You've got to, if you're selling a lot of pickup trucks and SUVs, you need to sell hybrids and you need to sell electric vehicles in order to meet those numbers. So if you're selling those at a great loss, that's also a problem. And so how do you get out of that mess if every one you sell is costing you at least $10,000? So, these are both structural problems that the company seems to think they can fix. But if you're an investor, you have no idea how quickly they're going to be able to do it. So they're fleeing the stock today.
Hey, David, for you and the team who cover this group and Ford specifically, I mean, going back to what the CFO said, that, that this isn't a quarter where we're coming off track. It's just not. Does it feel like it's coming off track?
it doesn't really inspire a lot of faith that they can do it because they've had these same issues for a few quarters now. I mean, the quality and warranty thing, and even in years before this, they've had a difficult time with basic vehicle launches and just getting vehicles out, like Bronco, like Explorer years before that didn't have quality problems or didn't have delays. So it does lead investors to think, okay, what's going on here? This is the fundamental basics of car making that Ford is having problems with. Remember when we had production hell at Tesla, everyone said, hey, the conventional car companies, they put new vehicles out of muscle memory and there aren't these problems. But here we do have these problems. So look, while we're saying that the end is in sight on this thing, but why would investors sit around and bet on that when there are other places they can put their money?
Well, remind us what happened with Ford. I mean, this is a company that's been creating vehicles for over a century. Why is there the warranty issue right now?
Look, it's hard to say what the issue is internally. They've just had quality issues, and when you have that, consumers bring the vehicles back. They pay the dealers to fix it, and it just keeps costing the company a lot of money. They have to put money into warranty reserves. All the companies do this, but it's been difficult for them to fix. People ask me this all the time. Why can't Ford get this behind them? And it's just tough to really get an answer without sitting down with their quality people and engineers and saying, hey, what's going on?
What do we know about where the issues are, not internally in the manufacturing process, but where they're manifesting when it comes to complaints from consumers and when dealers need to fix?
I don't know, exactly, what the biggest complaints are per vehicles. I mean, you could go back through, some of the things like Consumer Reports and J.D. Power. Those surveys often flag a lot of things that people have issues with. But when the costs are this big, it's probably in multiple places, and just it's hard to put a finger on. Hey, it's this vehicle, it's this one thing. It's a pretty big cost item that they've been dealing with.
All right, so David, let's go to Stellantis, right? Maker of Jeeps, Fiats, Peugeots. Yesterday they reported net income that almost halved in the 6 months through June after they had a massive sales drop in the United States, also Europe. What's their story? And we know the CEO joined Surveillance earlier and talked about the possibility of maybe shedding some of the company's, 14 brands. So talk to us a little bit about the Stellantis story.
Look, I've wondered for a long time when they would shed some of those brands because I don't know if you guys remember this, but pre-bankruptcy, General Motors had 8 brands, and this is when they still had Hummer as a separate brand, and there was Saab, Pontiac, and they got rid of them. They got rid of Oldsmobile 20 years ago at least, because they were expensive to run and the volumes went down. And I think that's one of the cost issues, at least in North America, that Stellantis is dealing with, is some of these brands, there's still a cost of marketing them and running those dealerships, even if the dealerships are combined. And when the volumes get low, they weigh them down. That's not their biggest issue, though. Stellantis' biggest problem is the North American business is a very big profit center for them. Over the past 5 years, their sales of Ram pickup trucks and their sales of Jeeps have gone down a lot. This is a market that only buys SUVs. Honestly, as I look at this, I'm thinking to myself, how do you lose sales with Jeep when the market is, 2/3 SUVs and 80+% pickup trucks and SUVs? And they're one of 3 players with really competitive full-size pickup trucks, so Ram shouldn't be losing this much share to Ford and General Motors, but sales have gone down. So those are big issues for them. That's why sales are down. And they're still making money, but those 2 brands right there, that's a big gap in expected profit. And look, Jeep, they've kind of gone up in price on that. They may have gotten greedy. My bureau mate, Gabby Coppola, has written some stories about that. I think that's one of the things where they've lost sales is some of the Jeeps that were more accessible to either entry-level or middle-income buyers have gotten priced out of range, especially a period of high interest rates, and there is more competition, but it's such a great brand in the SUV business that they should be doing much better with it. The Ram's a little bit long in the tooth now. You've got fresher product from GM and Ford, and that always happens in the pickup business. There's always leapfrogging. Whoever has the freshest truck tends to get the sales and get better pricing, but it's been a very successful franchise for them, and you have to think that some of the cost-cutting that Tavares has done has put off freshening some of these products, and maybe that's an issue. Maybe he's cut into muscle in his effort to get out all the fat.
So if Tavares says, as he did this morning, that they could shed 1 or more of the 14 brands, what does shed mean to you? Does that mean they sell the brand, Or does that mean they sunset it?
Probably sunset it because he's not going to get rid of Jeep or Ram trucks or one of the big money makers or high volume brands. We're talking about things like the Chrysler brand, which sells a minivan, the Dodge brand, again, very small brands. I don't know who would want to buy those. Maybe somebody would, but it's not like they would get a big purse for selling them. So you're probably talking about sunsetting it in the same way that General Motors tried to sell Saab. It didn't happen. There were a couple of failed attempts. They even tried to sell Hummer. There were failed attempts to sell that deal, and they just ended up keeping it. So I could see some of those smaller brands go by way of Oldsmobile, Pontiac, and that sort of thing, and just getting the costs off their books and allowing engineers and managers to focus on the remaining brands. There's a lot of value in doing that.
I mean, Carol, it's pretty wild to think about an iconic American brand like Chrysler or Dodge being sunsetted and just going away.
Yeah, I mean, if you think about the changes that we've seen, especially coming off of the financial crisis, that was certainly a big change for that brand, right? We talk about Chrysler independently, and it's just not the case anymore. Having said that, one name that still is one of the old iconic brands, General Motors. David, they reported earlier this week, profit was up 60% from a year ago. They beat Wall Street expectations. The stock was lower, though, on the day that it came out. We've seen analysts downgrading the stock, but upping their price target. GM, how are they doing on a day when we saw a story about Cruise that you actually put out? How are you thinking about General Motors right now? And just got about 30, 40 seconds.
Sure, when I looked earlier, their stock was down too, just not nearly as bad as the drops at Ford and Stellantis.
Yeah.
Look, GM is actually operating pretty well. Their profits are up. They were bigger than expected for the second quarter and first half of the year. The reason the stock was down is since they did raise their guidance, probably conservatively, it implied that the second half wasn't going to be nearly as good as the first half, so I think investors said this is as good as it gets. Some of the counter argument to that is GM is always conservative with their guidance. They always are nearly always beat it, and then they raise expectations, or they raise their guidance again. And so some of the analysts are saying, hey, buy the dip because GM always does this. They're always very conservative, very cautious, and then they beat it. So, we'll see what happens, but I think fundamentally GM isn't showing some of these issues like declining SUV sales or quality problems that the other two are.
All right, we're going to leave it on that note. GM shares, as you mentioned, David, down about 4%. That's Bloomberg News Detroit Bureau Chief David Welch joining us. Hey, still ahead, staying downstream of the Fed's liquidity river. We're going to get into that. That's more on the other side of the break.
Before that, though, a check on the latest world and national news. We got Amy Morris in the Bloomberg 99.1 newsroom in D.C. Hey, Amy.
Hey, Tim. Former House Speaker Nancy Pelosi has endorsed Vice President Kamala Harris for president.
Make no mistake, this is a politically astute Vice President of the United States. I've seen her in action. I can talk about it on another occasion at more length, but let me just say, she is capable officially, personally, and politically to lead us to victory in November.
Pelosi speaking at an event for Democratic women in Washington. Vice President Harris addressed the American Federation of Teachers National Convention today in Houston, Texas, saying she's a product of public education and she still remembers her first grade teacher.
So it is because of Mrs. Wilson and so many teachers like her that I stand before you as Vice President of the United States of America. And that I am running to become President of the United States of America.
Harris thanked the AFT for becoming the first union to endorse her for president. A new poll shows Donald Trump leading Kamala Harris in 4 swing states, but in 3 of those states, the lead is within.
So we're seeing the release of the NYMEX closing prices for the day. NYMEX WTI crude September futures settling at $78.28. Natural gas August futures at $2.04. Also seeing gasoline futures settling at $2.47 and diesel futures at $2.47 as well.
This is Bloomberg.
why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Also seeing Brent crude futures settle at $82.37 a barrel, which is up 66 cents or 0.81% on the session.
Of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo Pet Products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that you know most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
The names that move markets are on Bloomberg.
We've seen story after story about companies delisting from the London Stock Exchange, listing in New York, listing in Europe. I want to turn that around. I want Britain to be the place of choice to make an IPO, to grow your business. That's why I welcome the reforms that the FCA put in place last week. It's also why I'm determined to change our pension system so we can keep more businesses here in Britain.
Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We do have stocks well off session highs, but still looking at a lot of green for the Dow, the S&P, and NASDAQ. Right to the numbers, S&P 500 index up now by 17 points to 54.44. That is a gain of 0.3%. We've got the Dow up 322 points now, up 0.8%. The NASDAQ Composite Index up 35, higher by 0.2%. The Russell 2000 Index, the outperformer by far, up now by 1.9%. Again, the S&P, to put that in context, up 0.3%. 10-year 4.25%, the 2-year 4.44%. Spot gold down $38 the ounce to $23.58, down 1.6%. and West Texas Intermediate crude up 0.8%, 78.23 a barrel. Traders betting that the Fed will be able to engineer a soft landing are spurring a rally in riskier corners of the market. Stocks rebounding today after yesterday's sell-off that jolted markets around the globe. Ford shares are slumping after that big earnings miss that the automaker blames on a surge in warranty repair costs for older vehicles. As we have been reporting, Ford down now by 17.9%. Among other automakers, Stellantis down 6.9%, GM down 4.3%. So again, recapping, stocks holding on to gains. S&P right now up 15, up 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie, going through the markets, we've talked throughout the day how economically sensitive shares such as financial and industrial companies have led gains today. Smaller firms extending this month's surge to almost 10%, largely outpacing the group of tech mega caps. And if you take a look at an equal-weighted version of the S&P 500, where the likes of NVIDIA carry the same heft as Dollar Tree, just to give you an idea.
What a world.
Yep, beating the U.S. equity benchmark. So let's get back to the trade.
And the factors that really matter, like Fed policy and earnings. Back with us is Doug Sioka, CEO and partner at Kavar Capital. They've got approximately $1.25 billion in assets under management. Doug joins us once again from Leawood, Kansas. Doug, what really matters when it comes to today's investment environment? Is it anything on the Fed and earnings?
Oh, I think so. And great to hear both your voices. And thank you for having me on. You know, you think about like what's been happening the last 2 weeks as it relates to like earnings trends, right? Dominant sectors coming to life, tech earnings having a hard time fulfilling lofty expectations, consumer strength being stretched a bit, industrials and staples are beating and raising, and you combine that with expectations of lower rates, going back to the priority and importance of the Fed, and maybe most importantly, even or equally important, is a weaker dollar. And that's going to lead, like, I think some of this rotation / pivots / shading in the directions what kind of commonly are mentioned, right? Smaller cap companies, like you just said on the lead in, international investments, and really reinforcing a balanced portfolio and how you're fortifying your bond portfolio.
So how much, I don't know, I'm curious what you're hearing, Doug, from clients, from investors in this environment where I know for us in the media business, there's so much news coming at us.
So according to a New York Times and Siena College national poll, Trump leads Harris 48 to 47%.
There's a fair amount of volatility in the trade, depending on the economic print of the day or maybe the Fed conversation, although I feel like the Fed narrative is calming down and getting more kind of all on the same page. Are people looking to play it more safely at this point? Or if they've got new money to work, are they willing to take an opportunity when they see the NASDAQ 100 down more than 3%? Like, what is it?
Yeah, that's a great point, because look, if you think about like what are markets, right? They're just a manifestation of the kind of collective wisdom and emotions of their participants, right? Or maybe now they're surrogate algobots. But uncertainty is seeming right now to Trump, and that's not an intended pun, uncertainty, right? Uncertainty is trumping certainty. And so you have this manic nature that's reflecting shifting sands and heavy decision points that investors are feeling in other aspects of their lives, right? To your point, Carol, where are we with the political perspective? Where are we with the geopolitical perspective? And are we really lining up with monetary policy perspective? I mean, for crying out loud, before last night, we didn't even know we could watch the NBA next year. So like, there's just a lot of things that are being sort of...
All right, now it's getting serious. I know.
But seriously, you're right. But you really think about this is like the preeminent environment for dollar cost averaging, particularly into sectors and parts of the market that haven't been participating, right? That have been, left behind with all the excitement about tech and AI. That's left a lot of gaps and opportunities to put money to work in a very progressive fashion where you can make this volatility your friend.
So, Doug, what does work? Where should people be dollar cost averaging right now? Small caps?
Certainly small caps, but also look at yesterday, right? Not to be super dismissive, but the S&P had gone 356 consecutive trade days without a 2% drop. Longest streak since 2007. So this Mag 7 index on Bloomberg is down yesterday 12% for the July 10th high, which we got that friendly reading of CPI. And you had four sectors that outperformed not only the whole market, were higher on the day: healthcare, energy, staples, and utilities. So these are going to be, right, potentially the catch-up trade. And I think it's fascinating that portfolio managers are obsessed with terming the current trading patterns as a pivot or a rotation. it's mean reversion, right? It's attended to a shift in underlying monetary policy. We didn't just go through 99, right? We were not on the precipice of some kind of a dot-com like bubble and debacle. At some point, the breadth had to widen, and I think, Tim, that's what's taking place. And those 4 sectors as beacons yesterday, I think, were very representative of that fact.
So, you know, it's interesting. I was just looking, and somebody else, I think, pointed this out on Bloomberg. You know, the S&P 500 hit a record. It was only a few weeks ago, right? July 16th. We're down about 4% from that record. Markets go up, markets go down. I mean, do you feel that prior to this, or that even markets are still a bit elevated when it comes to valuations based on what we've seen so far, about 1/3 of the S&P 500 reporting?
Yeah, and the third that is reported have come a little shy of expectations, about 6.5% year over year, but maybe only 1 to 2% quarter over quarter. But I think, Carol, the market has been so good since October of last year. Sometimes it's easy to forget that up until that pivot point on October 28th, the S&P was in a 10-11% drawdown, the NASDAQ 12 or 13, right? So you had a little refreshing pause that was very beneficial. People talk about how awesome 2023 was, and somehow completely forget that 2022 was horrible, right? From every class of asset perspective. So I do think having some of these pullbacks in the S&P, 4 or 5%, if it gets a little deeper, that would make a lot of sense to us, just because you do want to stave off a more problematic air pocket into the future. So we kind of enjoy the volatility, again, from the standpoint of having these dollar cost averaging opportunities.
Yeah, we're still up 32% on the S&P 500 from that late October 2023 low.
Yeah, pretty remarkable in a relatively short period of time. All right, so you said that we have a hard time understanding where we're going to be watching NBA games in the near future. We don't know who's going to be in the White House come January of 2025. How is political risk weighing on the trade, or do you think political risk even matters?
So over long periods of time, Tim, empirically it doesn't, right? Undeniably, every bit as important as the occupant of the Oval Office is going to be the lineup congressionally speaking. What I think undermines the market any confidence that it's trying to transition through this election period would be if the election doesn't end. Right? We all went through on this call what was taking place back at the end of 2000 with the hanging chads of the Supreme Court decision in the last week of December. I think because there's such polarity across parties in the country, going back to kind of collective manifestation of the wisdom and emotions of investors, that would weigh heavily. And I think that level of uncertainty would likely cause people to maybe want to take a little bit less of an aggressive path with other aspects of their life, including investing. So to me, that would be kind of undermining to the market. Having a really nice follow through to the back half of the year would just be an inconclusive outcome on election day or election month.
Hey, Doug, just quickly, got about 30 seconds here. I mean, the past few weeks, as we kidded or have been kidding this hour, that has been chock full of political news, particularly about the U.S. presidential race. How many conversations are you having with clients and investors around this? And again, just got about 30 seconds.
Yeah, a lot, Carol. I mean, it comes up quite a bit. You know, I think a big part of a job of wealth advisor is to continue to reinforce objectives, and not just to say, hey, over the long term, we know things typically would end up being fine, but let's make sure we understand the consequences of activity that could be undermining to achieving our objectives. So it all kind of comes back to the context within a financial plan that we set realistic objectives that'll couch the amount of risk we should be taking at any point in time anyway.
All right. Great stuff. Doug, as always, thank you so much. Doug Sioka, CEO and partner at Kavar Capital, joining us on this Thursday. As we get ready to wrap up this hour, I am thinking about you.
Why?
My colleague and co-host.
Oh, because of Chipotle? Getting more food?
Because of food.
Is that why?
Would you like to get 2 generous scoops of rice and 4 ounces of meat?
Well, let's just say Chipotle is responding to complaints. Let's just say that.
We'll get into it. That's next.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Now, your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We have got Uber, Lyft, DoorDash, an important ruling involving those companies out of California. They can keep classifying California drivers as independent contractors after the state's top court said a company-backed law passed by voters does not wrongly curtail the legislature's power over worker protections. The ruling upholds California's Proposition 22, and it was unanimous. Uber shares little changed, up 0.1%. Lyft down 1.1%. DoorDash lower by 0.1%. Southwest Airlines is going to begin offering assigned seats, ditching that free-for-all policy that has been a defining feature of the carrier for more than half a century. The airline announced the seismic change to its business model alongside a new premium class option and plans for red-eye flights. It shifts the company and it sees boosting sales and also enhancing its appeal. While Southwest said earlier this year it was reconsidering the seating policy, it is now facing heightened pressure to revamp underperforming operations from activist investor Elliott Investment Management. Southwest shares today, they're flying higher along with the rest of the airline group. We've got Southwest up now by 6.1%. American Airlines has slashed its earnings outlook for the quarter and the full year, making it the latest carrier to temper expectations as industry-wide fare discounting and high costs squeeze earnings. Shares of American, they're advancing now by 4.2%. And those are some of our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week. Let's get a check of the latest world and national news. We got Amy Morris in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Amy.
Hi, Tim. Vice President Kamala Harris addressed the American Federation of Teachers National Convention. That was in Houston today. It's the vice president's second appearance since becoming the de facto Democratic presidential nominee.
From the public service workers and higher education faculty to the school bus drivers and the custodians to the school nurses and our teachers, you all do God's work educating our children.
She thanked the AFT for becoming the first union to endorse her for president. President Biden has signed into law a new bill that strengthens oversight of the Federal Bureau of Prisons. The Federal Prison Oversight Act establishes an independent ombudsman to field and investigate complaints in the wake of sexual assaults and other criminal misconduct by staff, chronic understaffing, escapes, and high-profile deaths. It also requires the Justice Department's Inspector General conduct risk-based inspections of all 122 federal prisons and provide recommendations. An advocacy group is suing New York Governor Kathy Hochul for pausing the city's traffic congestion pricing plan. They say she doesn't have the authority to do that. That plan would have charged most drivers $15 to drive into the city. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. Now back to Bloomberg Business Week with Carol Masser and Tim Stenovic.
All right. Thank you so much, Amy Morris in our D.C. Bureau. All right, folks, one more thing before we head out on this hour, and this has to do with Chipotle. We've been kind of kidding. We talked about...
It's not a joke.
What's that? More
portion sizes are not a joke.
Portion sizes are never a joke. Well, Chipotle apparently coming out and saying making sure all of its diners are getting generous serving sizes. So they want to make sure that they are going to put out those bigger portions to keep everybody happy. So we kind of teased earlier that we're talking about 2 generous scoops of rice, 4 ounces of meat. They want to make sure that their workers are giving them along. But you know what? Bigger portions mean what? That
means they're spending more money. The company CFO said that meeting these standards is going to cost the company an extra $50 million. But Carol, look what they're responding to. You had people complaining online and sort of doing experiments about going to different Chipotles at different times and getting different amount of food. You even had one analyst who actually went out to different Chipotles all over the New York City area and weighed and got the same order and weighed the bowls and found big discrepancies. And it turns out Chipotle was listening. And this has affected not just the company stock not just today, but in the last few months as well.
Yeah, it's interesting. Listen, we've all been there, right? Where like somebody in front of you, they get a bowl and it's like, you know, or I'm not saying about Chipotle, but anywhere where somebody gets a bigger portion and then you come up and you're like, wait a minute, what's happening here? Like, where's my extra scoop? So there is something to consistency, right, in terms of how you are serving your customers. So that's something that they certainly seem to be taking note of. I should point out Chipotle, I mean, this is a stock that's still up about 12% so far this year, and it's been on quite a run over the last few years. But they are also, you know, I guess trying to think about whether or not do you pass this along to customers at a time when we are increasingly talking about consumers are becoming much more price sensitive.
Chipotle doing very well, though. It's one of only a handful of large restaurant chains that has consistently grown traffic in recent quarters. And the results show that most diners still see the burritos and bowls as a good deal, and limited time offers such as chicken al pastor are drawing customers in. So net, they're doing pretty well.
Yeah, the CFO, Jack Hartung, on their call saying that the company has no plans to increase prices again, or increase prices this year. But he does add that he expects avocado prices to ease by year end. So maybe some of the pressures on the cost side coming off. So
what's your go-to bowl, Carol?
I like kind of everything, some avocado, a little beef.
Okay, beef, okay.
Does that
chicken.
make sense?
Yeah.
You're a chicken kind of guy.
Chicken, throw everything else in there.
Chipotle shares down about 1%. All right, for those who are watching on TV, the close is coming your way in just a moment. Tim and I continuing on Bloomberg Business Week. Lots to come in the next couple of hours. This is Bloomberg.
Countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
A rebound in U.S. economic growth spurring a rebound in economically sensitive stocks. Live from Bloomberg's world headquarters here in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Let's get a check on where markets stand right now, because we started the day with Wall Street in recovery mode from yesterday's big sell-off thanks to the latest batch of economic data. Those gains have since faded. You can see the S&P 500 unchanged at the moment. The Magnificent Seven actually in the red, down 0.1%, although Tesla is bucking that decline, actually higher today. Remember, the Mag 7 yesterday fell almost lost 6% as a group. The S&P 500 yesterday tumbled 2.3%. The Russell 2000, though, clear outperformer. So small caps, that rotation into this group is still intact for now. And we're looking at yields lower for mostly across the curve. The 10-year down 2 basis points to 4.25%, Romain.
Yeah, the move in yields and the move in the Russell really tied to one big number, and that big number of the day has to be 2.8%. That was real U.S. GDP growth in the second quarter, more than a percentage point higher than in the first. A major economic data point that should be warmly embraced by the Fed and is already being embraced by investors who are sparking another day of outperformance by small cap stocks versus those large caps. We'll get back to that in just a second, because while a big rebound in personal spending did help stoke those official GDP numbers from the past quarter, look ahead to the next quarter. Some bumps on the horizon, at least if you believe the commentary out of several corporate executives, Stellantis, Whirlpool, Nestle, United Airlines, just to name a few. Consistent commentary about how a multi-year inflation cycle has finally put real pressure on household spending. And that is the conundrum for a Federal Reserve that has been seeking to stick that economic soft landing, a landing that Mohamed El-Erian, as well as Bid Dudley, says could too easily slip away if unhelpful, noisy data delay an interest rate cut beyond September. Take a listen.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. If the Fed doesn't cut in July and waits till September.
Bill Dudley there, and Scarlett, this gets to the trickiness here of that soft landing, right? I mean, the fine line between a Goldilocks scenario and, well, a downturn is fine indeed.
And that's why everyone's obsessing over every economic data point that does come out. So let's circle back to today's batch. And the centerpiece of it really was GDP. And as you mentioned, it showed the U.S. economy grew more than forecast in the April to June quarter at a 2.8% annualized rate. It's a clear sign that demand from both consumers and businesses is holding up under the weight of higher borrowing costs. The print is up meaningfully from the 1.4% rate in the first 3 months of this year. Now, some analysts say that this report reinforces the idea that the central bank has the benefit of time and therefore doesn't need to rush a rate cut in July, but it puts more onus on doing something in September.
All right, let's kick things off to the close with Diane Swonk, KPMG's chief economist. So, of course, on the heels of a very encouraging gross domestic product report. And Diane, with the caveat, of course, that's looking backwards here, it's still a pretty significant improvement from what we saw in the first quarter, not just on the headline number, but really when you open up the hood and look at where those personal spending dollars actually went. Were you encouraged?
Absolutely. I think this is as close to use the word I was going to use, as close as a Goldilocks scenario as the Fed's going to get right now, because what we saw was consumers push back. They were defiant in the first quarter. They didn't spend on goods. And then we saw major retailers, vehicle producers who said they'd never, reinstate incentives again. Yes, they are reinstating incentives now. Lots of lease incentives, lots of incentives, even on the markdown on price. Remember, just a few years ago, we were talking about above sticker price on many things. Those shifts actually brought consumers back. And that is encouraging. But, there are things that people are worried about, and that is that we've seen an increase in unemployment. Most of that's due to more people looking for jobs. But we also know that those who have lost a job are taking longer to find a job. We know that the jobless rate for new college grads has moved up more rapidly than the overall college graduate unemployment rate. And so there are some cracks in the foundation, and you don't want those cracks to spread to become larger fractures in the foundation of the labor market.
It gets to a point then when you look at the state of the economy or the general health of it, and this idea of whether you want to call it soft landing, Goldilocks, et cetera here, does this create a situation for the Fed, as Bill Dudley and Mohamed El-Erian said earlier today, kind of forces their hand to do something sooner rather than later? Or do you think they have the luxury of waiting?
Well, I don't think they're going to do anything until September. I think that there is still a need for them to feel really confident. And let's face it, we saw what the ECB did. They cut, and now they're sort of caught in a, no man's land of pausing because they've seen stickier service sector inflation. We need to see that goods deflation continue to offset more structural inflation in the service sector. And there are still things out there that could pop it up. We also know every time mortgage rates really come down, now the consumers have held back a little bit. There's a lot of pent-up demand on the sidelines, but the supply picking up at the same time when mortgage rates do come down, that those millennials can finally buy the the homes they want to buy, you need more inventories out there, or you're going to push prices back up again. So it is a hard thing to do. And let's face it, when the Fed got the soft landing in the wake of the 1994 hiking cycle, in 1995, they cut rates after we actually saw red ink unemployment for 2 months. It was later revised away. But it was, it's a bit of a luck thing that was actually a soft landing.
So I got to ask you about the other side of the Fed's mandate, which is, of course, maximum employment. We get the jobs numbers next week, and there's going to be a lot of focus on whether there's a weakness in unemployment or unemployment that would push us towards triggering the SOM rule, an early recession warning. How have expectations for the jobs report changed or shifted as a result of this latest batch of data?
I'm not sure it's changed all that much, but there is a risk. I mean, we're 0.7 basis points. I mean, it's 0.43, 0.5 on the SOM rule is that it's, signaling it could be a recession. We, even Claudia has been sort of forthcoming and saying it doesn't, it's not clear. It's the same thing in this kind of environment. And we do know that much of the increase in unemployment has come from an influx of workers looking for jobs more than layoffs. But like I said, there are underlying cracks where those people who are laid off are finding it harder to find a job, and new college grads are finding it harder to get a job once they graduate. And those are things we have to watch for. So, it could trigger the SOM rule next week. I don't think the Fed is as focused on that as some others are, and maybe Bill Dudley is at this point in time. But I do think it is one more piece of information that we have to watch, because we've had a lot of momentum, and that's been great. Today's orders data was also good, but there are places where it's weak, and the housing market is one of them. And consumers at the bottom of the income strata, the bottom 30% really, don't have any savings left, and their credit cards are compounding at very high rates.
Yeah, I'm glad you bring that up, because I'm curious to get what you think is happening with the corporate results that we are seeing lately. This idea of revenge spending, which has really supported the economy for so long after the pandemic, has kind of given way to reluctant spending. People are spending, but they're being very, very selective about how and when they do so. What earnings reports have you seen that really raised your concerns?
Well, I can't talk about any specific companies, but I think what you're starting to see is some of the pushback on margin compression. And that is exactly, what retailers did. Big box discounters were the first ones out of the box to say we're going to roll back prices. They set the tone for the entire industry. We saw fast food chains also give discounts out there. That's very important as well. But all of that compresses margins, right? And it's a volume play over a margin play, but it does mean that it's much more difficult to get that extra earnings out there. And I think that's exactly what we're seeing. And what you want is that's part of the Fed's strategy and what they were trying to do. But on the flip side of it, you just don't want it to hit a tipping point and accidentally hit a tripwire where all of a sudden that means more layoffs as those margins compress further.
All right, now I give you the tripwire of a political question here, Diane. Everyone is focusing on the election this year, more from the perspective of how any shifts in fiscal policies could either help or probably hinder some of the progress that the Fed has made on inflation. Any concerns there?
There's lots of concerns. There's lots of things out there. When you talk about tariffs and immigration policies, those tend to be higher tariffs, which we've just seen. Actually, we saw hedging. We saw one of the reasons we saw the increase in inventories in the second quarter was because people were buying ahead of tariffs that just went into effect. That's going to continue, but the more tariffs you get out there, they are inflationary. That's a problem. The more you curb immigration, which has helped to balance labor markets a little bit more, the more inflationary a situation you've got, and then you've got the Fed raising rates instead of cutting rates. So there are policies out there that we have to think about, but at the end of the day, I think one of the most important things to note is that although we all judge the economy now, we know that consumers do it through the lens of their partisan affiliation, there is a reality to what is being experienced. Many Republican strongholds saw a lot of migration from very wealthy states and wealthy consumers into their areas. That bit up inflation in those Republican strongholds, and they actually experienced more inflation than former Democratic strongholds or Democratic strongholds. And so the divisions we're seeing are also real economic differences. So, you know, when I talk about the economic data, it describes everybody, but no one in particular.
Yeah, absolutely. Inflation on the top of a lot of voters' minds. It'll be interesting to see if that drives the results. Diane, always a great conversation. Diane Swong, KPMG's chief economist, helping kick us off to the close here on this Thursday afternoon. When we come back, a closer look at the market moves, that rotation into small caps. It continues. Ralph Schlosstein, Evercore's chairman emeritus, is going to be joining us to talk about this rally in the riskier corners of the market.
Plus, the biggest IPO of the year. You have shares of Lineage popping as the storage and logistics giant makes its public debut. And
what's the future for Warner Brothers Discovery after missing its shot on holding on to its NBA rights? We're going to speak to Macquarie's Tim Nolan, who just downgraded the stock in today's top calls. All that and more coming up in a bit. This is The Close on Bloomberg.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep winning World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing
earnings out of Broadcom.
JP Morgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
We, set out to build a forever company when we started this, and we never tried to time the market. We just wanted to take good long-term decisions to continue growth at scale, which is what we've been doing. It was just the right time for us to be a public company, to have the right cost of capital, to have the fortress balance sheet, to go out and continue to bring in the best assets in our business and to invest in our customers' growth.
Lineage co-founders there ahead of the company's public debut. Shares of Lineage, of course, moving higher as the temperature-controlled storage and logistics giant began trading today. They raised about $4.4 billion. Again, the year's biggest IPO. Bloomberg's Bailey Lipschultz has more. Yeah, and of course, Romaine is impressed because we thought the IPO market was dead.
Can I do my joke first? $4.4 billion. That's cold, hard cash.
You've been rehearsing that, right?
Yeah.
It's been rehearsing
I'll just see myself out.
Yeah.
All right, so this heralds what? The comeback of the IPO market?
I don't know if I'd go that far. It is the busiest week since ARM after Labor Day last year, which everyone thought that was going to be the deal that helped open the IPO market. Shortly after that was Instacart. A little bit later was Birkenstock, but we did have the market really correct back in the fall of 2023. So biggest deal since then. We do have the busiest week since that week. Expectations had been high. I mean, I call it a 4 1/3% rally is kind of in line with what some of the buy-siders I've talked to were expecting. Not really a huge move, just given the fact that $4.4 billion is a lot of money, and it is a REIT, so it's not like OneStream, which we saw pop 34% yesterday.
Yeah, I mean, it's interesting, too. I mean, when we talk about this company's business and this idea that there might, I mean, obviously they see a lot more demand for cold storage, particularly with people ordering more medications online, groceries, other things like that. They keep in. What's like the growth story here? Because when we talk about the post-IPO performance, the secondary market performance here, it seems like we've seen these IPOs fizzle out pretty quickly because no one can really articulate what that longer-term growth story is going to be.
Well, it's a lot of putting money to work. So when you look at the REIT space in general, acquisitions are kind of what you raise cash to do. So that's when we're looking at the REIT space, not only do you have a catch-up trade over the last few months of valuations getting better, still nowhere near some of those AI names, but when you look at the underlying business and the expectations that they can put cash to work, that they continue to grow through some of these bolt-on acquisitions, that actually is the strategy, as opposed to, you know, a technology company that maybe has been waiting in the wings for 4, 5, 6 years, who hopefully is just going to continue to grow its bottom line.
And at least this seems somewhat unique. I mean, I don't know how many other publicly traded cold storage REITs there are, but
yeah, that's very specific.
It's new to me.
It definitely is niche-y. We spoke with the CEO of the NASDAQ Stock Exchange earlier today. Let's listen to what she said about not just Lineage, but companies coming to market.
The monetary policy outlook and other geopolitical, factors, I think, are still keeping investors a little bit more risk they have a little bit more risk aversion. But we're seeing some real good progress, and we think that going into 2025, we should see more momentum in terms of the pipeline of companies that we've been talking to.
So that brings me to my next question. What does the pipeline look like end of 2024 and into 2025, where a lot more is expected to come on?
Yeah, the big focus right now is really that second quarter 2025, which ironically this time last year, everyone was saying second quarter 2024. So wishful thinking that we're still 3-6 months away from that return. But the big expectation is you'll have the uncertainty around the election in their rearview mirror from at least a banking perspective. Likely you will have a few interest rate cuts. You should have kind of a more normalized environment for some of these smaller companies. So there's a lot of excitement about who could go in 2Q. We do see, the likes of a StubHub still being floated as a potential fall target. But the big thing is, and when you look at, again, Lineage, $4.4 billion, when I talk to people on the street, that's signed, sealed, delivered, the biggest IPO we'll see in 2024. So moving to 2025, you could see some of those bigger names like a Stripe or a Databricks 2025, 2026 timeframe.
All right, Billy Lipschultz here. A closer look at the IPO market. The new kid on the block, Lineage Scarlett, selling last night at 78, opening today at 82, pretty much where it's trading right now. And it was interesting, too, about cold storage, too. I mean, it kind of sounds esoteric, but I had an interview with the Carrier CEO a few months ago, and he was actually talking about this was a big opportunity, particularly overseas. And then I even noticed in my apartment building here in New York, they actually put in a fridge.
When they take deliveries?
Where you get package deliveries? And they put in like this industrial fridge. And I said, what's that for? And they said, so many people are getting medications and other things that needs to stay cold until they come home. And food deliveries as well. So they felt compelled to, I guess, spend, part of our fees on this new thing.
Does this mean that dry ice companies, they're hurt by this? I don't know.
I like the way you think, Scarlett Fu. All right, when we come up, we're going to talk about Warner Brothers Discovery here, a downgrade today on the back of them losing the rights to the NBA to Amazon. It's part of our top calls, and it's up next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly.
I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
All right, let's get a view from the sell side. Top calls, the big movers on the back of analyst recommendations. We're going to start off today with Lamb Weston, the maker of French fries and other potato products, getting several downgrades after a disappointing earnings report. Bank of America dropping its recommendation to neutral, saying the industry is entering uncharted territory as companies weigh greater price concessions given weaker sales volume. Also peeling back the price target on Lamb Weston down to 66 from 109. The shares peeling back by 5% down below 54. Next up, Lululemon, not fit for a buy rating over at Citi, a downgrade of the athleisure brand to neutral. Lululemon actually telling Bloomberg that it's halting sales of its Breeze Through yoga wear, a move that the analyst says signals weaker trends and leaves Lululemon more susceptible to increased competition and promotional pressures. Lululemon having one of its worst days in at least a year. And finally, let's take a look at Warner Brothers Discovery. Macquarie downgrading the stock to neutral, with the analyst saying WBD missed its shot with the NBA by losing out on those broadcast rights to Amazon. He calls it a huge loss of a core content asset for both the linear network and the Max streaming service, and he now expects the company to accelerate any plans to break up. Shares down about 5%, now camped out right at $8.03 a share. Woof. Those are some of our top calls, and pleased to say the analyst behind that last call is joining us right now. Tim Nolan, Senior Media Tech Analyst over at Macquarie. Let's get right to it. I mean, there was a lot of concern here that they were going to lose this NBA contract. They had a chance to bid. They had a chance to outdo Amazon's bid. They chose not to. Do you think that's going to be a mistake?
Well, in a way, that's the conundrum, isn't it? They've had an exclusive for a long time, up until April or so, and then they didn't take advantage of that. And then they've had a few months since then to try to fight and match, and evidently now it's going to go to the courts. So it's unfortunate, and it's probably a function of Warner Brothers Discovery being a little bit hamstrung financially, given the debt load that they've got. And perhaps not completely clear on whether they really wanted the NBA or not. I mean, they said at one point they don't need it, and now they're suing to try to keep it. So uncertain what was behind the thinking there, but I do think it's a big loss for TNT and for WBD as a whole.
You're referring, of course, to David Zaslav, the CEO of Warner Brothers Discovery, saying in May at an RBC investor conference, we don't have to have the NBA. Clearly, you don't agree with him. To what extent can you trust what he says then going forward, Tim?
Oh, I don't know about that. I mean, it might have just been a public posturing comment. I don't know what was behind it. But I do think the NBA really was important, or maybe still is important for WBD if they can somehow manage to win this lawsuit or whatever's going to happen next. But, you know, it's an important component, not only to the linear networks, which a lot of people are worried about right now, given the downturn in advertising, which is probably structural for linear, and given the loss of potential bargaining leverage on affiliate fee renewals. But I'm more concerned about the Max streaming service, because streaming is the present and future. It's a very competitive space. They've got a great offering with some deep studio content, you know, HBO, Warner Brothers Studio, Discovery Lifestyle content, lots of great stuff there, kids programs, and until fall of 25, a lot of sports. But you take the NBA out of that, and that critical sports component goes away. And I just think it's really unfortunate, because it would have been a very good way to draw and retain users to the Max streaming.
So U.S. Vice President Harris, as well as the Democratic nominee Harris, are ready to debate Trump, she says.
Questions about how this company might be broken up. That does seem to be the impetus that Zaslav brings to the table. Do you think that's going to happen? And if so, how quickly?
Oh, I don't know. I mean, there is certainly corporate intrigue across the media space these days. The larger companies with the budgets to support streaming services seem to be in a better spot.
Yeah.
And the smaller ones are struggling. I don't know if a breakup. Look, there was an article last week in the FT talking about this. I don't know how realistic it is, but there is activity afoot underneath the waves, and so maybe a breakup is a way to release value from the linear network separately from the studio and the streaming.
I just have to ask you another quick question here, Tim, and this is more about content creation, and this is just some breaking news that came out just a little while ago revolving the video game makers and SAG-AFTRA basically authorizing a strike that effectively starts tomorrow and does affect Warner Brothers. It affects their peers as well. And of course, we're coming off of that actors and directors strike from a year or so ago here. Are you concerned at all that if we see another major disruption in content creation, that could provide another big headwind for valuations?
If this is news that's just come out in the course of today, I've missed it. I thought you were referring to something from last year. But yeah, that was disruptive. Another strike would be disruptive. I mean, they're just kind of crawling out now from the delays to production from the strikes last summer. So it's hardly what the industry needs at this point.
Yeah, very well said. They need to get going with the production. Of course, that costs money, and that's another issue entirely. Tim, really appreciate your joining us today. Tim Nolan over at Macquarie on his downgrade on Warner Brothers Discovery. Coming up, we've got Ralph Schlosstein. He is Chairman Emeritus of Evercore, joining us to discuss his outlook for the U.S. economy and the markets, the rotation into small caps. This is The Close on Bloomberg.
The biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Bloomberg Power Players is back this September. As the top names in tennis take the court over in Queens, we're convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at BloombergLive.com/powerplayers.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Scarlett Fu. Romaine, you look at the major indexes, they've been up, they've been down, they've been up again, but what's remained steady throughout today is small caps and how persistent that advance has been, that outperformance since that June CPI report a few days ago.
And it all seems tied to the perception of economic conditions being better than they are, and of course the speculation that we're going to finally start to get some rate cuts that could actually help out some of those small caps. And let's face it, it was higher interest rates to a certain extent that led to the small caps being such laggards, but really over the last, 12, 13 sessions, they've really bounced back.
And it's not just small caps, right? It's the other 493 companies in the S&P 500 that aren't the Magnificent Seven. You can see the equal weight S&P 500 has beat the S&P 500, the weighted S&P 500 for a third straight week. So let's talk a little bit more about some of the drivers behind that rotation. Let's bring in Ralph Schlosstein. He is Chairman Emeritus of Evercore. Ralph, it's so good to see you here in our office.
It's great to be here again.
Thank you for joining us today. What are some of the assumptions that are being rethought here as investors, looks like, are much more convinced that the other stocks that aren't the Magnificent Seven and small caps really have some ways to go here?
Well, first you have relative value. The multiple at which those stocks trade is dramatically lower than the Magnificent Seven. Second of all, as you pointed out, those stocks are the ones that are most negatively affected by higher interest rates. And I think it's pretty clear we're closer to interest rate cuts by the Fed, and that is helpful to them. The one thing you didn't mention, which I think is very important also, is that small caps tend to be more domestic in their sales.
Good point.
And so given the relative outperformance of the U.S. economy, cap stocks.
And absent in your answer there was the benefits of the big technology companies. I mean, they are still making a lot of money, maybe not as much as investors would have liked, but
world-altering technological change. You go through a cycle. Cycle is massive spending. Then there is a part of the cycle where people say, of the other side, there are companies that will be massive beneficiaries of technology. So there will be a sorting out. My guess is that collectively, that's typically what happens with massive technological change. However, it won't companies.
I am curious, though, about what's driving that change. I mean, when you started your career, we were kind of going through a different... Some of that aided, or at least seeded, we should say, by government involvement, government policies, government investment. We're kind of like to be a little more involved. Do you feel, though, that the changes that are coming, even if they're not shared by all, that this is that big an inflection point?
Well, I think there are a couple of interesting things that are very different in my Google and Meta and Netflix, and that really is going to improve the performance of almost every company. For having technological change that significantly affects the jobs of white-collar workers. And so every company margins utilizing AI. It's going to take a while to happen, and there's that it's likely that the greatest beneficiaries
are still private. A whole cohort of at least public investors, they don't necessarily have access to be able to get in on the ground floor the way a lot of private investors have come. And I know that's been a broader change that we've seen in investing overall, where private markets have been, at least for a certain investor class, much more accessible than the public markets.
Well, I think the reason for that is a couple-fold. Number one, these companies don't generate any earnings. So valuing them in a public market is a little bit more challenging. The second is they're materially more risky than the average public company, and therefore are more appropriate for large, deep-pocketed institutional investors who, by diversifying, can afford to have some, what we call in the investment business donuts, where a lot of money is invested and it winds up being worthless. So that's, in my view, best done in the private world. I think if you look at the last set of technological innovations, you take a company like Amazon. So Jeff Bezos brilliantly put the pedal to the metal for 20 years and created a category killer of a company. If you go back 20 years, logically, Amazon should have been created by Walmart. They had the customer base, they had the countrywide distribution network, they had all the things, the logistics that Amazon had to build. Why didn't that happen? The reason is there were 20 years of negative income statement to build a huge terminal value.
Right.
We would have probably had 5 CEOs of Walmart over that period of time if they had tried to do that, and the board would have been attacked by activists every year. So it's very hard in a earning public company to do these terminal value investments.
The patience is just not there, right, from public investors. I want to get your take on politics, because I know that you are a supporter of Vice President Kamala Harris. You back her campaign. What is the best argument you can make for why she is good for the U.S. economy?
Well, I think if you look at the accomplishments of the Biden-Harris administration, and quite honestly, I've been mystified why the president and the vice president haven't focused on this more. Many of the things that they accomplished were things that President Trump talked about and did nothing about. He talked about bringing technology and semiconductor jobs back to America. The Biden-Harris administration passed the CHIPS Act. He talked about lowering drug prices. Nothing happened. Biden and Harris have actually lowered the price of insulin and allowed for the first time Medicare and Medicaid to negotiate on certain drugs. And so I think if you look at the infrastructure, another one, you will recall President Trump talked a lot about infrastructure.
There are a lot of infrastructure weeks.
And in reality, President Biden and Vice President Harris were able to get a bipartisan bill. By the way, all 3 of these things that I talked about were done on a bipartisan basis. So I think if you look at the accomplishments of the Biden-Harris administration, they are high relative to the rhetoric. If you look at the Trump administration, the rhetoric was high and the accomplishments were not that great. Someone said to me, or I heard it on one of the news shows the other day, Trump wasn't so bad if he were a silent movie. I would say it the other way. If you just listened to him and you didn't see what he was actually doing, you would think he was actually accomplishing something, when in reality he didn't get that much done.
All right, Ralph, I got to leave it there. Always great to talk to you, and wonderful insights as always. A lifetime of experience on Wall Street. Chairman Emeritus over at Evercore. Coming up here, we're going to take a look here at some of the big movers on the day, including the surge in shares of Bally. News of the buyout offer. It's our stock of the hour, and it's up next, right here on the close on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
All right, time now for our stock of the hour. Taking a closer look at shares of the casino company Bally's, up about 25% here on the day. This on the news, the Standard General has agreed to acquire the remaining shares that it didn't already own. Abigail Doolittle joining us now for a little bit more on this. They own about a quarter of this company, a 35% premium, it looks like, based on yesterday's closing price here. Overall, it seems like a pretty good deal, certainly for Bally's. Is it a good deal for Standard General?
It certainly seems like a good deal for Bally's, considering the stock is down about 80% from its peak. If we look at the other numbers, this year, this company's modeled to a $9 loss. That's incredible. I mean, it's more than $9. I can't remember the last time I saw such a big loss, and it was a big loss last year. Margins are dropping by a couple 100% this year and next year. As for Standard General, it's sort of interesting in fact, because they own the Queen Casino, so they're hoping to fold this thing into it. Queen Casino has 4 casinos, whereas this Bally's has 15 casinos in 10 states, a horse racetrack in Colorado, a golf course in New York, an online gaming operator as well, plus the sports betting platform dubbed Bally Bet, almost 1,100 employees. So what I'm trying to say here is, from an operating standpoint, to fold all of this in, It's not going to be the easiest thing. One thing to point out, the stock is having a nice pop today, but it's a 35% premium. The stock's up about 25%. So there are some people who think maybe this deal isn't going to get done, or there's going to be some challenges.
And the Queen Casino entertainment business that Standard General currently owns operates 4 casino properties, as you mentioned, so it's a lot smaller.
Yes.
Is there going to be any kind of regulatory resistance to this?
It's interesting that you should ask that. It seems unlikely, but on the one hand, one thing to consider is that there are some horizontal similarities. From a geography standpoint, 3 of the Queen casinos are in Louisiana. One of Bally's is. That would be the one point of concern. Outside of that, probably unlikely. However, the FTC, super active, and right now it seems as though there's bipartisan support for cracking down on deals. More in technology, but who knows? Maybe there will be an issue here.
All right, great stuff. Bally's currently up by 25% on this buyout offer from Standard General, the hedge fund, for $18.25 a share. Thank you so much.
Yeah, I'm always curious as to how casinos lose money. I mean, $9, what'd you say, $9 a share or something? Yes. I mean, like, I thought this was just a license to print money.
Right.
You basically just hand the money, they spin a wheel, and then
there's
you're
definitely
supposed
room to redo this and restructure this somehow. All right, Nadia Lavelle joins us next with the countdown to the close.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Saturday mornings, I understand you have off.
Yeah, Saturdays is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife. We go for a swim all year round. After that, have a nice lunch, and then I'm on to a good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend as they fancy. I think what we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, the bandwidth of your reflection is just too narrow. And I generally believe...
So 1 minute now until the market on close imbalance.
I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
So we are looking now to the market on close imbalance. The S&P 500, 720 million to the sell side. The NASDAQ 100, 610 million to the sell side. That's in the Dow 30 stocks, 270 million to sell. At Mag 7 stocks, 255 million to sell. So the side imbalances across the board on the new US indexes
is something that literally is going to improve the performance of almost every company. For the first time, we're having technological change that significantly affects the jobs of service workers, white-collar workers, and so every company is going to improve their productivity and their margins utilizing AI. It's going to take a while to happen.
The chairman emeritus over there at Evercore, of course, a lifetime of experience on Wall Street from his days in helping to found BlackRock to the old Lehman Brothers days. So he really understands kind of these inflection points in market cycles. And I do wonder if that's what we're seeing, particularly with yet another day of outperformance with the small cap stocks.
Absolutely. You take a look at what's happening in the big cap stocks, the S&P 500, for instance, down about 0.2%. The NASDAQ off by 0.5%. But you look at the S&P equal weighted index, up 0.4%. That rotation into things that aren't big tech is definitely taking hold, and certainly the Russell 2000 continues its outperformance. Ralph was talking about how it's going to take time. We all knew that coming into this AI story, but at some point during this earnings season, investors were like, no, I need to see something more right now.
Yeah, and it's interesting too, I'm glad you put up the equal weight there, because when you look at the cap weighted index and you take a look at where the S&P is down on the day, despite the fact that the majority of stocks, more than 300 stocks in the green.
Overwhelming,
But that might be an encouraging sign, because that is your rotation. Basically, the other 490 names, or in this case 318 names, but still I think that's what a lot of people really wanted to see. Let's get you down to those closing bells here. Nadia Lovell joining us right now, senior U.S. equity strategist over at UBS Global Wealth Management. And Nadia, when we talk about this rotation, a rotation that now looks like it really is a little bit more sticky. People are encouraged by the potential for a drop in rates. They're encouraged by numbers like that GDP data that we got this morning that seem to suggest a relatively decent economy, or at least an economy that will be more favorable to small cap names. You see that?
You know, we are neutral officially on small cap, so we do think that it is important to have some exposure. But I would say that we are a little concerned about the durability in small cap, and particularly the strength and the velocity that we've seen in this rally in small cap. You know, it's not really fundamentally driven. It's really being driven by macro factors and positioning. We have seen investors close out their underweight and also a bit of a short covering. And so valuation multiples have expanded in the last few weeks for small cap, and so that gap between large cap valuation and small cap has narrowed. They're still trading at a discount, though, to the large cap space, but on an absolute basis, not so much anymore. And what we've been seeing consistently, even through this earnings season since the start of the year, is downward revision to small cap. So yes, agree that in terms of a Fed cut could help alleviate some of the balance sheet concerns and refinancing concerns around small cap, but really want to start to see that earnings growth come through for this to have any sort of real staying power and become not so much a trade and more of an investment.
And it's interesting too. I mean, when you look at the complexion of this small cap rally, a lot of that is still tied to financials, a few kind of cyclical type of names like in the materials space, et cetera. But then when you get down to tech and discretionary, even on a small cap basis, you're not seeing as much love there. And I'm wondering if that's indicative of investors' concerns about those macro conditions.
I think partly, I mean, some of it has to do with just positioning that had been within the tech space. So we are seeing that rotation continues. But, the complexion of that could change next week when we have some of the more less cyclical and more defensive areas of tech report. What we have been advising our clients globally, more tactical clients coming into quarter, was to position a little bit more defensively in tech. But now you're starting to see some of these, semiconductor names that are now in correction or even, bear market territory. So the risk reward set up in some of these earnings are a little bit more attractive. Now, there's concerns around whether we're sort of entering a CapEx bubble, and that remains to be seen. We don't think so. So we do think that the AI story still tech, and we do expect these companies to reinsert their leadership by the time we get through this earnings season.
Talk a little bit more about what your clients are doing. We came into the second half of the year, and there was a lot of anticipation that people wanted to put money to work. Is that what you found when you talked to your clients, that they wanted to put money to work, or were they fully allocated and pretty happy with where they were and wanted to continue to see how that would play out?
Yeah, there is still, as we know, a lot of cash on the sidelines. I would say what we're seeing more, because we are a global wealth management firm, we do see in terms of outside the U.S. in particular that a lot of our clients are underexposed to the U.S. market and actually underexposed to tech, and where we see opportunities. And so we're starting to see some pickup in activity there, but clients still have dry powder to put to work. And so we would look at this sort of rotation that's happening, and also the broader pullback in the broader market, because reality is you need mega cap tech to be able to participate for the broader S&P, the S&P market cap to be up. Another leg down in this, we would look to that as a buying opportunity. We ultimately think that this is a market that could get to 5,900 by the time we get to the end of the year. And so we tactically looking to add if this market continues to trade down.
Okay, got it. Thank you for explaining that. You mentioned that small caps are trading at a valuation discount to large caps. Would you say that valuations of the most popular trades, and here we're talking about big tech, of course, anything tied to AI, have reached what one analyst called stupid levels?
Maybe in some of the small cap space, but I would say in the large cap space, valuations aren't cheap, but I don't think that they're definitely not bubble territory or overly exuberant, because reality is the earnings growth is coming through for these companies. Yes, there's been some chatter and a lot of much ado about potential for mega cap tech's earnings to decelerate in the second half of the year. We know a lot of these companies has been growing at over a 30% clip for the last 4 quarters. This quarter, they'll probably put up another 30% plus growth. And so some of these companies, particularly given the pullback, will be growing into their valuation multiples. And so we don't think that valuations are, in sort of bubble territory. And as long as the earnings are following through, these companies can continue to perform well.
Nadia, always great to talk to you. Nadia Lovell there, Senior U.S. Equity Strategist at UBS Global Wealth Management, helping us count you down to these closing bells with about 3 minutes until we get there here. A bit of a complexion change here or at least in the aggregate markets here. The S&P and the NASDAQ now falling deeper into the red, right around lows of the day. The Russell still clinging to some pretty decent gains, up more than 1%.
And this is kind of something we've seen during this rotation out of those big cap tech stocks, is that in the last hour of trading, instead of kind of rallying into the close, we start to see a little bit of a swoon, especially on days where things were a little bit mixed to begin with.
And don't forget, maybe some of that is also some concerns that we have a big economic data point coming out tomorrow that could change the complexion of the market once again, depending on what it says. And of course, we're still heading into the real meat of the earnings season next week, where you get the Microsofts and Amazons and all those types of names.
And then, of course, you've got the Fed next week, and you've got the jobs report on Friday.
Absolutely. So a lot for investors to chew on here as that rotation in the equity market continues. The VIX elevated on this day, we should point out, back to the 18 level at one point, trading at 19. Our full coverage of all the market moves coming up right now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu here to take you through the closing bells. Our global simulcast, it starts right now. Carol Massar and Tim Stenovic joining us in the radio booth. Alex Steele has the day off. Welcome to our audiences across all of our Bloomberg platforms, including our partnership on YouTube. That rotation, Carol Massar, into small caps, out of big caps to a certain extent, continues for yet another day.
Absolutely. Rotation, but I feel like we've been kind of back and forth, some hesitation in terms of certainly the S&P and NASDAQ in terms of what direction it wants to go. So I would say volatility continues to kind of be back in I feel like a big way. You've got the VIX going above 19 today. So I do feel like investors are kind of trying to search for what is the next big trend line.
And I was trying to go back. I don't think we've seen it this high almost all year long, right?
Right.
Yeah.
It feels like it's been a long time, right? Yeah.
It's interesting to see after yesterday, Romaine, I know you were out, but I don't know if you heard there was a major sell-off.
No, I did not
hear. The S&P 500.
Oh, was it? Okay.
Yeah, so the rotation, but it wasn't a rotation into small caps. That's the thing. So that kind of took a pause, but the fact that it's back on, I mean, I don't know, it was yesterday's sell-off harbinger of things to come, or just sort of a one-off?
You know, if you put it in context, yes, we extended yesterday's sell-off, but now the S&P 500 has fallen for 6 days in the last 7. You look at a chart, and it's starting to look definitely like we've plateaued, and maybe we have definitely reached that inflection point.
Yeah, and just a clarification too on the VIX, we did get above that 20 level back in April of this year here, but still at an 18. Yeah, but still at an 18 reading here. Some territory we haven't been in now for about 3.5 to 4 months. We get the closing bells here in New York. A mixed day once again here with green on the screen. At least if you are in that small cap, mid cap, or cyclical space, the Dow Jones Industrial Average higher by more than 80 points, or about 0.2%. The S&P taking a leg lower, down about 0.5%. The NASDAQ also lower by about 0.9%. The NASDAQ 100 down more than 1. As for those cyclical names, Dow Transport's up 1.3%. The Russell 2000 up by a similar amount, 28 points, or about 1.3% on the day.
I might remind everybody, too, though, we're still up, I think more than 30% since that October low back in 2023. Having said that, Scarlett, today you've got 290 names in the S&P 500 gaining ground, 211 to the downside, 2 unchanged.
All right, let's take a look at the sector performances, because you'll see the heaviest weighted sectors doing the worst. You've got communications services down 1.9%, technology losing 1.2%, utilities, okay, not a heavily weighted sector, but down 0.9%. The ones bucking the decline, energy up 1.5%, industrials and financials and materials